Hey folks, welcome you all to a new video. This is CA Ganesh Bharadwaj. So, in this video, we are going to get started with your CMA Intermediate Paper 12 Management Accounting Marathon. Of course, this is just the part 1 of the marathon. Part 2 will also be uploaded separately. So now, before we get into this marathon, first I would like to give you guys a brief introduction. So for those who do not know me yet, so my name is CA Ganesh Bharadwaj. So I'm a practicing chartered accountant and a very passionate teacher. And I handle 2 papers at the CMA intermediate level. Your paper 12 management accounting, which is the current paper, and paper 8 cost accounting. And at the CA intermediate level, I handle your paper 4 cost and management accounting and paper 6A financial management. Of course, I'm also going to take advanced financial management for the final level. Right? That's a brief introduction about myself. Now, coming to this particular marathon. Now, guys, this marathon for your paper 12 management accounting, we will be covering about 70 to 80 marks, right? 70 to 80 percentage, right, is going to be the coverage in this particular marathon with respect to the topics and concepts covered, right? About 70 to 80 marks you can expect from the areas covered in this particular marathon, right, guys? Now, what are the topics covered in this marathon? Now, in part 1, we are going to cover divisional performance measurement, marginal costing, applications of marginal costing, and activity based costing. Now, very important chapters from these areas itself. You can easily expect around 42 to 50 marks roughly, right? Because divisional performance measurement, every attempt 2 7-mark question comes. Marginal costing and applications of marginal costing, needless to say, some 2-3 questions will easily come. 2-3 7-mark questions, I'm saying, right? Activity based costing, every attempt at least 1 question they are testing. Literally, we are going to cover all the biggies, important areas, especially this marginal costing single chapter itself, right? We'll be seeing a huge coverage of about 4.5 hours, right? And then in part 2, we will be covering standard costing, all the different all the variances, right? Be it your material, labor, variable overheads, fixed overheads, sales variances under total approach, sales variances under your margin approach, everything will be covered. And also your forecasting, budgeting, budgetary control. Each of these 2 chapters cover 15 percentage weightage. So this is going to be the coverage we are going to see in this particular set of 2 marathons, right? Now, before we get started, there are also a few things I want to tell you. Now, I have made 2 different books, right, for your paper 12 management accounting, exclusively for your CMA Inter. There are 2 books. So the first book is called as the Concept Decoder book. Basically, this book has all the concepts in your study CMA Institute study material, whatever is there, 100% of the concepts, including theory. So practical concepts and theory have been neatly segregated in this single book, right? Just about less than 200 pages. Entire study material concepts are covered here, right? All the chapters, every single thing is kept here. And if you can see the markings, basically whatever I've marked was, all these markings were done during our regular and exam oriented batches when I took. That was a time when I did all these markings, by the way. And the second book is your solved question bank. This question bank will have 100% of all the questions from your CMA Institute study material, plus with solutions, plus it also has past exam questions with solutions, right? So it also has past exam questions with solution exclusively for CMA intermediate paper 12 students. For example, if you can see activity based costing, right? So this blue color background, right, if you notice, all these are study material questions. 100% of study material is covered here, right? I'm talking about in this book, I'm saying, right? And look, at the end of the chapter, we also have past exam questions. Look at this. Questions from previous year papers, PYPs. The background is, slight beige color. Attempt wise I have given. And sir, are all these questions covered? Each and every question, we do it with the solution in detail. I do it in the class notes, right? During our regular exam oriented batches and all. In regular batch, even your past exam papers are covered. Sir, how about marathon, sir? In marathon, right? So obviously this is a revision batch, right? So basically what I do is I take up all the concepts in these chapters, right? And all the concepts with numerical problems we will be solving. Limited numerical problems, not all the numerical problems. Obviously, this is a marathon. But even this, I'm telling you, trust me, the kind of coverage will be such that you will be able to effectively revise the entire subject beautifully once before your exam. Now, the prerequisite is that you should already know the subject once. Now, if you have not read for some reason, trust me, even in that case, definitely you will find this marathon very, very useful. But clearly, this is not a substitute to our regular or exam oriented batches, right? Because there the coverage is in depth. Every single sum that you can see in your study material or the question bank which we prepared, we solve. But here, all the concepts we will be revising quickly with the help of one representative question from every concept. I will also be doing here. It's going to be an exhaustive coverage, and this chapter, divisional performance measurement, trust me, this is a game changer, because this chapter is relatively a smaller chapter. In about 1.5 hours we can revise the entire chapter with a limited numerical problems, but every attempt 2 full 7-mark question gets tested here, right? That's the beauty of this chapter. Every single thing, the strategy and other things with respect to each and every chapter, I will be sharing during the course of this marathon. But I also want to tell you one more thing, guys. During our regular and exam oriented batches, so it is exclusively done for CMA interest students. In fact, there are even common topics for paper 8 and paper 12. For example, marginal costing. There are common topics, but still it was separately recorded even for paper 8 and paper 12. So even between the two papers, there is no interchanging or common recordings. It's been separately done in our regular and exam oriented batches. Exhaustive coverage. And if you have already attended my lectures, during the lectures, I would have dictated the library of adjustments, which I would have asked you to write down. You please have that with you. It will be effective for you to watch this marathon. And for those who have not watched my regular or exam oriented batches, absolutely fine. You either did a self study or watch the lectures of another faculty and learned, absolutely fine, not a problem. Even you guys can follow this background. Even you guys can follow this marathon, because wherever required, I share the background and only I will be actually taking across this marathon. And one more thing, guys, I request you all to follow is that now when you are watching this marathon, please don't watch it like a web series and binge watch. No, please have a notebook, take a pen, calculator, be ready as if you're watching a class, a proper class, right? And as and when I explain certain things, please catch up notes. And now for every concept, I will be doing one numerical problem and all. And at the end of the numerical problem, I will dictate something and ask you to write down. I call it as the library of adjustment. What is that? Basically, in your notebook, I want you guys to prepare this. So, library of adjustments. Now, here, you should segregate this as follows. Chapter name, question number, page number, and then adjustment. For adjustment, you leave a bigger space. Now, what is this? For example, in divisional performance measurement, right? You write the name divisional performance measurement. In that, let us say we solved the first question. Now, this first question was actually, this first question was there in, let us say, page number 125 of our solved question bank. Example, I'm telling you, you can write down the page number. And what we learned in this question is called as adjustment, which I will be dictating even in this marathon. In the marathon itself, I will be dictating. So as and when we finish something, you please update this library of adjustment. These 3 columns you should populate. Chapter name, question number, page number of our solved question bank. Adjustment I will dictate. Please write it so that the 2 marathons put together will come close to about 14 hours, right? So whatever we are going to cover, part 1 plus part 2, whatever you are watching here, effectively, trust me, if you update your library of adjustment properly, once again, if you want to revisit in a span of half an hour to 45 minutes, you can revisit the entire content which is being covered in a span of 14 hours. That is a promise from my side, provided you are properly maintaining your library of adjustments, because this is a game changer for many students. If you want, you can ask your seniors, right? Especially the ones who have attended our regular classes and all, because therefore every single sum in this book I would have dictated. So that is actually something which will be able to increase the efficiency of your revision, and it reduces a lot of time in your revision. Clear with this, guys? So this is something I expect you to follow. And the concept decoder book and your solved question bank, right? These two books, if you want to download it, you can download it from you can download the PDF free of cost from our website under the free resources section. And if at all you have a hard copy, nothing like it, great. So the hard copy, you can follow it along with the hard copy, absolutely fine. Clear with this, guys, right? So that's about the thing. So that's about the introduction right now. And guys, in fact, in our in our book, the solved question bank, if you see, for paper 12 management accounting, we have a total of 215 institute study material sums, 70 past year papers, right, past exam questions, and 287 MCQs we have, right? And all this we cover in our regular batch, and I told you in marathon. So for the topics mentioned, I will clearly explain all the concepts and one representative sum, so that it's an easy thing for us to revise. Similarly, in your paper 8 cost accounting also, we have a separate concept decoder and a solved question bank that covers 228 institute study material questions, 44 past exam questions, and 181 MCQs. All these are solved fully in our regular batch and all. But in our marathon, separately for paper 8 cost accounting also, we have uploaded a marathon where accordingly the concepts and one representative sums from the respective chapters are covered, right? So this marathon is an effective tool for you to revise the entire subject, even if you're watching it the day before your exam. So please make the best use of it, and please have a notebook and a pen and a calculator, all your required stationaries, and start watching it. Trust me, this is going to be a game changer in your preparation. On that note, let's get started with the marathon for management accounting. So let's get started. So guys, let's get started with the revision of the chapter Divisional Performance Measurement. All right. So now, in your concept decoder book, right? In your concept decoder book, so in this concept decoder book, if you notice, you have this divisional performance measurement, which is your 8th chapter. So maybe we can just take that out. 1 second, let me just take it out. Right. So divisional performance measurement. Right, guys? By the way, this handwritten notes, right, you can find it on our website. So you can download it. The PDF version of this can be downloaded. This is basically the notes which I used during our regular and exam oriented batches. Basically, whatever I have annotated here, you can find the same on our website as well. Now, guys, this particular chapter, divisional performance measurement, is very important from an examination perspective. Every single attempt, they are testing 2 7-mark questions from this particular chapter. Almost all attempts, right? They are testing 2 7-mark questions in this particular chapter. Right, guys? So it's a very important chapter. So now we are going to start with the revision of this particular chapter, divisional performance measurement. That's why I wanted to start this particular marathon with first revising this particular chapter, divisional performance measurement. Right? So it's going to be a revision right now. We'll be touching about all the concepts covered in this particular chapter. And in every concept, I will be doing one numerical problem in the marathon itself, right? However, in our regular and exam oriented batches, every single sum printed in our solved question bank will be done with detailed solutions and all that. But since this being a revision marathon, I will be doing one numerical problem for sure from every single concept of this particular chapter. Fine. Now, guys, our subject, basically management accounting, cost accounting and management accounting are basically interlinked. These two are interconnected, right? So collectively, if I say cost and management accounting, if you see, our subject goes on to achieve 3 objectives. Objective A is called as stock valuation and profit computation. Objective B of our subject is decision making. And objective C of our subject is control. Now, every chapter you study in paper 8 or paper 12, right, goes on to achieve either one of these three objectives. And generally, those chapters that deal with objective A are generally classified under cost accounting in your paper 8 of your CMA intermediate, and those chapters which go on to achieve objective B and C, basically decision making and control, comes under the concept of management accounting, right? It comes under management accounting. So please have this context very right. In fact, I would have given a detailed introduction during our regular lectures, but since this being a marathon, once again, I didn't want to leave it. I'm just giving you guys a bird's eye view about this. So yes, so our subject in this paper 12, management accounting, every chapter you see will either go on to achieve objective B, decision making, or objective C, control, right? Or some chapters will go on to achieve both the objectives B and C. Clear with this, guys? Now, in this particular chapter, divisional performance measurement, this chapter goes on to achieve objective C of our subject, which is control. Sir, how, sir? What do we cover in this particular chapter? Now, neatly, I have bifurcated and classified the concepts covered in this particular chapter. Divisional performance measurement. In this chapter, we'll be seeing the following concepts. First one is something called as DuPont analysis. Then we'll be seeing divisional performance measurement tools, DPM tools. One is ROI, return on investment. Then we'll also be seeing a concept called residual income. And then we'll go on to learn a concept called economic value added. Then there is another concept called learning curve. And finally, you have a concept called as balanced scorecard. This balanced scorecard is actually a theoretical area. There's only one sum regarding that. All these are practical areas. And one more thing I want to tell you guys. The sum of these first three segments of this chapter literally are a part of your financial management, which you are learning here in management accounting. So these three are ideally a part of your financial management, which you are learning here. So literally, you should have some knowledge of financial management. Still, then and there, here, I will give you guys, wherever possible, the background, right? During our, in the full-fledged batch where I go into a little bit of detail to the extent of financial management required, but here also do not worry. I'll give you guys the requisite background so that, right, even if you have not watched my regular lectures, at least if you are just a month away or maybe a week away from your main exams, even then you will be able to follow this marathon. For that purpose, I will give you guys the context before we enter into the respective concept. Clear with this, guys? But understand, these three are ideally a part of your financial management area, which we are learning here in your management accounting. Now, sir, what is this particular chapter, divisional performance measurement, deal with? Now, guys, division means generally what people think. Division is a department, sir. Not necessary. A division could even be a department, like production department, sales department, or a division could be a branch, Chennai branch, Hyderabad branch, Guntur branch, or maybe your Bangalore branch, your Cochin branch. It could be anything. Or it could even be a subsidiary. The subsidiary, for example, Tata Group of companies. They have multiple companies in Tata Group, Tata Consultancy Services, Tata Motors, right, which got, recently there was a demerger also in Tata Motors, but anyways, right, into commercial vehicles, passenger vehicles and all. Anyways, Tata Motors, there's a company called Tata Elixir, Tata Power, Tata Finance, etc. All these are Tata Group of companies. So how, sir, all these companies have the name Tata? Because there is a flagship holding company called as Tata Sons Limited. This company holds the major stake in each of these subsidiary companies. Clear with this, guys? For example, if you take the balance sheet of Tata Consultancy Services, in the balance sheet of TCS, you have equity share capital. So the significant portion, more than 51% of the equity share capital will be held by Tata Sons Limited. Like that, 51% of the stake in each of these Tata group of companies is held by this flagship holding company called Tata Sons Limited. Now, guys, fine. Sir, now, sir, why are we reading this particular chapter in management accounting? I will tell you. Now, Tata Sons will want to know how each and every subsidiary company in which they have invested is functioning. Guys, correct? They want to exercise some control and check whether they have invested this money in this company. Now, whether this investment is yielding good results or not. If they are not yielding good results, obviously Tata Sons, that is the holding company, needs to take a corrective action. For this, they need certain tools to actually evaluate the performance of each and every division, in this case the subsidiary which the company has invested in. Clear with this, guys? And so what are the different tools available in order to evaluate or measure the performance of their division? This is what we are going to study in this particular chapter. Hence the name of this chapter, Divisional Performance Measurement. We are going to see the tools that we are going to learn that are used to measure the performance of the divisions, and hence the name of the chapter, Divisional Performance Measurement. Literally, I have derived the logic for the name of this chapter as well. Clear with this, guys? Now, to evaluate the performance of multiple divisions, these are all the different segments we are going to learn in this particular chapter, and I told you the first three segments are purely related to your financial management, so we will be revising that. And then we also have a learning curve and your balance scorecard method. Right, guys? Now, I want you also to remember one more thing. Sir, whatever we are going to learn in this chapter, will it be useful only for a company to evaluate the performance of its divisions? Not necessary. Suppose you are an investor, right? Forget about a company. You are an individual investor. You have some money. You want to invest this money in a good company in a stock market, right? You want to go buy shares of a company. Now, to judge whether a particular share is good or not, even for that judgment, you want to take a particular decision, you can use some of these tools. Are you clear with this? So ideally speaking, whatever we are going to learn in this particular chapter are not meant only to measure or evaluate the performance of a division of a company. This can also be used for standalone companies as such. Clear with this, guys? But still, this chapter is being coined from a perspective of evaluating the measurement or evaluating the performance of the particular divisions of a company. So this way, the holding company, in our example Tata Sons, will be able to exercise good level of control. They will know which of their subsidiaries, which of their babies are performing well. Are you guys clear with this? In this particular context, let's get started with the first segment of discussion called as DuPont analysis. Now, as I told you guys that this chapter requires some level of financial management. So before we get into the the core of this particular chapter, first let us understand the context of income statement. Now, guys, many of you know income statement, your marginal costing income statement, how it looks like. Sales minus variable cost gives you contribution, minus fixed cost gives you operating profit, right? This is the profit reported in our subject. Clear with this, guys? Now, more details about all these things I will explain separately in marginal costing chapter as well. Every single line item will be doing it, but since this being an important chapter, I actually kept this as a first chapter in the marathon, right? During our regular courses and all, we'll first finish off marginal costing and then only come to this divisional performance measurement. But anyways, since this being a revision, I want to keep this chapter first because this is a very important chapter from an examination perspective, and trust me, it will not take much time. Clear with this, guys? Now here the cost and management accounting stops at operating profit. Sales minus variable cost gives you contribution, minus fixed cost gives you operating profit. Operating profit is also popularly called as earnings before interest and taxes, right? Now, from EBIT, your financial management starts. What is this? Earnings before interest and taxes, which means before interest and tax. So first, from this subtract interest. Interest is paid to whom? The providers of debt. correct? Your banks, your debenture holders and all that. If you subtract from EBIT, if you subtract interest, you get what? EBT, earnings before tax. From EBT, you subtract tax, you arrive at what? Earnings after tax. Now, in this from this earnings after tax, now you will have to pay your preference shareholders with a preference dividend, right? Now, whatever amount you have is called as net income, or it is also called as earnings available for equity shareholders. I call it as EFE. What is it called as? Earnings available for equity shareholders. Or in other words, your entire income statement, that is cost and management accounting and the financial management segment, this is how it looks like. Sales minus variable cost gives you contribution, minus fixed cost gives you earnings before interest and tax. With this, ideally our subject stops. However, now from here your FM starts. That's why cost and management accounting and financial management, they are interlinked, right? Earlier, under the old syllabus 2016, they had this as a single paper, cost and management accounting and financial management. They had it. Now they have bifurcated separately and all, right? So now from EBIT, if you reduce interest, you get EBT. From EBT, if you reduce tax, you get EAT. From this, if you subtract preference dividend, you get the earnings available for equity shareholders, also called as net income. Now, with this context, let's go to the first segment of discussion in this chapter, DuPont analysis. Now, if you look at our concept decoder book, now whatever is there in the study material, I have clearly explained it here and all these things, but let us practically and logically understand this particular concept. Now, this DuPont analysis was introduced or analyzed and given to us by a company called DuPont Incorporation. Right, the company's name is DuPont Incorporation from the United States. This is what is given here. It is given by DuPont Corporation in the year 1920 itself. Now, what have they given? Simple. They have just given us the manner of computing return on equity formula. Guys, this is nothing but your financial management area. Once again, you'll be studying all this in financial management as well. Return on equity. What is the formula? Simple. First, you logically tell me. Return on investment. What is the formula? Return divided by investment. Guys, correct? Now, they've asked for return on equity. From the equity shareholders' perspective, what is the return? Net income. Guys, correct? From EBIT, I subtract interest, I get EBT. From that, I subtract tax, I get EAT. From that, I subtract preference dividend. I paid all the other providers of finance. Whatever is left out belongs to the equity shareholders' net income. So, net income divided by what was the investment that the equity shareholders have brought, the total equity component, that is the equity shareholders funds. Or in other words, the return on equity is nothing but the net income, that is your return, divided by investment. What was their investment? It was total equity shareholders funds. Clear with this, guys? This is a normal formula. Now, DuPont Corporation, what they have said, return on equity is equal to this formula. They have given a manner of computing, right? Another perspective they have given. What they have given, return on equity is equal to net profit ratio into asset turnover ratio into financial leverage. Now, what is this? Net profit ratio means what? Simple. Net sales, net income divided by sales into 100. Guys, correct? So, net income divided by sales is your net profit ratio. You guys know that this is very simple. Sir, net profit ratio, sir. Net profit divided by my total sales. Right? This is the net profit ratio. Now, what is the formula for asset turnover ratio? Turnover ratios. Recall. Right? This is actually something you would have studied even in your school days or in your foundation. Alright, if not, even in your intermediate financial management, you would have learned it. Ideally, this is a part of financial management, right? So, asset turnover ratio, turnover, sales divided by total assets, right? And financial leverage, right? This is also called as equity multiplier. The formula is total assets divided by equity. Now, what is this? I will tell you. First, net profit ratio. The formula is what? Total income divided by sales. This talks about the profitability of the company. Clear with this, guys? Now, sales divided by turnover, asset turnover ratio. This talks about the efficiency of the company. How? I will tell you. And the last one, total assets divided by total equity. This talks about the leverage of the company. Once again, I'll tell you how. Now, before that, first, the formula for return on equity is net income by total equity. right? And this company DuPont Corporation has given this formula. If you see, guys, what happens here, sales and sales gets knocked off, total assets and total assets gets knocked off. Literally you get what? Net income divided by total equity. Net income by total equity. You literally get whatever was the base formula here. Clear with this, guys? Now, sir, what is the big thing here, sir? They asked us to multiply three formulas, I mean, three different ratios. These ratios, they got knocked off each other, and literally at the end of the day, you got net income by total equity. And this was introduced some 100 years ago, 1920, it got introduced more than 100 years ago. And till date, we are studying this. What is the great thing, sir? If I multiply these three like things, these three ratios, the numerator and denominator gets knocked off. So what is the big thing? No, it's not like that. There is one very important learning in this particular area of DuPont analysis, and that's what we're going to see here. Now, the net profit ratio, as I told you, talks about the profitability. How, sir? For example, let us say the net income is 20 crores, right? Sales was 100 crores, which means if I make a sale of 100 crores, I'll be able to earn a net profit of 20 crores, which means 20% is my net profit ratio. Guys, correct? Now, asset turnover ratio, sales by total assets. For example, let us say my total turnover for the year was 500 crores, and the assets, the total assets that I deployed was 100 crores, which means 500 by 100 was 5 times. What does it indicate? Look, by using assets worth 100 crores, I was able to generate a turnover of how much? 500 crores, or it means that I have actually generated turnover which is equivalent to 5 times of the investment made in the company. Or in other words, guys, this asset turnover ratio talks about how efficiently the assets of the companies are being used. Clear with this, guys? So for 100 crore rupees worth of assets, I'm able to generate 500 crores of turnover, which means I'm using the assets very efficiently. Clear with this, guys? Right? So that's about it. Now the next one, total assets divided by total equity. This is called as leverage, right? Also equity multiplier. Sir, what is this, sir? What does this talk about? For example, let us say we have a company A. The total amount they raised, capital employed, was 100 crores, all right? This entire amount they have invested in the company. This is the total assets. Now, how did they raise this money of 100 crores? 50 crores they raised from equity, 50 crores from debt. Clear with this, guys? Now, following this formula of leverage, total assets by equity, how much will be the equity multiplier or leverage? Total assets, sir, 100 divided by equity, how much is it? 50. You get 2 times. Clear? Now, let us say company B. Same 100 crores they raised, the only one change was the proportion of debt and equity alone, they changed it. 20 crores they raised from equity, 80 crores they raised from debt. Now for this company, if you apply the formula, total assets divided by total equity, how much will be my leverage? Assets is 100 crores. Equity is how much? 20 crores. For this company, the leverage is 5 times. Clear with this, guys? Sir, what does it talk about, sir? Wait, I will tell you. This is a very technical discussion in a part of your financial management. You have a separate chapter called leverages, operating leverage, financial leverage, combined leverage. But to a limited extent, I will give you the background here. Now, guys, what DuPont Incorporation says is that, look, first, mathematically, they have proved return on equity is nothing but net profit ratio into asset turnover ratio into leverage. Correct? Now, this DuPont company has made an analysis and they said, look, if a company wants to increase the return on equity, right, the increase in the return on equity can be made if they either increase their net profit ratio, or if they increase their asset turnover ratio, or if they increase their leverage. An increase in any one of the three, because your return on equity is a multiplication of these three. It's a function of these three. So an increase in any one is enough. So an increase in any one will result in a higher return on equity. Or in other words, these three are the components that make up the overall return on equity of a company. Clear with this, guys? Now, this was what DuPont Incorporation found out. Now, guys, what happened in this particular, let us say in our example, for a particular company, the profitability was how much? 20%. The efficiency, asset turnover ratio was how much? 5 times. Clear with this, guys? Right? Now, into leverage, let us say it is 2 times or whatever we saw here, 2 times or 5 times. Clear with this, guys? So if you multiply these three, you will get what? Your return on equity. Clear with this, guys? Perfect. Now, let me just take an example of a particular company. Let us say company A. These two companies we saw. Company A. Let us say company A, right? It had an overall return on equity of 30%. Company B, it also had an overall return on equity of 30%. Let us say company A was Tata Consultancy Services, TCS. Company B was Tata Motors, right? Both the companies reported the same return on equity. Now, which company is better? Now, you will say, sir, both the companies give same return on equity, sir. Both are equally good only. What is the question? Now, I am giving you guys the breakup. DuPont analysis. DuPont came and they are doing the analysis. Sir, company A, sir, 30%. How is it made up of? 20% is because of the net profit ratio, into 1 is the asset turnover ratio that talks about efficiency, into 1.5 into 1.5, let us say 1.5 is the leverage of this particular company. Leverage happens because of the composition of your debt and equity in your capital structure. Clear with this, guys? Now 20 into 1 is 20. So 20 into 1.5 becomes 30%. So this is how the 30% of your return on equity has made up. How about company B? Sir, company B net profit ratio was 5%, sir. The asset turnover ratio is 2 times and the leverage was 3 times. Or in other words, this particular company B, it has a net profit ratio of only 5%. Into 2 makes it 10%. Now 10% is because of their overall efforts. Now into 3 times it is being magnified using leverage. Sir, the company did not genuinely take any efforts to increase the return on equity, but what has happened? Because of this leverage effect, that is because of the composition of debt and equity. Because of this, basically in our example I have taken 3 times was the the leverage factor for this particular company. So because of that, what has happened? 30% they have got as return on equity. Clear with this, guys? Now, if you notice, between the two companies, what has happened? Company A has achieved this 30% significantly because of their profitability. Profitability was 20%. Right? Because of the leverage, right, it got increased by 1.5 times. Whereas for company B, profitability and the efficiency and all is very less. But just by using leverage means what? Using more of debt and less of equity. Now what has happened? It has drastically increased and boosted their return on equity. Clear with this, guys? Here if you see, company B has used what? More of debt, less of equity. Now for that only the company has a more leverage, whereas company A, if you notice, it has equal debt and equity. It had only 2 times. So if you increase the debt in your composition of your capital structure, the leverage will actually increase. Clear with this, guys? Now, sir, is leverage good or bad? Now if you notice, for this company, sir, 5% into 2, 10% was the profitability attributable to their net profit and their efficiency. Whereas this was significantly, this became 3 times. It was multiplied with 3 times and it gave me what? A return on equity. So in this case, a limited profit and 3 times of your profitability and your efficiency became your return on equity, right? Whereas, just take an example, suddenly during a downfall, this company is reporting only a 1% net profit ratio. In that case, what will happen? 1% into 2 into 3. Now, how much will be the return on equity for this company? 1% into 2 is 2%. 2% into 3 will be how much, guys? It is going to be how much? It is going to be, so 6%. Now, from 30% of return on equity, drastically this company's ROE will fall down to 6%. Or in other words, your leverage is very, very risky, right? Now, if your profitability increases, your return on equity will increase 3 times the profitability. Whereas if your profitability decreases, your return on equity will decrease 3 times your profitability. Are you clear with this? Hence a higher leverage is an indicator of risk. It will be helpful for you, it will work in your favor if your profitability is increasing. Your ROI will be 3 times of the increase in your profitability. But if your profitability is decreasing, the decrease in your ROI will also be 3 times in this case, right? Whereas if you notice company A, this 30% was organically made up of their net profit and asset turnover ratio, predominantly the net profit. Whereas company B, their ROE was significantly attributable to their leverage analysis, so leverage component. So any day I would prefer investing in company A than in company B, because look, when the market is good, when things are growing, leverage will work in my favor. One small recession, company B will be out of business. Clear with this, guys? Why? Sir, one small recession, now in that case, my losses will be magnified in company B. Whereas company A, sir, solid, they have 20% profitability, sir. Even there is a dip. Now, my dip in ROE will only be 1.5 times of the dip in my net profit. Are you guys clear with this? Hence, on the face value, return on equity for these two companies could be the same. But if you look at the composition of return on equity, now a company which is heavily dependent on your leverage, right, will definitely is a very, very risky company. In case of downward trends or recession, this company will definitely break. Are you guys clear with this? Hence, in this kind of scenario, I will definitely prefer company A than investing in company B. Or from the perspective of Tata Sons, TCS is better than Tata Motors, because Tata Motors is showing right now 30% return on equity, but they are heavily banking on the leverage for the purpose of achieving this particular return on equity. Whereas one small recession, the entire company is gone. So this is the kind of information that you can get by way of your particular DuPont analysis. Clear with this, guys? So though both the company can report same ROE, a company that is too much dependent on leverage will have to generally is going to be avoided. We should avoid such companies, or generally those kind of companies are not good because they are risky. Don't say, sir, risk means bad. No, it will work in your favor in case the company is going to grow, but it will definitely break you in case the profitability dips. Are you guys clear with this? So it is like a double-edged sword. This is what you'll be learning in your financial management. To the extent possible, I have given you guys a particular background in this area. Now, in this particular context, let's go and do one quick numerical problem. So please take question number 1. It's about DuPont analysis. An investor is interested to invest in any one of the two similar companies within the same industry. The investor wants to use the DuPont analysis method to compare each company's strengths and area of opportunities and help him decide which company is better. Okay, fine. The following financial information is given for A and B. Net income, revenue, average assets is given, right? The total assets or average assets, average equity is given. With the help of this, you need to compute the return on equity for this particular company. Now, please have this solved question bank with you. You can download this PDF of the solved question bank freely from our website. If you don't, if you already have a hard copy, great, nothing like it. I would always prefer you to have a hard copy because it's easy for you to refer and do the markings. If not, at least you can follow with the soft copy. Now, look at this. First, as per DuPont analysis, ROI is equal to what? Net profit ratio into asset turnover ratio into equity multiplier, right? Net profit ratio is net income divided by sales. Asset turnover ratio is sales divided by average assets, and equity multiplier is average assets divided by equity. Now, for company A, you guys tell me, for company A, how much is that going to be? So, overall, you have what? Net income is 2000, right? Divided by revenue is 8000. So, 2000 by 8000. And sales is how much? 8000. Divided by how much is my average assets? Average assets is 5000, right? And average assets 5000 divided by what's my average equity? 2000. Clear with this, guys? Or in other words, so it's going to be 2000 divided by 8000, 25%. 8000 by 5000, it's 1.6. And 5000 by 2000, it is 2.5. Or in other words, how much is the return on equity of company A? The company A's ROI is going to be 100%. Means what? Means what? So if I invest 100 rupees, every year's return itself will be 100 rupees. Clear with this, guys? Right? That is the meaning. How about company B? Similarly, you should solve. So net income was 2500 divided by revenue is 20,000 into The second one is revenue 20,000 divided by average assets comes out to 8,000 into average assets 8,000 divided by average equity. So it's going to be 1,000. So now tell me guys, how much is it? 2,500 by 20,000 comes out to 12.5%. 20,000 by 8,000 is 2.5 times and 8,000 by 1,000 is 8 times. So now in this case, company B, how much is the overall return on equity? So it's going to be 12.5 into 2.5 into 8, 250%. Means what? Sir, if you invest 100 rupees in the company, every year you will earn a return only of 250 rupees. This is the meaning of that. Now, between company A and company B, you guys tell me which company is better. Now, you will think, sir, company A is giving me a return on equity of 100. Company B has a ROE of 250. So, company B, sir, is better, right? But however, if you look at it, company A, organically through its net profit, it is earning 25% return, right? Whereas company B is only earning how much? 12.5% net profit ratio. But significant portion of their overall ROE is actually increased because of what? Because of their leverage. Because if you look at this, out of the 8,000 rupees, average assets is represented by the total capital employed. Out of 8,000, only 1,000 rupees they have taken from equity, which means the balance is 7,000 rupees they have taken from debt. Clear with this, guys? The company is a levered company. So because the use of debt, they have a leverage of 8 times. So whatever is the profitability and efficiency, because of that, whatever they've earned is getting magnified. Suppose one small recession happens. Now what happens if suppose if there is a recession, there is a decline in the profitability, the ROE will decline by 8 times of the decline in the profitability. This is a very risky company. So look at this, 12.5 into 2.5, if you do, in effect you get somewhere around 31.25%, right? Whereas if you multiply here 25 into 1.6, how much you get? 40% you get, purely attributable to what? Their organic way of, because of their net profit and because of their efficiency, they earn 40%, and because of the magnifying effect that the leverage gives, this gets magnified into 100. Whereas this company, what happens? 12.5 into 2.5, they get how much? 31.25%, but this gets magnified by 8 times because of the leverage. Clear with this, guys? Hence they are appearing to actually give you a more profitability or more return on equity. However, any day I would prefer company A. It has organically earned a profitability of 25%, whereas company B has earned only half of this, but still it's reporting a more ROE. It's purely because they are trading on equity. They are banking on the concept of leverage. Because of their leverage, this is not because of their effort, right? It is because of the funding pattern. It is actually magnifying their actually profitability. But one small decline, this company will actually run into huge amount of losses. Any day I will prefer company A over company B. Are you guys clear with this? Look at the analysis here. Look at the analysis here. Two-point analysis model allows the investor to see through the company B, see that although company B has a higher return on equity than A, a large portion on B's ROE results from the equity multiplier leverage. The investor can also see that a large portion of company A's ROE comes from its 25% of net profit margin, and because of this information, the investor should invest in company A and not in company B. Are you guys clear with this? So an excellent analysis is being done by DuPont, where they are saying don't look at the ROE figure as a whole, break it down into 3 components and find out which component contributes more to the return on equity. Based on that, you take a judgment call. A beautiful analysis is what we saw under return DuPont analysis. So please go and update your library of adjustments. Write down question number 1. Please write down DuPont analysis. DuPont analysis. And that's about the first question number 1. Now, guys, let's move on to the second segment of discussion, which is about divisional performance measurement tools. Now, under DPM tools, first, let's go and do a particular concept called residual income. Now, once again, this is the core of your financial management. Residual income is equal to operating income minus minimum rate of return into operating assets, right? Minimum rate of return is nothing but WACC, weighted average cost of capital. So what are all these terminologies? Quickly, I will brush up with the help of an example, and with the help of this, we will understand the concept of weighted average cost of capital and the concept of residual income also. Now guys, let us say overall I have raised 100 crore rupees of money. Out of this 100 crores, 20 crores I've raised from equity, 80 crores I've raised from debt, right? Now on this 20 crores, let us say the cost I incur, this is equity, the cost for this 20 crores, let us say, is 18%, dividend payable to the shareholders and all of that, all right? Let us say is 18%, right? This 18% is a cost incurred only on this 20 crores, correct? So this is actually a cost incurred for which source of finance? Equity. Hence I call it as cost of equity in financial management. That's how we call it as. So cost is represented by K, and E is E stands for your equity. So KE stands for cost of equity. Let us say on this 80 crores of funding through the debenture debt channel, the cost I incur is 12%. Clear with this, guys? So 12% is called as cost of debt, or also called as KD. Clear with this, guys? Now this 100 crore is the overall capital which I have raised. Now if someone is asking you, sir, you have raised 100 crore rupees, what is the cost of capital? Now what will you say? Now simple, on 20 crores you incur how much? 18% is the cost. On 80 crores, the cost is how much? 12%. So overall, you tell me, what is the total cost you incur? Sir, 20 crores into 18%. Plus, on 80 crores, I incur 12%. This is the total finance cost you will pay to the providers of finance for a total investment of how much? 100 crore rupees. Guys, are you all understanding this? Are you all understanding this? So, 20 into 0.18, how much is that? 3.6 crores. And 80 into 0.12, how much is that? 9.6 crores. So 3.6 plus 9.6, how much does it come out to? So 3.6 plus 9.6 comes out to, so 3.6 plus 9.6 comes out to 13.2 crores. So this comes out to 13.2 crores rupees. So every year I need to pay a cost of 13.2 crore rupees for a capital of how much? 100 rupees. So which means the overall cost of capital is going to be how much? 13.2%. Clear with this, guys? The weighted average cost of capital is how much? 13.2%. How did you get? So on 20 crores the cost is 18%. On 80 crores the cost is 12%. Add up everything and divide it by the overall amount raised. On an average I get, so the weighted average cost of capital is how much? 13.2%. So 13.2% is the cost for this overall. Sir, what is the cost? 100 crores. On this 100 crores the cost is 13.2%. Clear with this, guys? And there is a way of computing this. How do you compute? Just now I told you, right? 20 crores into 18% plus 80 crores into 12%, the whole divided by 100, right? Or you can also write it differently. Can I also say this is nothing but 18% into 20 by 100, guys, correct? Plus 12% into 80 by 100, guys, correct? So the same thing mathematically I can also rewrite it like this: 18% into 20 by 100 plus 12% into 80 by 100, right? So if you do it like this, what do you have? So 18% into 20 by 100, you get 3.6%. 12% into 80 by 100, you get 9.6%. You add the two, you get what? 13.2%. Clear with this, guys? Or in other words, what we say is the formula for computing weighted average cost of capital is the cost of equity into the weight of equity. Weight of equity means what? Sir, out of 100 crores, 20 crores comes from equity, which means 20 by 100, sir, 20% of the overall capital employed comes from my equity. Guys, clear with this? So literally what we say here is this is nothing but KE, and this we call it as WE. WE means what? Proportion, or the weight of debt, weight of equity in the capital structure. Clear with this, guys? So it's nothing but 20 upon 100. Similarly, what do we do here? So 12% is the cost of debt. Multiply this with the weight of debt. What is weight of debt? So out of 100, 80 comes from debt. Clear with this, guys? So 18. So how do you compute the overall cost of capital, sir? 18%, sir, is the cost only for the 20% of the overall finance. So 18 percentage into 0.2 plus, sir, 12 percentage is the cost only for 80 percentage of the total capital. So 12 into 0.8, overall you get the weighted average cost of capital. This is actually the correct way of calculating your weighted average cost of capital. Literally, I have right now taught you a formula which is ideally a part of your financial management. So they say weighted average cost of capital is KEWE plus KDWD. This is nothing but a logical formula written in a particular manner. As simple as that. Clear with this, guys? Perfect. Now, what they are saying, simple. What do you mean by operating income? EBIT, guys, correct? No? So what is EBIT? Basically, this is the amount that is available with me before paying all the sources of finance, guys, correct? Right. Now what they are saying, residual income means operating income, EBIT, minus the minimum rate of return, minimum required rate of return into operating assets. Or in other words, now guys, you tell me I have raised 100 crore rupees. On this 100 crores, what is my overall cost? 13.2 crores. Correct? Now, this on this 100 crores, the cost is 13.2 crores. That is 13.2 percentage into 100 crores. Correct? Now, what they are saying is, look, on every rupee raised, what was actually my cost? 13.2. So, now this 100 rupees I raised, I invested in the assets. Now these assets should give me a return. So the minimum, bare minimum, it should give me 13.2 percentage return. If not, it should give me more. Correct? No, because only then my return will exceed the cost. So what they say is, generally the cost of capital will also be, in some questions they will say, the minimum required rate of return. It's not the actual return. They will say minimum required rate of return is 13.2. Means what? You should understand the minimum required rate of return is equal to cost, because cost should be the minimum return that they should earn. So the minimum required rate of return is nothing but your weighted average cost of capital. Clear with this, guys? Now what we are trying to compute here, weighted average cost of capital into operating assets. How much is it coming out to? 13.2% into 100 crores. So overall it's going to be 13.2 crores. Clear with this, guys? Suppose, let us say the EBIT of this company is 15 crores. So they have earned 15 crores, right? Out of this, 13.2 crores is the cost pertaining to the providers of finance they need to pay. So how much extra they have earned over and above their cost of capital? It is 1.8 crores. I call this as residual income. The income which is left out, residue means left out, right, after paying all the providers of finance, is called as residual income. So what is the formula? Operating income minus weighted average cost of capital into operating assets. Operating assets is nothing but capital employed. Whatever amount I raise is what I invest in the assets. Clear with this, guys? And minimum required rate of return is nothing but weighted average cost of capital. Literally, guys, there is nothing that you need to mug up in this entire subject. There is not even a single thing that you need to mug up. Everything is so conceptual, right? You can just learn it beautifully. Clear with this, guys? So what is the formula for residual income? Operating income, that is EBIT, minus your cost of capital, overall cost of capital in absolute rupees. That is nothing but WACC into operating assets. Clear with this, guys? Now, there are multiple numerical problems in this regard, which we generally do it in our regular and exam oriented batches. In this marathon, I will take 1 or 2 representative sums and we will actually knock this area off. So please take question number 2 in your solved question bank. Right now, let us say sales is 4,80,000. The total cost of goods sold is 2,22,000. The gross profit is 2,58,000. Selling and admin overheads is 2,10,000. So the operating profit, EBIT, is how much? 48,000. Now, on Jan 1st, the net book value of operating assets is 2,77,000. On December 31st, the book value of operating assets is 3,23,000. The minimum rate of return is 12%. Means what? The weighted average cost of capital is 12%. Now, guys, first, what is the formula for calculating your residual income? Your EBIT minus your WACC into your capital employed or operating assets, right? Now, guys, basically, you should know in this format of balance sheet, if you see, you have equity plus debt. This is the total capital employed. Can I say this is nothing but fixed assets plus current assets minus current liabilities? So in your balance sheet, instead of adding this 2, If you say equity plus debt, your total capital employed, you can also arrive the same figure by saying it's nothing but equal to fixed asset plus current assets minus current liabilities. Guys, correct? In this question, they have given the value of operating assets. Net operating assets value has been given. But remember, they have given opening value, they have given closing value. Which value will you take? Take the average of the two. So what is the value of average operating assets? 2,77,000 plus 3,23,000 divided by 2. If you average out, you get a value of 3 lakh. So you take 3 lakh rupees is the average value of operating assets. That is nothing but your capital employed. So 3 lakhs into 12 percentage, how much is that going to be? 36,000 rupees is the amount that you need to pay to all the providers of finance put together, right? But how much is your EBIT? 48,000. So I have earned 48,000. Right, out of this I need to pay 38,000 to all the providers of finance, which means after paying them I am left out with how much residual income? 12,000 rupees. Are you guys clear with this? This is the concept of residual income. Now what do we do? Let us say your Tata Sons, for every particular subsidiary they will calculate the residual income. Higher the residual income, it is better for the the company. Why? Because obviously after paying all the providers of finance, if you're left with more money, that amount belongs to equity shareholders, and I am the Tata Sons is the predominant investor. They hold more than 51% stake in all the subsidiary companies. So significant portion of them belongs to whom? The the holding company, which is the Tata Sons in our example. Are you guys clear with this? So this is a very, very effective tool to evaluate the performance of their subsidiary companies or divisions. Clear with this, guys? And that's about this particular question. This is what I've done here as well. So please go and update your library of adjustments. Write down residual income. Question number 2, please write down residual income. That's about it. Please write down residual income. Now let's do one more sum. Please take question number 4. Please take question number 4. This is a common sum. This is a common sum for both residual income, ROI as well as residual income. We saw now in divisional performance measurement tools, DPM tools, we're seeing two concepts. One is ROI and the other one is the residual income. So we'll be seeing both of that here in this particular question. So question number 4, consider the following. Division A and Division B, operating assets, basically your capital employed is given. Operating income, basically your ROE, your EBIT is given. The return on investment division wise is given. Now, which is more successful division in terms of ROI? Now, based on ROI as a parameter, which division is better? How do you arrive as ROI? How do you arrive at ROI? ROI is nothing but return upon investment. Clear? So what is the return? EBIT divided by what is the total investment in the business? Operating assets. Clear with this, guys? So in other words, it's nothing but EBIT, operating income, divided by the total capital employed. You arrive at your ROI. Clear with this, guys? Now all this data, these two figures need not have been given. We ourselves could compute. So for 10 lakhs by 50 lakhs into 100, how much is it? 20%. Here 22,50,000 divided by 1 crore 25 lakhs. How much is that going to be into 100? 18%. We ourselves can compute this ROI. So looking at ROI, I would say division A is better than division B. Clear with this, guys? That's all, no? So division A is more successful as it earns a return of 0.2 for every rupee invested, or for every 100 rupee invested it generates 20 rupees, or every rupee invested it generates 0.2 of return, whereas division B earns only 18% return. Clear with this, guys? From an ROI perspective, division A is better than division B. Now let's compute what? Let's compute the residual income. Look what they have given. Using 16% as the minimum required rate of return. What is this? Weighted average cost of capital. Compute the residual income for each division, and which division is successful, right, from the perspective of residual income. Now 16%, right? So now what is the formula for calculating your residual income? The residual income is going to be what? It is going to be your operating income minus your weighted average cost of capital into operating assets or your capital employed. Now what is the operating income under both these particular alternatives? 10 lakh and 22 lakh 50,000. So write down 10 lakh 22.5 lakhs. right? Now, what is the minimum required income, or in other words, I can also say weighted average cost of capital into my operating assets. That is the amount that I'm going to pay to my providers of finance. How much is that? 20 percentage, sorry, here 16 percentage into 50 lakhs. So 50 lakhs is the amount that I would have raised raised as a capital. On that, the overall cost is 0.16. So 0.16, 16 percentage into 50 lakhs. What is the total cost? 8 lakh rupees. Here for division B, what is the total cost? 16 percentage into 1 crore 25 lakhs. So 125 lakhs into 0.16. How much is that? 20 lakh rupees, the minimum required rate of income, minimum required income, or in other words, that's the cost of capital in amount, right? So division A, it actually earned an EBIT of 10 lakhs, right? And your cost of capital, the cost that you need to pay to the providers of finance was 8 lakh. So which means the extra amount that you've earned is called as residual income, 2 lakh rupees. Whereas what happens with division B, it's going to be 22.5 lakhs minus 20 lakhs. It's going to be 2 lakh 50,000. So from the perspective of residual income, so which is better, division A or division B? Since division B reports a higher RI, residual income, I would say division B is better. Clear with this, guys? Now, from an ROI perspective, division A was better. From a residual income perspective, division B is better. That is the maximum you can rate. Sir, between the two methods, sir, which is better? There's nothing like that, right? But generally people prefer residual income, but based on a particular tool, you will say which division is better. That is the maximum you can write and leave in the particular question. Clear with this, guys, right? That's about it. So division B is more successful from the perspective of your residual income. Clear with this, guys, right? Please go and update your library of adjustments. Write down ROI and residual income. ROI and residual income. Please write down ROI and residual income. Clear with this, guys, right? So with this, we have finished the first two segments, DuPont analysis and DPM tools. In DPM tools, we have also revised the concept of ROI and residual income. Now, let's go on to the third segment called as economic value added, EVA. Now, economic value added, EVA. Now, segment 3, economic value added. Guys, this is a very similar, very similar concept as compared to residual income, but there is a small refinement we do, a small change, a correction we do, and a corrected version of residual income method is called as economic value added method. Sir, what is this, sir? What does this method say? Simple. EVA is equal to, economic value added is equal to NOPAT. NOPAT means what? Net operating profit after tax, right? Minus of weighted average cost of capital into capital employed. Sir, there also we did WACC into capital employed, fine. But in residual income, we took operating profit, EBIT, minus of WACC into capital employed, right? So after paying the providers of finance, how much is the extra amount I have with me? That is called as residual income. Yes, correct. Then what is this EVA, sir? What is this EVA? Now basically guys, there was one small mistake in the residual income that is being rectified under your EVA method, economic value added method. What is this? Now, recall the format of your income statement. From EBIT, operating income, you subtract interest, you arrive at EBT. From this, you subtract tax, you arrive at EAT. From this, you subtract your equity, or you subtract your preference shares or preference dividend or equity dividend, whatever it is. Finally, if you subtract all these things, after paying out to everyone, whatever you are still left out, that is basically, guys, here what they are saying, from this, you also subtract the minimum payment of the equity shareholders. That is, the equity shareholders will be having their own expectation of return. Let us say equity shareholders expect generally, sir, you should pay me 18%. Even you pay that, even after paying the minimum required rate of return of equity share capital, equity shareholders, even after that, if you're still left with some money, that is called as economic value added. To whom does this EVA belong to? Once again, to the equity shareholders only. Clear with this, guys? So ideally they are saying, after paying all the sources of finance, including the equity shareholders. Sir, how is it including equity shareholders? Equity shareholders also you pay their dividend or whatever amount they are expecting, right? after paying that, still if you have earned some more amount, that also belongs to the equity shareholders only. We call that as economic value added. So this is what even RI, residual income method, calculated. No, sir. What are we calculating separately here? Now, if you notice, guys, out of all these payments, interest payments is paid to a provider of finance. Yes, whom? The debenture holders, or to the people who have lent me money by way of borrowings, loans and other things. Cost of equity, this is paid to the equity shareholders, correct? Yes. Now, in between, I also have a tax payment. Why do I make this tax payment? To whom do I make this tax payment? To the government. Now, you guys tell me, the tax amount, is it paid to the government because government has invested in my company? They have provided me capital? No. This tax amount is ideally an outflow for me, but it is paid not to a provider of finance. Guys, agreeing with me on this? Agreeing with me on this? Or in other words, technically speaking, the amount, net amount available with me before paying the providers of finance is operating income minus my taxes. Agreeing with me? Because EBIT I have. From this, I should reduce the taxes, and only that net operating profit after tax is the amount available with me before paying my providers of finance. Agreeing with me on this? Whereas in residual income, we ignored this completely. So we assume that the entire EBIT is available with me right before paying the providers of finance. But remember, ideally, the tax payment is there, which is not paid to a provider of finance, it is paid to the government. Hence, what we do, let us say tax rate is 30%, right? So which means if you have to pay 30% to the government, the balance 70% of your operating profit is only available for you. Guys, clear with this? So what we do is net operating profit after tax. This is the net amount available to me before even paying my providers of finance. It's nothing but EBIT into 1 minus T. T stands for tax rate. Let us say I've earned 100 crores. EBIT is 100 crores. So out of this 30% I need to pay to the government by way of taxes, which means the balance 70% is only my amount available. Clear with this, guys? So 70% of my EBIT is 70 crores. This is the funds which I have. This is the net earnings, net operating profit after tax, which is available with me, guys. Clear with this, guys? From this, I will subtract the total cost that is payable to all the providers of finance. So after that, let us say the total cost payable to all the providers of finance is 65 crores. All right. So now my net profit after tax was 70 crores. So which means I've earned 70 even after paying the taxes. This is the amount available before paying all the providers of finance. But to all the providers of finance, I only need to pay how much? 65 crores, which means I still have 5 crore rupees. This is the net economic value addition that the equity shareholders can enjoy. Are you guys clear with this? This is exactly the same as your residual income, but there's only one change. In residual income, here we consider EBIT itself. But in EVA, what we do is, look, EBIT is not available for me. The net amount available is only EBIT into 1 minus tax, because tax is paid not to a provider of finance. So please adjust that also. The net amount is only available for you. From that, you subtract the cost that you need to pay to all the providers of finance. The net amount is called as economic value added. Clear with this, guys? That's all is the concept of EVA. See just how simply we can revise this entire chapter, right? On that note, let me just take one numerical problem. Please take question number 18 in your solved question bank. All sums we have actually done. Here I'm only taking some representative problems, right? So question number 18. Fine, guys. Before that, one more thing I want to tell you. Now, for the purpose of this particular segment, there are a few formulas in your financial management that you need to know, right? So basically, EVA is what? Net operating profit minus tax, NOPAT, right? Minus WACC into cost of WACC into capital employed. NOPAT is EBIT into 1 minus T, right? WACC. How do you arrive at WACC? We saw cost of equity into weight of equity plus cost of debt into weight of debt, right? Now, how do you arrive at cost of equity? How do you arrive at cost of debt? All these things are ideally a subject matter of discussion in your financial management, right? You have multiple variants, but anyways, to a limited extent, first I will list out. There are some formulas in financial management which you need to know, right, in this EVA problems. Number one, first, cost of debt. The formula for calculating KD is interest rate into 1 minus tax. Sir, why sir? Now guys, let us say I have raised 100 crore rupees of debentures, right? And the interest rate is 10 percentage. Now let us say I have earned 100 crore rupees of EBIT. From this I will subtract interest of how much? 10 percentage on 100 crores of that I've borrowed, 10 rupees, 10 crores. So the net EBT is how much? 90 crores, correct? On this EBT, let us say I have to apply a tax of 30 percentage. So on this 90 crores, I apply 30 percentage tax. How much does it come out to? 27 crores. Now guys, if you notice here, now what was my EBIT? It was 100 crores. From this I subtracted interest 10 crores. I got EBT. From this I subtract my taxes, correct? Now tax is applied on what? EBT. Now EBT, how do you arrive at it? EBIT minus interest. Now guys, literally because I had this interest payment of 10 crores, it got subtracted and the base on which I compute the tax is only 90 crores right now. Agreeing with me on this? Or in other words, had I not had this interest amount, I would have had to pay an income tax of 30 percentage on this entire 100 crores. Guys, correct? Because there is no deduction allowed. Since income tax is a tax deductible expense, right? Literally on this 10 crores, I do not end up paying any tax. Agreeing with me on this? Or in other words, now on this 10 crores into 30 percentage tax rate, literally 3 crore rupees is the amount of tax I am able to save because I am paying an interest of 10 crore rupees. Agreeing with me on this? Yes? Now, or in other words, the net cost of interest, can I say, it is nothing but 10 crores of interest payment minus on this 10 crores, there is a tax saving parallelly. So literally the net cost is only 10 minus 10 into 30 percentage. Clear with this, guys? Or in other words, you take 10 out in common, 10 the whole into 1 minus 0.3, that is nothing but interest rate into 1 minus tax. Or in other words, guys, literally, though you incur a cost of 10 percentage, on this, there is a parallel tax saving. So the post-tax cost of debt is only, in this case, 7%. Are you all able to understand? More details about this is a subject matter of discussion in your financial management. Right now, suppose in the question they have not given you the cost of debt, right? If you want to calculate, they have given interest rate. The formula you need to use is interest rate into 1 minus tax rate. Clear with this, guys? Fine. The next one, cost of equity. Now, KE. There are multiple formulas to calculate KE, right? Which is a subject matter of discussion in your financial management. One of the formulas popularly used in this chapter in your study material is a formula using an approach called as CAPM. What do you mean by CAPM? Capital Asset Pricing Model. Now, what does this model say? KE is equal to RF plus beta times RM minus RF. What is the meaning of this? RF stands for risk-free rate of return. RM stands for the rate of return which the market provides me. And beta is a measure of risk. Now, sir, basically, what is this, sir? Now, you have money. You want to invest it somewhere. Now, there are two options. Option number one, you can invest it in FD. That FD will give you 10% guaranteed risk-free rate of return. Option number two, you can go to the market and invest, right? Generally, market gives you, let us say, 15% rate of return. Now, let us say you have identified one company, ITC Limited. This particular company has a beta. Beta is a measure of risk. What is beta and all is a very technical discussion in your CMA final strategic financial management. There will be seeing later on. Right now, you just understand it's a measure of risk. 2 times. Now, basically, what is the meaning of this? RF stands for risk-free rate of return. In our example, FD return. RM is a measure of, stands for the return which the market gives you. Generally, if you go to the market, share market, your return is going to be 15%. RM minus RF represents market risk premium. What do you mean by that? Sir, RM minus RF is what in our example 15 minus 10 percentage 5 percentage means what? Now market is risky, I know. Because I go to the market for taking this risk, what is the extra premium I'm going to earn? Or in other words, the premium you will earn in the market for the risk you take is called as market risk premium. How much is it? Sir, if I go to the share market, generally I should get 5% more than my risk-free rate of return. Clear with this, guys? But now I have spotted a company which is 2 times riskier. So which means I should definitely earn 2 times of this extra 5%. Clear with this, guys? Or in other words, how much is the cost of equity? Cost of equity is nothing but expectation of return from the perspective of equity shareholders. Why and all? You'll be seeing it in your financial management. Now, basically, the cost of equity is definitely I should earn RF, FD rate of interest, 10%. Plus, I will also now expect 2 times of the market risk premium. So 2 times of this extra 5% I will also want. So now the cost of equity for this company will be 20%. Are you guys clear with this? Don't mug up, logically answer. So KE is equal to RF, risk-free rate of return, plus beta times RM minus RF. This is the logic for this, right? Beyond this, the subject matter of discussion is in your financial management. Next one. Weighted average cost of capital, you know the formula, KEWE, cost of equity into weight of equity, plus KDWD, cost of debt into weight of debt. We just did quite some time now. And financial leverage, there is a formula, once again a subject matter of discussion in your financial management. Every single thing is logical. In financial management, trust me, it's a beauty. Every single formula is actually logical. Mugging up a formula in subjects like cost accounting, management accounting, financial management is a crime. You should never mug up all these formulas, right? Generally, I take financial management for CA intermediate, right? For CMA intermediate, I've not taken. But trust me, a lot of chapters are the same here, right? And this formula is also 100% logical. It can be derived on the spot, right? But for the purpose of this management accounting marathon, quickly, let's accept this. Financial leverage is equal to EBIT divided by EBT. Why, sir? The logic and all ideally is a subject matter of discussion in your financial management. Please accept this. Or EBIT divided by EBT is nothing but EBIT minus interest. You can rewrite it as EBIT divided by EBIT minus interest. Sir, how do I remember? I will tell you. Recall the income statement. EBIT minus interest is equal to EBT. Right? Now visualize this like a burger. Right? On the burger, what do you have? Top side you have a bun. Bottom also you have a bun. In between you have all this patty or vegetables, right? So financial leverage is the top bun divided by bottom bun. That's about it. Your EBIT divided by EBT. Clear with this, guys? You just remember it like this. But trust me, this should not be mugged up. Ideally speaking, in your financial management, you should have learned this conceptually because this is a conceptual area. Clear with this, guys? Fine. Now, let's move on with these things in background. Let's move on to question number 18. All right, let's go on to question number 18 and solve this question. Prosperous Bank has a certain criterion that it will give loans to companies that have an economic value added EVA greater than 0 in the past 3 years on an average. The bank is considering lending amount money to a small company that has an EVA characteristic shown below. The data relating to the companies as follows. Average operating income after tax equals to 25 lakhs per year, which means no PAT is given. Net operating profit after tax is how much? 25 lakhs per year in each of the last 3 years. Perfect. Next. Average total assets over the last 3 years is how much? 75 lakhs. Capital employed is also available. Next. The weighted average, oh, this is not, sorry guys, this is not capital employed, this is the total assets, be careful. The weighted average cost of capital appropriate for the company is going to be 10%, which is applicable for all the 3 years. Perfect. Then, the company's average current liabilities over the last 3 years, right, are 15 lakh rupees. Does the company meet the bank's criterion of having a positive EVA? Simple, calculate EVA. If the company has a positive EVA, the bank will give loan. If not, the bank will not give loan. How do you compute your EVA? Simple, net profit, net operating profit, no PAT, minus WACC into capital employed, right? No PAT is available, yes sir, 25 lakhs. WACC is available in this question. You need not compute all KE, KD and all. No need. They themselves have given it's 10%. Perfect. What's my capital employed? Be careful. Total assets was how much? 75 lakhs. Current liabilities how much? 15 lakhs. Now, how will you arrive at the capital employed? Guys, be very, very, very clear. Capital employed. How will you arrive at it? Now, in your balance sheet, now literally capital employed, basically nothing but equity plus debt is nothing but fixed assets plus current assets minus current liabilities. Correct? In this question they have given total assets is 75 lakhs, means the total of this is 75 lakhs. Current liability is 15 lakhs, which means this is 15 lakhs. So literally what should you do? 75 lakhs minus this figure 15 lakhs net of 60 lakh rupees is your capital employed. Clear with this, guys? You should compute the capital employed. So on the 60 lakhs, what is the cost of capital? 10%. So 10% of 60 lakhs is 6 lakh rupees. So 6 lakh rupees the amount that I need to pay to my providers of finance. All the providers of finance put together. But how much is the net operating profit after tax? Sir, EBIT after paying the taxes that I have with me is how much? 25 lakhs. Simple, guys. So from my 25 lakhs, reduce 6 lakhs. How much is the EVA I have? I have 19 lakh rupees more profit even after paying all the sources of finance. Clear with this, guys? So obviously I have a positive EVA of 19 lakh rupees. Will the bank give me the loan? Absolutely, they'll be more than happy to give me the loan. Clear with this, guys? EVA is greater than 0, therefore the company qualifies with the loan. So how do you arrive at the cost of capital employed? Simple. Total assets is 75 lakhs. So from that subtract your current liabilities. Total assets minus current liabilities gives me my capital employed. Visualize this, don't mug up. So you get 60 lakhs on this, apply 10%, 6 lakh rupees the cost of capital. As simple as that, guys. That's about it. That's about it. Very, very simple. So this is a logical understanding which you need to have in this particular chapter. Clear with this, guys? So that was question number 18. Am I right? Yes, so question number 18. I think we've done this question number 18. So it was something that I did as well during the course of the lectures, but anyways, now we have clearly seen this in detail, and that's about the concept of EVA, guys. Right now, in some questions what they would have done, they would not have given you the WACC directly, rather they would have given you the components for computing K, that is RF, beta, RM and all these things. They would have given you the components for computing KD, that is interest into 1 minus tax rate. You should compute all that, multiply with the respective weights, arrive at the cost of capital. That incrementally alone, there are some variants of question which we generally solve in a regular batch, but here in this marathon I wanted to cover that also in terms of the formulas. In terms of the formulas, I want to cover that also. So when we are revising this chapter, we should know that even certain formulas from FM needs to be revised here. Clear with this, guys? That's why I presented all these formula here once again, and I explained the logic also while solving the sum. Make sure that you are also revising this particular formulas, right? Whatever we saw here, CAPM formula of KE and your KD formula here, WACC formula we already saw, and financial leverage is also required in some questions, right? If you have these 4 formulas of FM, this chapter is sorted for you. Clear with this, guys? So with this, we have finished this particular question. Please go and update your library of adjustments. Write down question number 18, give all the cross-referencing, write down EVA hyphen calculation of cost of capital employed. We had to calculate the 6 lakh rupees, cost of capital employed and economic value added, EVA. Write down calculation of cost of capital employed and economic value added, EVA. Fine, guys? Yes. So this, let's move on to the next segment of this particular chapter called as learning curve. Learning curve analysis. This is the next segment 4 of this particular chapter. Literally speaking, the last segment of this chapter. Of course, we also have this balance scorecard, but that's only a theoretical aspect of this particular chapter. Now, what does this concept of learning curve signify? This is not relating to financial management, right? So this is core of your management accounting. Now, let us say, guys, To produce 1 unit, a worker will take 2 labor hours. Now, if I'm going to produce a total of 1000 units, so what is going to be the total labor hours that I will be taking? 1000 into 2, 2000 labor hours. This is how we do it. Yes. But in real life, this will not be the case. Why, sir? No. Because as you start becoming more experienced on the same task, now obviously the time that you will be taking on the subsequent units will definitely reduce. So it will not be exactly 1000 units into 2, it will definitely be a little lesser. Now let me take an example. Let us take an example of students, you people. Now let us say I explain a particular concept and I am doing the sum along with you. For the first time when you're doing the sum, maybe to do the same sum, you will be taking 1 hour. Now the second time when you're doing the sum independently, maybe the same sum you will be able to finish this in 45 minutes. Now you would have identified a few mistakes. Now the third time if you do it, the same sum you can finish it off in just 35 minutes. And let us say the day before your exam you want to solve this question, this big question, maybe you can finish it off in just about 25 minutes. Or in other words, over a point of time, right, as you keep on doing a repetitive task, there will be a learning curve effect which will reduce the average time taken per unit. This is the study of learning curve analysis, right, which is depicted in a graphical format. What they are saying, on the x-axis you have number of units, on the y-axis you have average time per unit. Now as you keep on producing more number of units, the time taken per unit will actually reduce. Clear with this, guys? Right? Now let us say the first unit will take 2 hours. The second unit maybe will take 1.9 hours, because now he has produced the first unit, he has gained experience out of that. And maybe the next subsequent units, slightly per unit level, there will be a reduction in the time taken. Clear with this, guys? That gets captured in your learning curve analysis. Clear with this, guys? Now there is something called as learning curve rate, LC rate. It will be given in the question. It is generally above 50%, less than 100%. Now with this LC rate, learning curve rate and all, sir, what can we conclude? What can we conclude is what we are going to see here in this discussion. Now let me take an example, right? Now let me take an example. In this example, I'm listing out a particular columns template, units, right? Cumulative average time per unit. Call this as CAT2, cumulative average time per unit. Then here we have the total time. What is it, sir? Let us say, guys, the first unit, I'm producing 1 unit. Let us say to produce 1 unit, it takes a total of 100 hours. Now, in this question, let us say the learning curve rate is 80%, which means the workers are learning at the rate of 80%. Now, what is this? Now, the concept of learning curve says that, now, suppose if you double your production as compared to the previous level. Now, if you're going to produce 2 units, the cumulative average time taken per unit, or in other words, the average time taken per unit is going to be the learning curve rate into the average time per unit of the previous level, or in other words, 100 hours into 80%, which comes out to 80 hours. So which means 80 hours the total time taken? No. Please understand, 80 hours is the average time taken if you produce 2 units, which means how much the total time taken? 80 into 2. The total time for producing all 2 units put together is 160 hours. Are you guys clear with this? No, sir, which means, sir, every unit 1 and 2 took only 160 by 2, 80 hours. No, that's the average time taken per unit. Literally, the first unit has taken 100 hours. Incrementally, the second unit has taken 60 hours. Averaged out, 2 units put together has taken you how much? 80 hours. Clear with this, guys? So this is what your learning curve concepts explain. So what do they say? Now, first unit takes 100 hours. If you double the production, the average time per unit is going to be the learning curve rate into the average time per unit of the previous level. Clear with this, guys? Now let's go and proceed forward. Suppose if I double the production further, so 2 into 2, I'm making 4 units. Now what will be the cumulative average time per unit? 80 percentage into 80, how much is that? 64 hours. Clear with this, guys? So on an average, the time taken for 4 units put together is how much? 64 hours. Clear with this, guys? Or the total time taken is 64 into 4, it's going to be 256 hours. Right? Now further, if you double the production, sir, 4 into 2, 8 units. Now what is going to be the cumulative average time per unit? So 80 percentage into 64, how much is that? So 64 into 0.8, it's going to be 51.2 hours. So that is the total time? No, this is the average time taken per unit if I produce 8 units, right? So 8 into this one, so it's going to be how much? 409.6 units, the total time taken for 8 units. Further, if you double the production into 2, so 16 units, so what will be the cumulative average time per unit? It's going to be 51.2 into 80 percentage. How much is that? 51.2 into 0.8, you get 40.96 and so on. Clear with this, guys? Now, this is what the concept of learning curve effect says. And guys, this whatever we saw here is called doublings. The concept of doublings is actually the basis for your learning curve analysis. What they are saying, if you double your production, the average cumulative average time taken per unit is going to be learning curve rate 80 percentage into the cumulative average time per unit of the previous level. Why, sir? This is what the concept of doublings in your learning curve effect says. Clear with this, guys? So suppose I'm going to produce 4 units, sir, or 8 units, sir. What is going to be the total time? First you compute the cumulative average time per unit by doubling it. Now you get the cumulative average time per unit. So 51.2, sir, 51.2 into 8, how much is that? 409.6 hours the total time taken, sir. So 409.6 hours the total time required to produce 8 units. Clear with this, guys? So for 16 units, once again compute the doublings, arrive at the cumulative average time per unit for 16 units, right? Multiply that, so you will arrive at the total time required for 16 units. So for 8 units, the time is not, sir, 1 unit, first unit takes 100 hours, 8 units is 8 into 100. That is what we have been doing till now, but we have completely ignored the concept of learning curve effect. But in reality, workers can be having a more experience. Once they get more experience, the time taken per unit reduces. So literally in this case, for 8 units, right, he's only going to take a total of 409.6 hours. Are you guys clear with this? So in this case, the learning curve analysis says that as you double your production, right, your cumulative average time per unit is going to be, so the learning curve rate into the cumulative average time per unit, CAT2 of the previous level. Clear with this, guys? So based on that, you arrive at the CAT2 of the respective of that particular output level, multiply that with the output, you will arrive at the total time taken. Clear with this, guys? Now you might be having a doubt, sir, in this concept of doublings, right, I will only have, if my volume is 1 unit or 2 or 4, 8, 16, 32, 64, 128, like this, if my volume lies in one of these volume levels, that is in the doubling levels, only then I can calculate cumulative average time per unit. Suppose, let us say for example, if my total volume is going to be 15 units, sir. So what is going to be the total time taken for 15 units? First I should compute the CAT2, cumulative average time per unit, and if I multiply that with 15, I will arrive at the total time taken for 15 units. Now, sir, how can I arrive at the cumulative average time per unit, CAT2, for the units that are not lying in this doubling levels? Doubling is what? 1 into 2 is 2, into 2 is 4, into 2 is 8, into 2 is 16, into 2 is 32, into 2 is 64, 128, 256, 512, and so on. Now, sir, in between, I could be having any volume level, sir. For each of these volume levels, how can I find the cumulative average time per unit? How can I make use of the learning curve effect? Now, in this case, you can't use this tabular format. You need to use a formula approach. What is this formula approach? Y is equal to A into X to the power B. Clear with this, guys, right? Where Y stands for the cumulative average time per unit for X number of units. Let us say 50 units, sir. So Y is equal to, so calculation of cumulative average time, CAT2 for X number of units. A stands for the time required for the first unit. In our example, the first unit was 100, right? Let us say I want to calculate right? The total the cat poo for 15 units. So what will I do? So A, that is 100 into x the number of units for which I want to compute, 15 to the power B. What do you mean by B? Log of LC rate, log of learning curve rate, which is log 0.8. In our example, it is 0.8. 80% is 0.8 divided by log 2. Sir, why 2, sir? Because doublings is there. So divided by log 2. Clear with this, guys, right? So then log tables and all needs to be used. Don't worry, generally the values will be given in the question. Log of 0.8, how much is it they will give? Log 2, how much is it they will give you? Clear with this, guys. Do not worry about that. Do not worry about it. Generally they will give you the tables, right? Now in this case, what you need to do, sir, which means the cat poo for 15 units is going to be equal to how much, sir? 100 A, that is a time taken for first unit, into x, which is 15 units to the power B, where B stands for log of 0.8 by log 2. Generally the values will be given. Clear with this, guys? You can just substitute the values and arrive. Then you will arrive at what? Cat poo only will arrive. Multiply that with the number of units. In our case 15, you will get the total time taken for 15 units. Clear with this, guys? So if it falls in your doubling levels, yes, you can directly use the doubling tables. If it doesn't fall in your doubling levels, then you can use the formula approach and do it. For you to use the formula approach, what is the formula? Cat poo for x number of units, that is y is equal to A into x to the power B, where A stands for your time required for the first unit, x stands for the number of units for which you are computing your cat poo, and B stands for log of learning curve rate divided by log 2. Clear with this, guys? If you know this, any kind of questions you can easily approach in this particular area, right? There are only, I think, 3 or 4 sums given in our institute study material. Anyways, right, in our courses and all, we have done it fully. Now I will take one representative sum for the purpose of this marathon so that we can revise this area also. We are not leaving a single thing in this marathon as well. I want to give you guys a comprehensive coverage. So please take question number 19. Yes, let's take question number 19. Yes, guys. Now the learning curve is a management accounting, as a management accounting has now become or going to become an accepted tool in the industry for its applications are almost unlimited. When it's used correctly, it can lead to increase in business and higher profits. When used without proper knowledge, can lead to lost business, bankruptcy. Illustrate the use of learning curves for calculating the expected average unit cost of making 4 machines, option A, option B, 8 machines, using the data below. So they are asking you to calculate the total cost or expected average unit cost of. So what is the average cost of manufacturing 4 units? Let us say the company is in the business of manufacturing machines. What is the cost of manufacturing? Average cost of manufacturing 4 units. What is the average cost of manufacturing 8 units? Is what they've asked. And what is the units given below? The data given below. Data given is direct labor needed to make the first machine is 1000 units, 1000 hours. Learning curve rate is 90%. The direct labor cost is 15 rupees per hour. The direct material cost is 1,50,000. Fixed cost for either size orders, fixed cost is going to be 60,000 rupees. Clear with this, guys? Now, what do we need to do? We need to arrive at what? The average, the average cost per unit for under each of these two alternatives. This is what we actually need to find out. Clear with this, guys? Let's do this. First one. Now, what have they asked? Sir, what will be the average unit cost for producing 4 units, for manufacturing 4 units? And what is the average unit cost for manufacturing 8 minutes? Unit cost will have what? Material, labor, as well as whatever is the fixed cost given. That will also be unitized. Clear with this, guys? Now, they've asked us to calculate what? The per unit cost. Simple. If I manufacture 1 unit, what is the average time taken for the first unit? 1000 hours. Now, if I double my production, 2 units. Now, what is the cat poo? 90% of the previous level. So, 90% of 1000 is going to be 900. If I double the production further, 4 units I am manufacturing. What is the cat poo? Cumulative average time per unit? It's 90% of 900. So, 900 to 0.9 is going to be how much? 810. If I further double my production to 8 units, so what is going to be my cumulative average time per unit? It's going to be into 0.9 further. You get 729 hours. Clear with this, guys? Which means how much is going to be the labor cost per unit? Sir, if I produce 1 unit, on an average, the labor hours I take per unit is how much? 1000. and every hour of labor I need to pay 15 rupees. 15 into 1000, 15,000. If you produce 2 units, per unit average labor time taken is only 900. So 900 into 15, 13,500 rupees is going to be the average labor cost per unit. Are you guys clear with this? Now, if you produce 4 units, the cumulative average time taken for every unit is only going to be 810 hours. On an average, you are going to take only 810 hours. 810 into 15. So how much is that? So that's going to be 12,150. And suppose you're going to produce 8 units, sir. So average time taken per unit is only 729. So 729 into 15, you only get average labor cost per unit is going to be how much? 10,935. Clear with this, guys? They only asked for the cost per unit, right? Had they asked for the total cost, CAT2 you should multiply with the respective number of units, arrive at the total time. From there you will multiply what? 15 rupees. If they only asked for the average cost per unit, first we calculated the average labor cost per unit. Fine. What is the material cost? So direct material cost is 1,50,000 rupees per unit. So automatically it's 1,50,000 rupees per unit. So whether I produce 1 unit, 2 unit, 4 unit or 8 unit, on a per unit level, material cost continues to be how much? 1,50,000, because variable costs will not change on a per unit level. Clear with this, guys? Now, how about your fixed cost? Sir, fixed cost totally is 60,000 rupees. Whether I produce 1 unit or I produce 8 units, fixed cost continues to be 60,000 rupees. So what is the average fixed cost per unit? 60,000 by 1. Here it's going to be 60,000 rupees. 60,000 by 2. Here per unit fixed cost is 30,000 units. 60,000 by 4. It's going to be 15,000 per unit. 60,000 by 8. Here it's going to be 7,500 rupees per unit. So now what you need to do, so the total cost per unit, average unit cost per unit, if I produce 1 unit, the average cost per unit is how much? 15,000 plus 1,50,000 plus 60,000. How much is that going to be? 2,25,000. If I produce 2 units, what is the cost? 13,500 plus 1,50,000 plus 30,000. You get how much? 1,93,500. If I produce 4 units, what is the total average cost per unit? 12,150 plus 1,50,000 plus 15. How much is that? 12,150 plus 150,000 plus 15,000 gives me how much? 1,77,150. If I produce 8 units, it's going to be 10,935 plus 1,50,000 plus 7,500. I get 1,68,435. So the answer is, if you produce 4 units, the average cost per unit is going to be, total average cost per unit is 177,150. If you produce 8 units, the average cost per unit is 1,68,435. Now for this, to compute the labor cost, ideally we had to use the concept of your learning curve, wherein we saw as the production doubles, the cumulative average time per unit is 90% of the previous level. Clear with this, guys? So since in this question they had asked us to calculate the cost for 4 units and 8 units, both 4 and 8 falls in the doubling levels itself. We need not use the formula. We directly computed using what? The direct, the statement approach. Had they asked for, let us say, 7 units or 10 units or any different units, now how you should have done? You should have used the formula, that is y is equal to a into x to the power b. Using that formula you should have done. Clear with this, guys? Just a formula substitution you need to do. Clear with this, guys? And that is the concept of learning curve analysis. So please just go and update your library of adjustments. Write down. Question number 19, please give the cross-referencing. Write down learning curve analysis. Please write down learning curve analysis. Right? So that's about this particular concept of learning curve analysis as well. Now with this, we have finished all the core concepts of this chapter. DuPont analysis, your ROI and residual income, which is coming under your DPM tools. Your EVA we have completed. We've also completed learning curve. Now there is one small concept called balance scorecard. Quickly, let us just revise that as well. And with that, we'll be finishing the revision of this particular chapter. Now, another divisional performance measure or a tool is called as balance scorecard. Now, what is this, sir? Basically, guys, to analyze and review the performance of every division, something called as a balanced scorecard is prepared. Now, in this scorecard, what they do, now, this scorecard is classified into 4 perspectives: customer perspective, internal perspective, innovation and learning perspective, and financial perspective. There are 4 perspectives in which, right, this scorecard is prepared for every division. Now for every division, from a customer perspective, the following questions are asked. What does this division do, right, for the existing and the new customers, that the customers feel that it is a value addition for them? Or in other words, from the perspective of customer, right, what do the existing and the new customers value from us, right? These are all collated under the first perspective here. It's purely theoretical in nature. Ideally, this is a part of your strategic management. Yeah, you have a paper strategic management. This is a part of your strategic management, right? The explanation. So why do we do this? This gives rise to targets that matter to the customers: cost, quality, delivery, inspection, handling, so on, right? So from this perspective, you analyze the performance of a company, of a division, from the perspective of customers. From an internal perspective, what processes must we excel at to achieve our financial and customer objective? This particular perspective is meant predominantly towards improvising their internal processes and decision making. For this purpose, how does this particular division, from this perspective, internal perspective, how is this particular division performing? They will categorize. Next, innovation and learning perspective, research and development. Which division is very good at innovation and learning, or division wise they do this categorization? And finally, from a financial perspective, how do we create value for our shareholders? So financial metrics are like return on investment, the other things we have seen, ROI, residual income, EVA, right? These are all some metrics which we will be using. Even your DuPont analysis, using these metrics for every division we categorize and we find out which division is performing well. Or in other words, the actual performance of every division is categorized into 4 perspectives: customer perspective, internal perspective, innovation and learning perspective, financial perspective. From each perspective, how a division is performing is being found out, and based on that, they take a proper corrective action for this particular division. This is purely a theoretical area, right? And this is what we call as balanced scorecard. Clear with this, guys? That's about this, a very, very small area, but it's more to do with your strategic management subject. Clear with this, guys? So this is also used as yet another tool to analyze and measure the performance of every division of a company. Clear with this, guys? Right? So literally, guys, with this entire chapter of divisional performance measurement is being revised right now. We finished DuPont analysis, we finished the DPM tools, which is ROI, residual income, we have done economic value added, then learning curve analysis and balance scorecard. Literally, I think we have solved about 5-6 questions in this particular marathon itself. Apart from that, I have also given some few illustrations right here and there. We have just done a few illustrations. Clear with this, guys? Right? For the marathon purpose, trust me, we have literally done all the concepts of this chapter with representative sums, right? Because this is not like a detailed batch where every single question we can be solving. In our detailed batch, we solve every single question. But here, for the purpose of this marathon, right, literally we have covered all the major aspects of this chapter, and we have revised it effectively in a span of about 1.5 hours. And this chapter definitely gets tested, right? Every single attempt, at least 2 7-mark questions generally gets tested from this particular chapter. Clear with this, guys? With this, we have finished the revision of divisional performance measurement. So now let's move on to the next one. So now let's get started with the revision of one of the most important chapters called marginal costing, right? So now, before I get started with the revision of this particular chapter, there are a few things which I want to clearly mention before we start into this particular chapter. Number 1, now this is a common chapter, exactly the same chapter, marginal costing. The concepts are all exactly the same in your CA Inter Cost and Management Accounting paper number 4. And in your CMA intermediate, there are 2 papers, paper 8 cost accounting and in paper 12 management accounting. Now this chapter, marginal costing, whatever we are going to learn in this chapter exactly is applicable in your CA Inter costing and in CMA intermediate paper 8 as well as in paper 12, whatever we are going to study. So this is a common marathon, right, or a revision video of this chapter, marginal costing, for both your CA as well as your CMA intermediate courses. But let me tell you one very, very important thing. Now, when it comes to all the paid courses, be it your exam oriented batch or your regular batch, now I have done separate recordings for CA Intermediate, separate recordings for CMA Intermediate. Even there, for paper 8, I have done it separately. Paper 12, I have done it separately. I'm talking about the paid courses, be it exam oriented or your regular batch, right? So I have done separately. This entire chapter has been done separately 3 times. Though the learning objectives, the concepts are all exactly the same. Now, this has been done strictly based on the respective institute study materials as well as the past exam questions and all of that. But when it comes to a marathon, for the purpose of marathon alone, I'm combining it so that the same marathon or a revision video will be useful across all the students. For all the students, they can use the same marathon purpose. So for marathon purpose alone, I am doing this particular chapter in a combined manner. Now guys, if you notice, I have listed out all the concepts which are applicable in this particular chapter. Your income statement, profit volume ratio, break-even point, margin of safety, profit, cash break-even point, indifference point, volume analysis, sales mix, sensitivity analysis, limiting factor analysis, shutdown point, marginal costing versus absorption costing. These are all applicable for all the 3 subjects, that is one paper in your CA intermediate and both paper 8 and paper 12 in your CMA intermediate. This last concept, number 14, accept or reject of a special order. This alone is applicable for CMA intermediate paper 8 students alone. So I am pushing this to the end so that in case you are a CMA intermediate paper 8 student, you can watch this, else this part alone you can skip it, right? So clearly I have bifurcated in such a way that this is applicable for all the students. Exactly the same concepts are applicable for all the students, right guys? Fine. Now one more thing I want to clarify with respect to the books, right? We have a concept decoder book and a solved question bank, as you guys know. Now for CA intermediate costing, we have a separate concept decoder solved question bank. For CMA intermediate paper 8, we have a separate concept decoder solved question bank, and paper 12 we have a separate concept decoder solved question bank. Every single thing is separate. Paid courses, your books, everything is separate. Marathon purpose alone I'm combining for the benefit of all the students, so that because the concept is going to be the same, right? We will be covering, and in this marathon itself I will be covering a few sums from your CA, few sums from your CMA. Now do not think that, sir, then you are mixing the two, so CA students need not work out CMA questions, CMA students need not work out CA questions, nothing like that. These are all common questions. We are in a professional course, so if there is a particular concept, any which way they can frame the questions. So I am only doing things which are applicable everywhere. In case something is exclusive, I will clearly tell you it is exclusive. The last concept alone is exclusive for CMA intermediate paper 8 students. So this is also one thing which I want to clearly clarify before we get started into this particular chapter. Now on that note, let's get started with this revision of marginal costing. Now guys, the first thing we will do here is with respect to the basics of this chapter. Quickly we will revise. Now I will be starting from the scratch. Now marathon, so I will be in the marathon itself, I will be constructing the formulas and all these things. It will be a super reviser for you, so that you will be in a position to appreciate all the concepts, and a few sums also we are going to do in the marathon itself. Now let's get started. Now these first 5 concepts, I call it as the basic concepts. Now we will understand this basic concepts, revise this basic concepts with the help of a numerical example. Now let us say that the selling price is 10 rupees, the variable cost is 6 rupees, fixed cost is 10,000 rupees, the volume is 6,000 units. Now with this data we need to prepare an income statement, marginal costing income statement, calculate the profit volume ratio, calculate the break-even point, calculate the margin of safety, and calculate the profit. Now quickly let's get started here. Now solution. Now guys, first the marginal costing income statement format looks as follows. Sales minus variable cost gives you contribution minus fixed cost gives you profit. Now in this case, what is going to be my sales? How many units am I selling? 6,000 units I am going to sell. and every unit is being sold at a selling price of how much? 10 rupees. So which means overall my sales value is going to be rupees 60,000. Now what's going to be my variable cost? 6,000 units each at the rate of rupees 6. It's going to be how much? Rupees 36,000. Right? Now from your sales, if you subtract your variable cost, you get your contribution, or in other words, this contribution is nothing but your variable profit. Every time I sell a unit, I get a revenue of 10 rupees. I need to incur a variable cost. Means what? So only if I produce the next unit, I'll be incurring this cost, 6 rupees. Or in other words, every time you sell every unit, you get a variable profit of how much? 10 minus 6, which is going to be 4 rupees. So 60,000 minus 36,000, so gives you how much? It gives you rupees 24,000. Or I can also say this 24,000 is nothing but 6,000 units at the rate of rupees 4 each. Right? Now, this 24,000, is this your final profit? No. Why? Because fixed cost is there. We have not yet adjusted that. So now from this, subtract your fixed cost of 10,000 rupees, you will end up with a profit of how much? 14,000 rupees. Clear with this, guys? Now guys, basically, now every time I sell one unit, I will earn a revenue of 10 rupees. For me to earn this revenue of 10, I need to incur a variable cost of 6, which means the variable profit is going to be 4 rupees, popularly called as contribution per unit, is going to be 4 rupees per unit. We know that, right? Now, why do we use the word contribution, sir? Now, we can rather use the word variable profit. Simple. Now, what happens? Every time I sell one unit, I earn a variable profit of 4 rupees. Like that, I keep on selling multiple units. Overall, now I've sold how many units? 6,000 units into 4. I have built up a total variable profit of how much? 24,000 rupees. Is this 24,000 rupees my profit? No. Now, what do I do with this 24,000 rupees? First, it contributes towards recovery of fixed cost. With this 24,000, I try to recover my fixed cost of 10,000 rupees. After recovering the fixed cost of 10,000, whatever is left over is called as my profit. Or in other words, this variable profit goes on to contribute towards recovery of fixed cost and then towards building my profit. Since it contributes towards two things, recovery of fixed cost and building your profit, we call this as a contribution. Clear with this, guys? So in this case, 10 rupees is my selling price, 6 rupees is my variable cost per unit, and then I can say the contribution per unit, short form is CPU. So contribution per unit is going to be how much? 4 rupees. 10 minus 6, 4 rupees. Clear with this, guys? Right? Now, this is how your marginal costing income statement looks like. So this is your A, marginal costing income statement. That's about it. Fine, guys. Clear with this? Next one. Let's move on to part B of the question. Now, in this part B of the question, what have they asked? Calculate the PV ratio. Now, very simple. Very simple. Now, let us say on a per unit level. Now, what is the format of your marginal costing income statement? Basically, it's sales minus variable cost gives you contribution, right? From that, minus fixed cost gives you profit. We know that. Now, on a per unit level, how much is the sales? Basically, my selling price is 10 rupees. My variable cost is going to be how much? 6 rupees, which means my contribution is going to be how much? 4 rupees, right? Or if you want it in value, for 6,000 units, we know that if I'm going to sell 6,000 units, my total sales is going to be simple, 10 into 6,000, 60,000 rupees, right? And my variable cost is 6 into 6,000, it's going to be 36,000 rupees. And my contribution is going to be 4 into 6,000, that's going to be rupees 24,000. Right, guys? Fine. Now, if I want to express everything as a percentage of my sales, or in other words, if I keep my sales as the base, and if I say right? Keep your sales as a base. That is going to be 100%. Now, if I want to express my variable cost as a percentage of sale, now can I say when my sales is 10 rupees, my variable cost is 6 rupees, or in other words, the variable cost is generally 60% of my sales. Yes, so 6 divided by 10 into 100. So can I say this is nothing but 60% of sales? So variable cost, if expressed as a percentage, I can say that it is 60% of my sales. Clear with this, guys, right? So this is called as variable cost ratio. BC ratio. What do you mean by variable cost ratio? Variable cost divided by sales into 100. Variable cost expressed as a percentage of sales into 100. Next, now I can also express my contribution as a percentage of sales. That is, contribution 4 rupees divided by 10 into 100. I can clearly say, so contribution expressed as a percentage of sales is how much? 40%. Now I can call this as PV ratio. What do you mean by PV ratio? Profit volume ratio. Are you clear with this, guys? Sir, why is this called as profit volume ratio? Basically, your contribution is nothing but variable profit. So your variable profit expressed as a percentage of sales is called as PV ratio. Are you all able to understand this? Yes. Now, guys, now, always remember one thing. Your variable cost ratio plus your profit volume ratio will be equal to 100. Why? Obviously, your sales is made up of what? Your variable cost and contribution, right? If variable cost ratio is 60%, then obviously 100 minus 60, 40% will be my PV ratio. Now, this way you can easily approach any kind of question which has everything expressed as a percentage. Are you all able to understand? Or in other words, guys, profit volume ratio is nothing but contribution divided by sales into 100. Now, don't think this can be calculated only on a per unit level. Now, on a per unit level, it is 4 divided by 10 into 100. Suppose if you want to take at 6,000 units level, no problem. You can take 24,000 divided by 60,000 into 100. You calculate and see. So 24,000 divided by 60,000 into 100. Once again, you will get 40%. How, sir? Simple. Contribution 24,000. How did you get? Simple. It's going to be rupees 4 into 6,000 units, right? Divided by what is the sales? 60,000. How did you get? Rupees 10 into 6,000 units. Anyways, both the numerator and the denominator are multiplied with the same units. Effectively, you will get only contribution per unit divided by selling price per unit. Are you all able to understand? So the proportion will not change because both the numerator and the denominator are multiplied by the same number of units. Are you all able to understand? So literally you can say PV ratio is equal to contribution by sales into 100 at any given volume level, or a per unit level, or on a total level. Fine, guys. So this is your story about profit volume ratio. With this, we have also completed the second part of the question. Third part of the question, what is this? Calculate your break-even point. So point C is your break-even point. Now, by the way, guys, as I told you earlier, separately I have mentioned all these things in the concept decoder book of the respective subjects. So your CA intermediate costing, CMA intermediate paper 8, CMA intermediate paper 12. Everywhere, everything is mentioned separately. And in the question banks, all the questions with past examination, your study material questions, past exam, everything is covered here. Now, for instance, I will just open and show it to you. This is your CA intermediate, your paper 4. Cost and management accounting. Here everything has been neatly condensed and presented here, right? For marathon purpose, so I'm mentioning it in such a way that quickly you'll be able to recapitulate everything. Now similarly for paper 8, once again the separate chapter we have in a separate book, right? This is a separate book, in fact, exclusively for paper 8. And similarly for paper 12, if you see, so here paper 12 management accounting, once again it is chapter number 3. Separately I have mentioned everything. These are all different books. All these books you can download it from our website, right? So I've made it clearly applicable. I mean, I've bifurcated it separately in the respective books. Nothing to worry about that, right? Only for marathon purpose I'm merging it, just so that in a common recording every student will get a proper learning objective. Right, guys? So now let's move on to the next one, which is called as break-even point. Now what do you mean by a break-even point? It is that point of sale where you will be left with zero profit. That is, there is neither a profit nor a loss. The profit is not positive nor negative. It is exactly zero. Or in other words, how many units should I sell so that my profit is exactly equal to 0? Those number of units is called as break-even point. Now guys, how will you compute this break-even point? Simple. Now, now, if I want to earn exactly 0 profit, can I say it will happen at a point when my contribution exactly recovers my fixed cost and I am left with 0 profit, correct? So I should be left with 0 profit. When will you be left with 0 profit? Only when your contribution exactly recovers your fixed cost, correct? Yes. So now can I say this break even point happens at a place when my contribution is equal to my fixed cost. So we need to calculate how many units should you sell so that your profit is exactly 0. So, or in other words, at that point, my contribution will be exactly recovering my fixed cost, right? It will not recover more. If it recovers, I mean, if my contribution is more, then over and above recovering the fixed cost, I will be left with profit. If my contribution is less, I will not be even able to, I will not even be able to recover my fixed cost. Hence, I'll be left with a loss. So, exactly it should be equal to your fixed cost. Only then you'll be left with a 0 profit or loss, right? Now we need to calculate how many units should we sell. Now, can I say, let us keep the number of units to be sold as X. So now contribution is equal to nothing but the number of units to be sold. Let us keep it as X into every time I sell a unit, I know I will be earning a contribution of how much? 4 rupees. So can I say X into rupees 4 should be exactly recovering my fixed cost. How much is my fixed cost? In this question, they have clearly given the fixed cost is going to be 10,000 rupees. So exactly I should be recovering how much? 10,000 rupees. Or in other words, can I say X should be equal to rupees 10,000 divided by rupees 4. Or in other words, it's going to be how much? 10,000 by 4. We will say it is 2,500 units. So if you exactly sell 2,500 units, so 2,500 into 4, you will generate a contribution of 10,000 rupees. From that contribution, subtract fixed cost, which is 10,000. Exactly, you will be left with 0 profit or 0 loss. Or in other words, we can clearly say your break-even point is 2,500 units. How did we calculate? 10,000, which is nothing but fixed cost, divided by 4, which is nothing but contribution per unit. Or in other words, we can say the break-even point formula, if you want to compute that in units, is going to be fixed cost divided by contribution per unit. As simple as that. Clear for this, guys? Why do we need to mug it up? So simple and logical. Beyond this, there is nothing that you will need. Clear with this, guys? Yes. Now, suppose break-even point is nothing but point of sale. How many units? What is the volume I should sell so that my contribution exactly recovers my fixed cost? That's my break-even point. Now, this break-even point can also be expressed in values because it is sales. No, sales can be expressed in units or in values. Now, suppose if I want to find out the break-even point in value, how can I do that? Very simple. Similar thing. So break-even point is a point at which what? My contribution should be equal to my fixed cost. Correct? So it is a point where my contribution should be equal to my fixed cost. Now, how much is the fixed cost? 10,000 rupees. Now, can I say contribution is nothing but, one way of arriving at the contribution is number of units, X number of units into rupees 4 contribution per unit. Or can I say contribution is nothing but sales in value into PV ratio? For example, in this case, PV ratio was how much? 40% in this question. So this 24,000 was the contribution when my sales was how much? 60,000. Or in other words, can we say 60,000 into 40%? Can I say will be 60,000 into 40% will exactly be 24,000. So can I say another way of computing contribution is your sales in value multiplied by PV ratio. So now we can say here, we can keep this as sales in value, or in other words, I can say this is your required sales X in value. I'm putting a rupee symbol here into PV ratio should be equal to 10,000 rupees. Correct? Now, or in other words, X, that is sales, required sales in value into how much is my PV ratio in this question? 40% into 40 percentage is equal to rupees 10,000, or in other words, x in rupees or in value is going to be rupees 10,000 divided by 40 percentage, or this is nothing but how much is it, 10,000 divided by 0.4, you get how much, rupees 25,000 is going to be my break even point in value. Or in other words guys, very simple, now I can say if you want to calculate the break even point in value, the formula is fixed cost divided by PV ratio. Are you all able to understand? Now sir, logic for this, so once again I will just put it here, break even point in value is going to be fixed cost divided by PV ratio. What is the meaning of this? If you generate sales worth 25,000, now what will happen? Sales is 25,000 in this case. So now what will be the contribution? 25,000 into 0.4, you will be exactly generating a contribution of how much? 10,000 rupees. Now from this 10,000 contribution, subtract your fixed cost 10,000, you will be left with zero profit or zero loss. Are you clear with this? Or in other words, another way of doing simple, sales minus variable cost gives you contribution minus fixed cost gives you profit. Now I want to calculate how much sales I should make, right, to exactly earn a zero profit or zero loss. So now your profit is zero. Now fixed cost is given. I need to recover 10,000 rupees, which means my required contribution is how much? 10,000 rupees. Correct? Reverse work. Right? Only if I exactly generate a contribution of 10,000, my fixed cost of 10,000 can be recovered and I'll be left with a zero profit. Right, guys? Fine. Now we know this PV ratio concept. Now if I generate sales of 100, my contribution is generally 40. That's the concept of PV ratio. We know that. Now simple, if 10,000 should be equal to 40, how much should be 100? It is nothing but simple formula you can use mathematically. 10,000 divided by 40 into 100, or in other words, this is nothing but 10,000 divided by 40%, or this is nothing but this formula, fixed cost by PV ratio. Are you clear with this, guys? Logically you can arrive anything and you will be able to clearly complete this chapter. Not even a single formula needs to be mugged up. That's the beauty of marginal costing. Right now guys, mugging up in costing and in FM also, I'm telling you, not even a single formula in the entire subject should be mugged up. Right? Mugging up in our subjects is not even a sin, it's a crime. It's a crime. You should not mug up because everything is so logical here. Now look at this. This is about the formula. Simple, guys. Break even point, if you want it in units, fixed cost by contribution per unit. Suppose if you want the same in value, denominator instead of contribution per unit, you put it as PV ratio. Always remember this. If you want the answer in units, it is going to be contribution per unit. If you want the answer in value, put it as PV ratio. You will get it. Are you all able to understand? This is all about the logic, and all these things in detail I have just explained it in a neat manner in the concept decoder of the respective CA and CMA books. Separately they are all mentioned. Clear with this, guys? That's about this area. So basically, what do you mean by a break-even point? It is that point of sale where your contribution exactly recovers your fixed cost and you're left with a zero profit or zero loss. That is all about this area of break-even point. Formula, if you want the break-even point in units, the formula is fixed cost by contribution per unit. If you want the answer in value, it's going to be fixed cost by PV ratio. As simple as that. Now let's move on to the next one, D. Let's move on to the next one, D. Now what is D? You have asked for something called as margin of safety. Now how do you compute this margin of safety? Now guys, very simple. Now in this question, you guys tell me overall, how many units have been sold? The example that I gave you, they have sold a total of 6,000 units, correct? Right. So they have sold a total of 6,000 units. So I'm keeping it here. The total sales made was 6,000 units. Right, guys? Fine. And what was the break-even point? The break-even point we just now computed. Let's put it in units. 2,500 units. So the break-even point was 2,500 units. Right, guys? So this is nothing but your break-even point. This is nothing but your total sales. Perfect. Now, what do you mean by margin of safety? Very simple. You've totally made sales of how much? 6,000 units. Now, if you sell 2,500 units, you generate a contribution that exactly recovers what? Your fixed cost, and you're left with zero profit or zero loss, correct? Now, any sale that you make over and above your break-even point generates a contribution that goes on to contribute towards building your profit. Are you guys clear with this? So, overall sales 6,000 units is broken up into two. First 2,500 units, it generates a contribution that is meant for recovering your fixed cost. Once entire fixed cost is recovered, whatever contribution you earn goes on towards building your profit. So the number of units sold over and above my break-even point is called as margin of safety. Now, in this particular scenario, how many units have we sold over and above the break-even point? So we have sold, literally, so 6,000 units minus 2,500 units. Literally, guys, in this case, we have sold 3,500 units over and above my break-even point. This is called as margin of safety. Clear with this, guys? Or in other words, total sales minus break-even point gives you margin of safety. Are you all able to understand this? Are you all able to understand this? Now, a very, very important thing that I'm going to tell you, I call this as marginal costing jodies. A very, very important understanding that you need to have. These are all basics of marginal costing. So once you strengthen this up, automatically the remaining part of the chapter will be easy for you to appreciate. Now, guys, first one. Now, let me just write on the format of this, marginal costing income statement. Sales minus variable cost gives you contribution minus fixed cost gives you profit, right? Now, in this particular example, what was the total sales we made, right? 6,000 units into 10 rupees. How much was that? Rupees 60,000, right? What was the variable cost? Now, 6,000 units into 6. It was how much? Rupees 36,000. If you subtract the two, now, or in other words, what is the contribution? 6,000 units. Each unit generated 4 rupees of contribution. So it's going to be 24,000, right? From this, subtract your fixed cost, 10,000 rupees. Literally, you are left with what? A profit of how much? A profit of rupees 14,000, right? Now, remember this for a lifetime. It's a very, very important understanding. Now, guys, the total contribution generated out of the total sales, that is 6,000 units, generated a contribution of how much? 6,000 units into 4. So the contribution generated by 6,000 units is nothing but the total contribution, 24,000 rupees. Are you all clear with this? So can I say my total sales is linked to my contribution, right? Next. Now, the contribution generated by the break-even point units, first 2,500 units, what was the contribution it generated? 2,500 into 4, 10,000 rupees, right? Or in other words, that is nothing but equal to your fixed cost, right? So, the contribution generated by break-even point is going to be equal to your fixed cost, right? Simple. Why? Because break-even point is nothing but that point where my contribution exactly recovers my fixed cost. Nothing less, nothing more. If it is less, then you will be having a loss. If it generates a more contribution, then you will be left with a profit. Exactly at 2,500 units, what you have is you generate a contribution equal to your fixed cost. Suppose I'm selling only 2,400 units, which means if I'm operating below the break-even point, the contribution that I would have generated would not even be able to recover your fixed cost. Suppose if I'm selling above my break-even point, it means after recovering the fixed cost, I have some extra contribution that goes on to build my profit. This way you can clearly analyze. Now over and above my break-even point, how many units have I sold? 3,500 units. The contribution generated by these 3,500 units now goes on to build my profit. 3,500 into how much? 4 rupees. 3,500 into 4. How much is that? 14,000 rupees. So this is going to be equal to my profit. Are you guys able to understand? Or clearly make a very important note of this. My total sales is linked to my contribution, right? Now my break-even point is linked to my fixed cost, and my margin of safety is linked to my profit. Are you all able to understand? So the contribution generated by total sales is going to be the total contribution. The contribution generated by break-even point is nothing but your fixed cost, and the contribution generated by your margin of safety is going to be called as your profit. Are you all clear with this? Now, one more very important thing. Now, these are all ideally your volume levels. This can be expressed in total values also. For example, 6,000 units. If you want to mention in units, it is 6,000 units. If you want to mention it in value, it's going to be how much? 6,000 into 10, 60,000 rupees. I can call this as 60,000 rupees. Correct? Similarly, break-even point, sir, 2,500 units, sir. If you want to express this in value, 2,500 into 10. This is going to be 25,000 rupees. Correct? Worth of sales. And margin of safety, 3,500 units. If you want to express this in value, it's going to be 3,500 into 10. It's going to be 35,000 rupees. Correct? 35,000 rupees. Right? Now, very simple, guys. Now, can I say my total sales, right, 6,000 units into contribution per unit gives me my total contribution, or my total sales into value into PV ratio gives me my contribution. Right? Now, you can calculate this 60,000 rupees into 40 percentage. Take your calculator and do. You get how much? 24,000 rupees. Or break-even point. In units, break-even point units into contribution per unit gives you fixed cost 2,500 into 4 gives you 10,000. Or break-even point, if it is in value, then use PV ratio into PV ratio 40%, 25,000 into 0.4, how much is it? 10,000 is equal to your fixed cost. Or margin of safety, similarly, in units into contribution per unit, that is 4 rupees, you will get a profit. Or margin of safety into in value into PV ratio 40 percentage, you try and do, you will get what? Profit. Are you guys clear with this? Or in other words, total sales is linked to total contribution, break-even point is linked to fixed cost, and margin of safety is linked to profit. The linking factor is what? The linking factor is ideally your contribution per unit, the contribution per unit, or you can also say PV ratio. It is contribution per unit or PV ratio. Sir, how? Or sir, if these are in units, if these three, the top figures are in units, then the linking factor is contribution per unit. If these are in values, the linking factor is PV ratio. Are you guys able to understand this? Are you guys able to understand this? Right? Now, coming to the discussion of margin of safety. Coming to the discussion of margin of safety. Now, guys, can I say margin of safety once again can be expressed either in units or in value. Correct? Now, if you want to express this in units, now I can say simple. One formula is what? Total sales minus break-even point. Correct? In this case, how much is it? Sir, totally I've sold 6,000 units. Sir, break-even point is how much? 2,500 units. How many units have I sold over and above the break-even point? 3,500 units. Clear with this, guys? Next, another formula. Now, use this marginal costing jodis. Now, can I say margin of safety into contribution per unit gives me the profit. The profit generated out of these extra units only went on to build my profit. Correct? So, can I say margin of safety into contribution per unit is equal to profit? Or in other words, margin of safety is equal to profit divided by contribution per unit. Are you all understanding? This 14,000 rupees is a profit that I earned, right? By selling how many units? Sir, every time I sell one unit, I earn a contribution of how much? 4 rupees in our example. So how many extra units have I sold over and above the break-even point to generate this profit of 14,000 is the calculation. So another formula here is going to be what? It is going to be profit divided by contribution per unit. Are you guys able to understand? Every single thing is derived, right? In the marathon itself, I'm deriving so much. In our regular or exam oriented batches, it will be done with much more explanation and other things. Since this is revision, still I want to set the context and I'm doing it for you. Clear with this, guys, because there will be some students who might not have listened properly, or maybe some freshers who have not at all attended the lecture. Since to set the context, I'm just giving all these explanations once again, so that the remaining part of discussion in this marathon itself will be very easy for you to understand. Clear with this, guys? Now, very simple. If you want the figures in value, margin of safety, once again, guys, so the formula, one of the formula is going to be total sales in value minus break even point in value. Look at this, total sales in value, how much was that? 60,000 rupees minus 25,000 rupees. If you subtract, you get 35,000 rupees, right? Or another formula is simple, use this formula, right? Profit divided by, now I want it in value, instead of contribution per unit, use PV ratio. One more jodi, no, right? So simple. So margin of safety 35,000 into PV ratio gives me my 14,000 rupees of profit, or profit divided by PV ratio gives me the margin of safety. Are you guys clear with this? So it is going to be profit divided by PV ratio. This is another formula for your margin of safety. As simple as that, guys. This is the power of conceptual learning. Beyond this, you don't need anything at all. That's all about it. That's all about it. Fine, guys. Now, that's about this particular area of margin of safety. Clear with this, guys? And finally, you can arrive at your profit. I think this profit has been arrived at. In this question, how much is your margin of safety? I think we have arrived 3,500 rupees, 3,500 units. Or if you want it in value, it's going to be 35,000 rupees. We have calculated all of that. And finally, guys, what is the thing they have asked for? So last one is arrive at the profit. Now, guys, in your study material, so many formulas are there and students mug it up. No need to mug up formulas. Now, profit, what is the formula? Profit is equal to, one formula I can say, use a marginal costing income statement. Sales minus variable cost is contribution. Contribution minus fixed cost gives you what? Profit, correct? This is one formula. Another formula, use your marginal costing jodis. Can I say profit is equal to margin of safety units? Profit is nothing but the contribution generated by the margin of safety units, or in other words, your margin of safety units into contribution per unit. 3,500 into contribution per unit is 4. This is also equal to your profit, right? So another formula we can say is profit is equal to margin of safety units into contribution per unit, or suppose margin of safety is given in value, multiply that with PV ratio. This way also you can arrive at the profit, right? In this question, you look at it. What is the margin of safety in value? 35,000 rupees into PV ratio. How much was that? 40%. So 35,000 into 0.4. How much you get? 14,000 rupees. As simple as that. You can literally play around with the figures. This is the power of conceptual learning. Clear with this, guys? Just we spent some time and look at the variety of formulas we ourselves can arrive. That's about it. You need not mug it up. You need not mug it up at all. Clear with this, guys? So these are different variants of arriving at the the profit formula. That's about it. Now itself, if you notice, we have covered so many formulas, and the best part is that all these formulas on the spot you can derive and arrive it. You need not take the pain of mugging up anything. The formula construction, we spent about 35-40 minutes right now. With that itself, we are getting this much level of conceptual clarity, so that you can arrive the formula by yourself. With this, any kind of sums in this basic level, you will be in a position to handle. Clear with this, guys, right? So that is about the basic concepts covered in this particular chapter initially. So with this, we have covered the revision of income statement, PV ratio, break-even point, margin of safety, and profit. Clear with this, guys, right? Now, let us go on and cover one more small concept called as cash break-even point. Now, guys, what do you mean by cash break-even point? Now, let us take this particular example itself for discussion. Now, all the facts are same. Only one small additional information. Here, fixed cost is given. How much? 10,000 rupees. Now, let us say, out of this fixed cost of 10,000 rupees, right? Example, I'm telling you, depreciation amounts to rupees 2,000. which means what? The other component is your cash fixed cost. What do you mean by cash fixed cost? Basically the fixed cost which is incurred in cash. For example, your factory rent, that is an amount I need to pay, right? In cash, it's going to be balancing figure 8,000 rupees. Now your total fixed cost is bifurcated into two: cash fixed cost, those components of fixed cost which are actually incurred and which needs to be paid to some third parties. Whereas your depreciation, this is also a fixed cost, but this is something that I set aside for my accounting purposes, right? Literally I would have spent the entire amount, capitalized the value, and based on my period of consumption, based on the period of the life of the asset, I amortize, I apportion it, right? Now this is an amount I need not pay out by cash. Now what do you mean by a break-even point? It is that point of sale. How many units should I sell to recover my entire fixed cost? Correct? Now in this question we saw, right, it was 10,000 rupees I want to recover, right? So every time I sell one unit, I earn 4 rupees. Literally I need to sell 2,500 units so that I will be exactly able to recover this 10,000 rupees of fixed cost. This is what we saw. Now cash break-even point means how many units should I sell to recover only the cash fixed cost. I need not recover the full fixed cost including depreciation. So how many units should I sell in order to recover this 8,000 rupees in our example of cash fixed cost? Or in other words, can we say cash break-even point is equal to cash fixed cost divided by contribution per unit, right? Now in this case I want to recover a total of how much? 8,000 rupees, right? Every time I sell a unit, how much contribution do I earn? I earn 4 rupees, which means how many units should I sell? 2,000 units. If you sell 2,000 units, exactly 2,000 units, each unit will generate 4 rupees of contribution. I will be able to pile up a contribution of how much? 8,000 rupees. From this, subtract your cash, this will be equal to your cash fixed cost. I will be able to recover my cash fixed cost. Are you all able to understand? Now guys, clearly understand, at cash break-even point, you will not be having your profit equal to 0. You will be having a loss. Sir, how sir? Simple. I will give this particular table and you will be able to understand. Now guys, let us say in our example we saw the break-even point was how much? 2,500 units. And we saw the cash break-even point right now we saw is how much? 2,000 units. Now at the cash break-even point, how much contribution you would have generated? You would have generated 2,000 into 4, which is equal to how much? 8,000 rupees. However, from my contribution, subtract your fixed cost 10,000 rupees. Literally in this position you will be left with a loss of how much? So literally guys, at 2,000 units level, 2,000 into 4, 8,000 rupees is going to be my contribution, minus entire 10,000 rupees of fixed cost. Literally you will be left with a loss of 2,000 rupees. Correct? Whereas at the break-even point, full break-even point means what? It is so many number of units that I need to sell so that my entire fixed cost of 10,000 rupees is recovered. I am left with 0 profit, 0 loss. So here literally 2,000 into 4, 2,500 into 4, 10,000 rupees the contribution minus fixed cost 10,000. I am left with a profit or loss of exactly 0. Or in other words guys, any point operating below the break-even point we know will give you a loss only. Right now at the cash break-even point, I am selling so many number of units that is exactly able to recover only my cash fixed cost, which means I have still not yet recovered my depreciation. Or in other words, the profit or loss, in this case the loss at the cash break-even point level will be exactly equal to the depreciation, because that is the only amount which I have not yet recovered. Are you guys clear with this? So one small learning objective here, at the cash break-even point, I generate contribution that is sufficient to recover my cash fixed cost, which means I have not yet recovered my depreciation amount. Or in other words, at the cash break-even point, in this example 2,000 units, I am left with a loss which is exactly equal to the unrecovered component of your fixed cost, which is nothing but your depreciation amount. Are you all able to understand? At the cash break-even point, the loss is equal to your depreciation because that is the only amount which is not yet recovered. Are you guys able to get this? This is the concept of cash break-even point. Now, literally, guys, with this, we have also covered this concept of cash break-even point. These are all the basic concepts which you definitely need to have in your mind, which you need to know before you can enter into the other areas. That's the reason why I'm giving you guys a background here itself. Right now, all these things I have clearly explained in our concept decoder book. If you open it neatly, a lot of efforts have gone into building these books because these are, as I told you, these are separately available for CA Inter Paper 4 Cost and Management Accounting, CMA Inter Paper 8 Cost Accounting, CMA Intermediate Paper 12 Management Accounting. All the books are separate. All the books are separate, neatly done based on the respective study materials. I have done it, and accordingly all these explanations have been given here. Right, this example I gave you with an illustration so that you can understand. Look at this. Selling price per unit is equal to variable cost plus contribution. Correct? Sales minus variable cost is contribution, or contribution plus variable cost is sales. Any which ways you can play around. Contribution per unit is equal to selling price minus variable cost. Everything is explained here. Basic concepts here. So contribution per unit is selling price minus variable cost. Total contribution is sales into PV ratio, or you can say contribution per unit into units sold. You can play around, or sales minus variable cost, or you can say sales minus variable cost is equal to contribution minus fixed cost gives you profit. So contribution is equal to sales minus variable cost, or if you want to reverse work, you can say it is going to be fixed cost plus profit. So contribution minus fixed cost gives you profit. Now if this goes to the other side, contribution is equal to profit plus fixed cost. This way also you can write. Literally you can play around everything I have mentioned here. The background logics is what I just taught you right now. Like this, every single thing, PV ratio, right? The formula, contribution by sales into 100, right? Required sales, we'll be doing it. Now all these things, literally, this is also something that we'll be covering in volume analysis. I will just come up right now. So every single thing, cash break-even point, what is the meaning of that? Fixed cost divided by contribution per unit is your break-even sales, right? If you want it in units, if you want it in value, it's divided by PV ratio, right? Now the break-even sales, you can say it's break-even units into selling price per unit. So cash break-even point is nothing but cash fixed cost divided by contribution per unit, or PV ratio as the case may be, right? And I've also given this doubt buster clearly. Doubt buster basically is those areas which you can have a confusion. At the cash break-even point, there will be a loss which is exactly equal to your non-cash expenditure depreciation. Every single thing literally has been mentioned here in the concept decoder book itself. Clear with this, guys? So there is nothing beyond this that you need. This is a very good way to actually, once you cover this conceptual explanation, you just go through it once, you will be able to have a full-fledged understanding the day before your exam. You just need to open your concept decoder and go through it once. You will be able to remember every single thing that I taught you. That is the biggest value addition, because all these things have been carefully designed. All the colorings and other things have been designed in such a way that you will be able to recollect all the important parts, whatever I've taught you during this lecture, when you are revising it. So this is a book which you can use both at the time of preparation, same book at the time of revision also. So I've removed all the unwanted content that runs into multiple paragraphs. We have used some AI tools and all to condense everything in a neat presentation manner. And if you notice, all these formulas are mentioned in a separate font, dark purple, right? So that the day before your exam, you can quickly revisit everything. Clear with this, guys? And the logic for all these things through our lectures is what we cover. Now just imagine, in the marathon itself, I'm covering all these things. In our exam oriented or regular batches and all, it will be in a much detailed manner, in such a way that we'll be covering so many sums also in the marathon revision. So little bit of sums here also I will cover, but all the sums in detail, all the chapters will be covering in our exam oriented as well as regular batches. Right, guys? Fine. So with this, let us move on to the next concept called as indifference point. So indifference point. Now let's get started with this particular concept. Now guys, we will also do one numerical problem in this particular area, one high level question we will be doing. Now even in the marathon, still it's okay, we will do a high level question, because this will cover this entire concept of indifference point. But before that, quickly I will walk you through the concept of indifference point with all the formula explanation. We will derive and see everything. So indifference point. Now guys, what is this concept all about? Quickly, I will give you guys an example. Now, long ago, right? So now don't think I'm talking about some previous generation, years and decades back. No, a few years back, right? Before 2016, right? Why sir 2016 specifically? That was a year when Jio came into this telecom sector. Before that, right? Now there were multiple players in this telecom sector. Now they had this concept of prepaid, postpaid. It is still there, but it is not as vibrant as it was before, because Jio has come up with all this unlimited plans. So many people, they don't know the concept of prepaid, postpaid and all nowadays. That's why I started off with saying long ago, master stroke by the Reliance group of companies. Master stroke, they wiped off the entire market, and initially they gave all the SIM cards free of cost and everything, and people were actually making fun. They were thinking, why are these guys doing all this, right? And they thought in India people will use free of cost and then they will not buy. Slowly and gradually he introduced all this paid subscription into the market, and literally they swept off this entire telecom industry. Fine, the case study another part, maybe in a separate video I'll make. But right now, let's take this example of telecom sector to understand the concept of this concept of indifference point. Now guys, let's say you have two models. One is called as prepaid, the other one is called as postpaid, right? Now in prepaid, generally what you have, in both the models you have a variable cost and a fixed cost. Let me take an example. Suppose if you are opting for a prepaid SIM, they will say, sir, monthly you should pay us a fixed charges of 100 rupees, right? What is this? This is going to be an amount which you pay them because they are retaining your number, mobile number. Variable cost, for every call you make, let us say you are supposed to pay them 50 paise, right? So which means if you're taking a prepaid SIM, flat 100 rupees every month, irrespective of your calls, you need to pay, plus every call you make you need to pay them 0.5 rupees. Whereas if you're going for a postpaid plan, every month you need to pay them a fixed charges of 500 rupees. But the advantage here is every time you make a call, per call you need to pay only 30 paise, right? Now guys, prepaid plan, this is the cost model, 100 rupees flat every month plus 50 paise per call. Postpaid, 500 rupees every month plus 30 paise per call. Now you guys tell me, which is more beneficial? Which is more beneficial? Will I go for prepaid or will I go for postpaid? Out of the two, which one is the best? Now, you can't come up with a solution like always prepaid is best or always postpaid is best. Why? Because here we need to choose between two different alternatives, and in prepaid, the advantage is lower fixed cost. Instead of 500 here, it's only 100 rupees. Whereas in postpaid, the advantage is by way of lower variable cost. Instead of 50 paise, here it's only 30 paise, that is 0.3. Or in other words, both these options, alternatives, will have one advantage and one disadvantage each. In this case, you can't directly come to a conclusion saying one particular alternative is always better than another particular alternative. Are you guys clear with this? And this concept of indifference point will come into picture only when you are deciding to choose between either of the two alternatives. Between choice of multiple alternatives, only then will you have a concept of indifference point. By the way guys, this chapter goes on to achieve the objective of decision making. Here in this chapter throughout, we are going to take decisions, right? So that is the most important thing that you need to have in mind. Ideally, I should have told this before. This chapter has an objective of decision making, right? And by the way guys, now our subject, right, cost and management accounting, overall it has three objectives. One is your stock valuation and profit computation. The second objective is decision making. The third objective is control, right? Now, this chapter helps you achieve the objective of decision making. Every single chapter has its own objective, either of the three objectives. This chapter has the objective of achieving your objective B, the second objective, decision making. However, in one area alone, that is in this concept called marginal costing versus absorption costing, we will also be seeing in this concept alone, it goes on to achieve the first objective, stock valuation and profit computation. This particular segment alone, everything else in this chapter goes on to achieve your decision making objective. Now coming back here, guys, coming back here, now sir, prepaid is better or postpaid is better? You can't come to a conclusion like that, because each of these two alternatives have one advantage and one disadvantage each. Now, but can I say there will be one point when both the alternatives will give me the same cost, same result. Now guys, you all think practically and tell. Let us say you are a missed call party, a conjuice party, right? So you will not make much of calls, you will only make missed calls. Literally, you want a phone number, for that only you actually subscribe to either prepaid or postpaid sim, right? You will not make much of calls. If at all, you make only at emergency purposes, right? Beyond that, you will not make. In that case, you tell me, will you go for a prepaid sim card or will you go for a postpaid sim card? Now, clearly you will go only for prepaid. Why? Sir, my volume is not less, so I need not commit 500 rupees. Prepaid, I need to commit only 100 rupees. If I make a phone call, only then 0.5 rupees I need to pay. Maximum, sir, my volume is very less, I will not make many phone calls and all. In that case, overall, your significant component of your cost is driven by your fixed cost. So you will go for that option that gives you a lower fixed cost. Generally, when your volume is less, you will go for that alternative that gives you a lower fixed cost. Suppose, let us say, now you are a businessman and you need to make a lot of phone calls every month. Now here, you don't mind paying this 500 rupees, but every time you make a call, your volume is very high. Instead of paying 0.5, you just need to pay 0.30. So if your volume is very high, now overall cost comprises of fixed plus variable. If your volume is huge, then generally the variable cost will be actually, the compensation of variable cost will be more. Hence, you will go for that alternative which gives you a lower variable cost per unit. In this case, if you are a person who makes multiple phone calls every month, you will go for a postpaid option, because that will give you overall lower cost. Clear with this, guys? But there will be one point of volume where the total cost under prepaid will be exactly equal to the total cost under postpaid, and that volume at which the total cost under both the alternatives are equal is called as indifference point. Are you clear with this? Indifference point means what? I am not different to either alternate A or alternative B, because both the alternative gives me the same result. The point of volume at which these two alternatives gives the same total cost is called as indifference point. Clear with this, guys? So now, how will I get this, sir? Simple. Let us keep this indifference point. Indifference point is nothing but volume as X. Now, what will be the total cost of prepaid? Can I say the total cost of prepaid will be 0.5x plus 100, correct? Now at the indifference point, this has to be equal to the total cost arrived under postpaid. What is the total cost of postpaid? 0.3x plus 500, right? Now take x on one side, I will say 0.5x. Now this comes to the other side, becomes minus 0.3x is equal to 500 minus 100. Correct? So I have 500 here, 100 comes to the other side, it becomes minus 100. Clear? Now take x out in common. Can I say this is nothing but x into 0.5 minus 0.3 is equal to 500 minus 100, or in other words, x is equal to 500 minus 100 divided by 0.5 minus 0.3. This is nothing but 400 rupees divided by 0.20. So 400 divided by 0.2 is equal to how much? 2000. right? 2000 units, or in this case it is not units, it is 2000 calls. Or in other words, if I am going to exactly make 2000 calls every month, then either if I go for prepaid or if I go for postpaid, both the alternatives will give me the same result. Clear with this, guys? Suppose your expected volume for the upcoming month is less than 2000 calls. If I am a person who is going to make less than 2000 calls, then I will go for that alternative. My volume is less, I will go for that alternative that gives me a lower fixed cost. I will go for prepaid. Suppose if my expected volume in the upcoming month is more than 2000 calls, right? In that case, I will go for that alternative that gives me a lower variable cost. I will go for postpaid at 2000 phone calls. In this case, what will I do? It is an indifference point. I am not different to either of the two alternatives because both the alternatives will give me the same result. Are you guys clear with this, right? This is the concept called indifference point. Or in other words, guys, how do we calculate indifference points? Very simple. Now look at this here, look at this. 500 minus 100 by 0.5 minus 0.3. So 500 minus 100 is nothing but difference in fixed cost, correct? This is nothing but difference in fixed cost divided by, now what is this? 0.5 minus 0.3. 0.5 minus 0.3 is nothing but difference in variable cost per unit. Are you all able to understand? Are you all able to understand? Or in other words, I will say indifference point is equal to difference in fixed cost divided by difference in variable cost per unit. If I arrive at this, I will get what? The indifference point. Sir, with the help of indifference point, what can we do? Simple, guys. With the help of indifference point, let us say in this case, indifference point is 2000 calls, right? In this case, it is calls. Suppose if we are talking about a manufacturing company, it will be 2000 units, for example. Simple. With this, sir, what decision can I take? Simple. Now, sir, 2000 units is going to be your indifference point. Now, suppose in the next month, you have your expected demand is less than 2000 units. What will you do? You will go for that option which has a lower fixed cost. Suppose in the upcoming month, your expected demand is more than 2000 units. You will go for that option which has a lower variable cost per unit. Clear with this, guys? And sir, exactly it is going to be 2000 units. It is called as indifference point. Whether you go for alternative 1 or you go for alternate 2, in either of the two alternatives, it is going to give you the same result. In this case, I am going to make 2000 phone calls exactly. Whether I go for prepaid or I go for postpaid, it doesn't make any difference. Suppose I'm a person who is going to make less than 2000 phone calls every month, then I will go for prepaid option. Why do I go for prepaid option? It is the option which has a lower fixed cost. Whereas if I'm going to make more than 2000 phone calls, I'll go for postpaid option because it has a lower variable cost per unit. So I'll go for postpaid here. Are you all able to understand this, right? So just if you calculate this indifference point, one look at the expected volume for the upcoming month, now upcoming period, you can say, sir, I'm going to make 5000 units, sir. Go for postpaid. Why? Lower variable cost per unit, right? Over and above my, it is lying below, it is lying beyond my indifference point. Sir, I'm going to sell only 500 units, sir. Go for prepaid. One look at the volume, you can directly say which alternative is going to be better for you, and the deal breaker here is going to be your indifference point. For that purpose only, we have computed this indifference point. Are you all clear with this? How do I compute indifference point? Difference in fixed cost divided by difference in variable cost per unit. I proved this formula and showed it to you. As simple as that, guys. You need not even mug this up. Clear with this, guys? So by one look at the expected output for the next period, you will be able to clearly tell which option is going to be working out for you. Are you all able to understand this? Yes. Now, sir, now in this case, if you notice, here we have 100 rupees of fixed cost. Here we have 500 rupees of fixed cost, right? Now, out of these two alternatives, which one has a lower fixed cost? Obviously, your prepaid. Correct. And here the variable cost is 0.5, here the variable cost is 0.3. Out of these two alternatives, which has a lower variable cost per unit? Absolutely postpaid. Clear with this, guys? So if my volume is more, right, I will go for postpaid. More means what? Beyond 2000 units, 2000 calls, right? If my volume is less, what do you mean by less? that is my expected volume is only less than 2000 phone calls, then I will go for prepaid. One look at this itself, you will be able to understand. For example, if I am going to make 1000 phone calls, lies below indifference point, prepaid will be better for you, right? If you want, you can check and also calculate. So 1000 phone calls means how much will be the total cost under prepaid? 0.5 into 1000, that's going to be 500 plus 100, it's going to be how much? 600 rupees will be the total cost under prepaid. If I go for postpaid, how much will that is that going to be? It is going to be 1000 into 0.3, that's going to be 300 variable cost. Fixed cost is how much? 500. Overall it's going to be 800. Clearly, if you notice, now your prepaid is cheaper than postpaid. Why? Because the expected volume lies below your indifference point. Like this, you can take one example of, let us say, 3000 phone calls and try. Obviously, postpaid will give you a lower cost than prepaid. There you will say postpaid is better. So here, now, there is no one best alternative. It depends on the volume. It's all about the volume game in this entire chapter. Clear with this, guys? So this is the concept of indifference point, where you can calculate it using this formula: difference in fixed cost divided by difference in variable cost per unit. Now let me add one more extra information here. With that one more formula we can cover for this indifference point. Let us say I am running a call center, right? And let us say ICICI Bank has hired me, right? I run a call center. ICICI Bank has hired me and they have told, right? Now I will give you one database which has a list of all the phone numbers of almost all the citizens in this country. Now your duty, the call center's duty, is to call every person and disturb them. Ask them whether they want credit card, debit card, whether they want to open a bank account, loan account, whatever it is, right? Now what ICICI Bank tells me is that, or HDFC Bank, whatever bank it is, they are telling me, for every phone call you make and disturb, I will pay you 1 rupee. Clear with this, guys? Now they are not bothered whether me, the call center, is using a prepaid or a postpaid SIM card. Clear with this, guys? This is the scenario. Now, in this scenario, how will the cost figures look like? Now, guys, we have what? Prepaid plan. We have postpaid plan, right? Now, you guys think and answer. Whether I use a prepaid SIM or I use a postpaid SIM, how much is the amount I will be getting from the bank? 1 rupee. This is the selling price. We are calculating this from the perspective of the call center, right? Whereas, how much will be the variable cost? If I use a prepaid SIM, we calculated the variable cost was slightly higher, 0.50. Whereas postpaid SIM, it was only 0.30. Correct? Now, how much is going to be the contribution per unit, or in other words, contribution per phone call? Here we'll say one phone call is 1 unit. Here, if I use prepaid, it's going to be 0.50. If I use postpaid, it's going to be 1 minus 0.3. It's going to be how much? 0.70. Clear with this, guys? Now, how much is the fixed cost? Now, sir, if I use a prepaid SIM, the fixed cost is only 100. Whereas, if I use a postpaid SIM, how much is going to be my fixed cost? My fixed cost is going to be 500 rupees. Are you clear with this? Now, in this case, which alternative is better? Same situation. Now, option A, that is your prepaid, has an advantage. What advantage? Lower fixed cost. Whereas postpaid, what advantage it has? It has a higher contribution per unit. Are you all able to understand? Now, guys, this is nothing but lower variable cost results in higher contribution per unit. No, because my selling price was the same. Selling price minus variable cost gives me contribution. Postpaid had a lower variable cost, which in turn resulted in a higher contribution per unit. Agreeing with me on this? So literally what I can say, prepaid has an advantage of lower fixed cost, postpaid has an advantage of higher contribution per unit. Which is better? You can't directly say like that. Then you need to compute your indifference point. In this case, once again, guys, if your volume is lesser, you will go for that alternative which has a lower fixed cost. If your volume is more, you will go for that alternative which has a higher contribution per unit. But there will be one point where the profit under the first alternative will be equal to the profit under the second alternative. This point of volume is called as indifference point. Now in that case, the profit under two alternatives should be equal, right? So now let's compute that. Now how do we do it? Simple. Let's take the volume as x. In that case, tell me what will be the profit under prepaid plan. The prepaid plan profit is going to be 0.5x, correct? Contribution 0.5 into x is the number of units which we need to compute, indifference point, minus contribution minus fixed cost 100 rupees, right? That's going to be the profit under first alternative should be equal to 0.7x is going to be the contribution under the second alternative minus 500 rupees, right? So now what we need to do, so now we just need to take x on one side and the fixed cost on the other side, the values on the other side. So can I say this 500 comes to the other side, minus 500 becomes 500. So can I say 500 minus 100 is equal to 0.7x minus 0.5x. So here we have 0.7x and this 0.5 goes on the other side, it becomes a minus 0.5, right? So now how much will this be? How much will this be? So this is going to be, once again I'll take x common out here, so I will say x the whole into 0.7 minus 0.5 will be equal to 500 minus 100, or in other words, x is equal to 500 minus 100 divided by 0.7 minus 0.5, right? Here literally x is equal to 500 minus 100 divided by, this comes to the denominator, 0.7 minus 0.5, right? So now I can say, or this is nothing but this is equal to 500 minus 100 is 400 divided by 0.7 minus 0.5 is going to be 0.20. So 400 by 0.2 gives me how much? 2000 units, or in other words 2004 calls. In this case, how did we compute 500 minus 100? 500 minus 100 is nothing but difference in fixed cost, correct? Is nothing but difference in fixed cost. And 0.7 minus 0.5, so 0.7, this is nothing but difference in contribution per unit. This is nothing but what? Difference in contribution per unit. Or in other words, I can say indifference point is equal to difference in fixed cost divided by difference in contribution per unit. Are you guys able to understand? This is another formula for your indifference point calculation. See how logical it is. Now sir, with this what can you come to a conclusion? Simple. So now I have an indifference point. How much is my indifference point? It's going to be 2000 units, in this case 2000 phone calls. If my expected volume is less than the indifference point, I will go for that alternative which gives me a lower fixed cost. If my expected volume is more than the indifference point, I will go for that option which gives me a higher contribution per unit, or in other words lower variable cost. Because of lower variable cost, you will have a higher contribution per unit, because at the end of the day, selling price minus variable cost is only contribution per unit. If your contribution is less, if your variable cost is less, contribution will be more. As simple as that. Clear with this, guys? In this case, under the first alternative, lower fixed cost, hence I will go for prepaid plan. So if I am a person who is going to make less than 2000 phone calls, go for prepaid. That will always give you the highest amount of profit. Whereas if you are a person who makes more than 2000 phone calls, go for the option which has a higher contribution per unit, which is nothing but your postpaid plan, because that will give you the highest amount of profit. Are you guys clear with this? And at exactly, if you're going to make 2000 phone calls, whether you go for prepaid or you go for postpaid, both will give you the same amount of profit. Are you guys able to understand? This concept is called as indifference point. So two formulas we saw here. What are they? Indifference point is equal to difference in fixed cost divided by difference in variable cost per unit, or it is nothing but difference in fixed cost divided by difference in contribution per unit. Clearly understand, difference in variable cost, how much is it? 0.5, 0.3. The difference is how much? 0.2. And the difference in contribution, how much? 0.5, 0.7. How much is it? 0.2 only. So obviously when my selling price is the same, the difference in fixed cost, the difference in variable cost is equal to difference in contribution per unit. Are you guys clear with this? Here my contribution was 0.5, 1 minus 0.5. Here what is the contribution? It is 1 minus 0.3. How much is it? 0.7 rupees. Clear with this, guys? Now literally, why did this happen? Simple. From the same 1 rupee, Here I'm subtracting 0.5. Here I'm subtracting 0.7. So literally this difference in contribution per unit of 0.2 is clearly because of this difference, variable cost difference, which is 0.2. So literally guys, the difference in variable cost is equal to difference in contribution per unit when my selling price is the same. Clear with this guys? That's why it can be calculated using two different formulas: difference in fixed cost divided by difference in contribution per unit, or difference in fixed cost divided by difference in variable cost per unit. Are you guys clear with this? So why do we use this indifference point? At the indifference point you can use either of the two alternatives, but if your expected demand or the volume is less than the indifference point, go for that option which gives you the lower fixed cost. Always mention the advantage, right? If your expected volume is more than your indifference point, go for that option which gives you lower variable cost per unit, or you can say in other words higher contribution per unit. Are you guys able to understand? This is all about the concept of indifference point. Now with this in mind, let us go and do one numerical problem. This sum is as per our CA intermediate. It is in our CA intermediate. I have kept it in our solved question bank. This is very much applicable even for CMA paper 8 and paper 12 students. You guys can also use it. It is not something out of syllabus. Absolutely, if there is something that is not applicable, I will clearly tell you. So here the reason why I'm merging the marathon is because this is very much applicable for you guys, right? That is the reason why I'm doing it. But please remember, all our courses and all are separately recorded. Even P8 and P12 I don't merge. Every single thing is separate only. Clear with this guys? On this note, please take our solved question bank. This is in volume 2. This is our solved question bank looks like. This is CA intermediate solved question bank. So you can download all the materials I'm using here. You can download it from our website free of cost. All these things are available, right? In case you want a hard copy, that you can buy. We are just recovering whatever is the printing cost and the courier cost and other things. But if you want, you can even download this free PDF and use it. Now please take this question number 12. It's on page number 412. It's in the volume 2. So please take this question, right? So now let me just read this question. It's a high-end question, high-level question. With this question, the entire concept of indifference point can be covered very, very easily. Now guys, what are they saying? The following are the cost data for 3 alternative ways of processing clerical work for cases brought before LC court system. There is a court like magistrate court or high court. They are saying there are 3 different ways in which they can process some clerical work. Some files are all coming, so they need to process the files. So there are 3 different ways in which they can process the files. One is called as a manual way. Then the second option is called semi-automatic processing. The third one is fully automatic. 3 different alternatives are there. Now what have they given? Particulars: monthly fixed cost, occupancy, maintenance contract, equipment lease. Now if I'm going for manual, there is only one fixed cost, 15,000 rupees. Second alternative, if I'm going, I have 15,000 plus 5,000 plus 25,000. 3 different fixed cost I have. So literally, what is the total fixed cost? Let us keep this as alternative A. We will keep this as alternative B. We will keep this as alternative C. Each of the 3 alternatives tell me how much is the fixed cost. Manual, that is alternative A, fixed cost is 15,000 rupees. Alternative B, how much is the total fixed cost? 15 plus 5, that is 20,000. 20 plus 25, it's going to be 45,000 rupees, right? So it's going to be 45,000. And alternative C, fully automatic, 15 plus 10,000 plus 1 lakh, it's going to be 1,25,000. This is going to be what? The total fixed cost under the third alternative. Fine guys. Now they have also given us the unit variable cost. 1 unit is 1 report. Clear with this guys? Now per unit or per report, what is the variable cost? Here there are 2 different variable costs here. Supplies, labor. Simple, add the 2. Alternative 1, my variable cost is going to be 40 plus 200. How much is this? 240 rupees is my variable cost. Alternative 2, 80 plus 60. How much is it? 140 rupees. And alternative 3, 20 plus 20. How much is it? 40 rupees. Clear with this guys? Now what we need to do, for every alternative we have the total fixed cost, total variable cost. Like that, for each of the 3 alternatives we have the fixed cost, variable cost. Now they are asking, calculate the cost in different points and interpret your results. And part number 2, if the present case load, which means the number of files, is 600 cases and is expected to go up to 850 cases in the near future, select the most appropriate option, that is alternative, on cost consideration. They are saying if I have a total of 600 cases, one case is one unit, so 600 cases means which is the best alternative. Suppose if I'm going to have 850 cases or 850 units is going to be the volume, in that case which is better? Now guys, first of all, in whatever I have taught you till now, we have seen clearly indifference point is nothing but difference in fixed cost divided by difference in variable cost per unit. Sir, we had only two alternatives, sir, but in this particular question, if you see, we have three alternatives. How can we do this question? Now, simple guys, always remember, indifference point calculation can be solved only by taking two alternatives. In this case, what we need to do, we need to take two different alternatives at a time and take up all different combinations. For instance, first, A and B. Calculate indifference point of A and B. Then calculate indifference point of A and C. Then calculate indifference point of B and C. Right? So three different indifference point we need to calculate. AB, AC, BC. Three different indifference point. First we need to calculate. And once we calculate this, then we need to interpret the results. Clear with this, guys? Now, the first part of the question is fairly simple. Calculation of indifference point. So, AB, AC, BC, three different indifference point we need to calculate. Once we calculate this, then, sir, we will be having three different indifference point. With this, sir, what do we do? Right? I will tell you what needs to be done. Clear with this, guys? Let's quickly do this particular question here. Let's quickly do this particular question. Okay, the solution is given here. But anyways, I would like to do this question in detail. So it's going to be, let me just put it up here. This was question number 12, right? So question number 12 from our CA intermediate. Right, guys? Now, so first, let me list out the options we have. Option A, option B, option C. That is your manual, semi-automatic, and fully automatic. Then you have variable cost and you have fixed cost. How much was our variable cost? Now I'm just putting it up here. It was rupees 240, rupees 80 plus 60 was 140, and then rupees 20 plus 20, it was 40, right? Just now we calculated all of this, 240, 140 and 40. And how about the fixed cost? 15,000, 45,000 and 1,25,000. I'm putting it up here. It was 15,000. Then we had 45,000. And then we had 1,25,000. Right? So I think this is what we had. Yes, 1,25,000. Now, what do we need to do? We need to compute the indifference point separately for each of the three different possibilities. AB first, then AC next, then B and C. Right? In whichever order you want, you can calculate. So indifference point for A and B. First I'm doing. Now, guys, we know the formula for indifference point. What is the formula for indifference point? It is basically difference in fixed cost divided by difference in variable cost per unit. So in this case, indifference point between A and B, difference in fixed cost, 45,000 minus 15,000. How much is the difference? It is 30,000 rupees divided by how much the difference in variable cost, 240 minus 140. How much is that going to be? 100 rupees, right? Divided by rupees 100. So how much does it come out to? 30,000 divided by 100. Just remove two zeros. That's about it. It's going to be how much? 300 units. Clear with this, guys? Clear with this, guys? Basically, what is the meaning of that? Now, exactly at 300 units, or in this case, the quote, if it gets 300 cases, whether you go for A or you go for B, both will give you the same result. Suppose if your number of cases is less than 300, go for that alternative which gives you a lower variable cost. Which one? This one. sorry, if it is less than your indifference point, you go for that alternative which gives you a lower fixed cost, which is alternative A. Suppose if your number of cases is going to be more than 300, you'll go for that option which gives you a lower variable cost per unit. You go for alternative B. Are you guys clear with this? This is what we need to do. Yes, we will come back to that later. Next one. Next is indifference point calculation for A and C. Let's do this. Once again, indifference point is equal to difference in fixed cost divided by difference in contribution per unit. Now, A and C. What is the difference in fixed cost? Here 1,25,000, here you have 15,000. The difference 1,25,000, 15. How much is the difference? It is going to be rupees 1,10,000 divided by how much the difference in variable cost? 240. Here you have only 40 here. The difference is going to be 240 minus 40, rupees 200. Or in other words, 1,10,000 divided by 200. How much is it? 550 units. Or in other words, 550 cases is my indifference point. If my expected volume is less than 550, right, you will go for that alternative which gives you a lower fixed cost. Go for A. If it is more than 550, go for that option which gives you a lower variable cost per unit, which is going to be option C. Clear with this, guys? This is the interpretation. Next, we need to calculate indifference point between B and C. This is the last alternative. What is this, guys? What is this? Here, once again, indifference point is equal to difference in fixed cost divided by difference in variable cost per unit. We're talking about what and what? B and C. What is the difference in fixed cost? 1,25,000 and 45,000. How much is the difference? 1,25,000 minus 45 gives you 80,000, right? So it's going to be rupees 80,000 divided by how much is the difference in variable cost per unit? 140 minus 40 is going to be rupees 100. How much is this, guys? It's going to be 80,000 divided by 100. It is going to be 800 units. Clear with this, guys? What is the meaning of that? So if I'm planning to have an output of exactly 800, you go either for B or C. It doesn't make a difference. If your expected demand is less than 800 units, you go for that option which gives you a lower fixed cost. Which one? Go for B. If your expected demand is more than 800 units, go for that option which gives you a lower variable cost per unit. You go for C. This is the interpretation. Now, sir, I have three different alternatives, A, B, and C. Because of that, I have three different indifference points. Now, sir, with this, how can I arrive at a proper conclusion? Now, let me clearly put this on a line and clearly explain what it is. This explanation is not there in your study material also, but based on this only they have arrived at the answer. Now, look at this. Look at this, guys. Now, plot this on, let me plot this on a graphical presentation. The first indifference point is what? 300 units, right? So the first indifference point was at yes, 300 units. Perfect. The next indifference point happens at 550 units. Okay, let me put it up here. It's going to be 550 units. And the next indifference point comes in at 800 units. Let me put it here. It's going to come at 800 units. Now 300 units is the indifference point between A and B, correct? I'm plotting it here. This is between A and B, right? Next, 550 is the indifference point between A and C, correct? A and C. And 800 is the indifference point between B and C. Now, we have plotted everything on this graph. Now, clearly, let us settle the score. Now, sir, 300 units, at 300 units, exactly if my demand is going to be 300, you can either go for A or you can go for B, right? Now, if it is less than 300, now we are just talking about A and B, you will go for what? The one with a lower fixed cost, which is A, correct? So here I will say, if I'm going to operate at less than 300 units, I will go for what? A. More than 300 units, I will go for what? B. Correct? This is the meaning of that, because it has a lower variable cost per unit. D has a lower variable cost per unit between A and B. Next, next is the clash between A and C. At 550 units level, exactly 550 units, sir. Either go for A or you go for B. But sir, below 550, now which one will you go? We're talking about what? A and C. Between A and C, if my volume is less than my indifference point, I'll go for that option which gives me a lower fixed cost. I will go for what? A. Right? So here, less than this, I will go for A as per this indifference point between A and C. So more than 550 units, I will go for C. Why? Because between these two, A and C, it has a lower variable cost per unit. Next, the last indifference point, 800 units, B and C. Now, if my expected volume is going to be less than 800 units, I will go for that option which gives me a lower fixed cost. Between what? Sorry, this is between B and C. B and C. Which one has a lower fixed cost? This one, right? So I'll go for B. Correct? More than this 800 units, I will go for C because it has a lower variable cost per unit. So here I will say go for B. Beyond this, you can go for option number C. Clear with this, guys? Now, this is how each of the three indifference point comes to a conclusion. Now understand one thing. What is the issue here? Less than 300 units, you have only one player. A. Always A is best. More than 800 units, always C is best. There is no problem here. The problem arises only in this region, that is between 300 units to 800 units. Why? Look at this. As per this indifference point A and B, more than 300 units, they have nominated whom? Option B. Whereas, as per this indifference point between A and C, less than 550, they have nominated whom? A. Or in other words, between 300 and 550, which is better, B or A? As per this indifference point, they have nominated B. As per this indifference point, they have nominated A. Sir, which one is better, sir? There's a confusion once again. Correct? Right? Similarly, in this scenario also, as per this indifference point, more than 550, they have nominated C. Here, less than 800, they have nominated B. Which means, sir, for this range, should I select C or should I select B? This is one issue. There is a clash. Right? Now, how will I resolve this conflict? Very simple. Now, first, guys, now for this range we will talk. Who are the nominees for this range? Right? B and A. Correct? The nominees for this range are B and A. Now, guys, between B and A, whatever was the conflict was clearly clarified here only. Right? Between B and A, in this case, this was nominated between A and C. Because of that, A came into this picture. Correct? Now, once again, we are having a conflict between B and A. Go down and check A and B. Between these two guys, where the indifference point clarification happened here. Now, clearly between A and B, we already found out anything beyond 300, B should only come. A should not interfere there because A's territory is below 300. Clear with this, guys? Whenever you have a conflict on the top, go refer between these two where the indifference point was actually calculated. It is calculated here. Now, what does this say? Sir, above 300 units, go for B, not for A. Hence, what I will do in this case, so obviously A will not come in this area, only B will come into picture. Are you guys clear with this? Why this conflict was resolved in this scenario? Once again, don't create a conflict because of another indifference point. More than 300 units between A and B, only B should come. Sir, once again, because of another indifference point, A has come back, sir. No, this area is actually clarified by this fellow. Are you all able to understand this? So only B will come. Next, in this area, the conflict is clashes between where? C and B. So between C and B, where did we compute the indifference point? Where was this conflict resolved? Sir, C and B or B and C, it was actually resolved here, sir. Right? So once again, because of this indifference point, C got nominated here. But as per the indifference point between C and B or B and C, as the case may be, less than 800, if there is a clash between C and B, always B should only come because this conflict was resolved here. So less than 800 units, only B should be nominated. This was clarified as per the indifference point clash between B and C. So here what I will do, C will not come. In this case, once again, B is only selected. Or in other words, if at all you want me to build a range and tell me, sir, when to go for which alternative, I will clearly say this is the final conclusion. What we will say is, if your expected demand or the number of units, in this case, in the court, number of cases, if it is less than 300 cases, always go for option A. At 300 units or cases, you can either go for option A or option B. Now, this itself is not relevant because this entire place is ruled by B, right? Now, more than 300 cases up to less than 800 cases, it is always B. Clear with this, guys? Always, if you check, B will give you the least total cost. At 800 units or 800 cases, you can either go for B or C because both of them will give you the same cost. Now, if your number of cases or volume is more than 800 units or 800 cases, C, it's better to go for C because that will always give you the best, least possible cost. Are you guys able to understand? So in this question, a high level question, why we calculated 3 indifference point and there were a clash between multiple indifference points. So we also saw how to resolve this conflict. Are you guys clear with this? So this is the one line summary of this particular area of this particular question: volume and decision. If your expected volume is less than 300 units, go for A. If your volume is exactly equal to 300 units, you go for what? You go for A or B. If your volume is, I'm putting my volume here, if your volume is greater than 300 units but less than 800 units, right? Then look at this. I'm talking about this range. Sir, 550 will not come. No. What is the point of keeping 550 here? Because less than 550 B, more than 550 once again B. So there is no point at all. So the conflict got resolved here. So this is never one threshold point at all for you. Clear with this, guys? This entire place is ruled only by one particular alternative B. So it's going to be B. Now, if your volume is exactly equal to 800 units, you come here, it is either B or C. And if your volume is expected to be greater than 800 units, always go for this particular alternative. Clear with this, guys? Clearly, if you build the range now, you just name your expected output that will give you the least possible total cost. Clear with this, guys? So with this, one look at this range itself, you will be in a position to come up with the correct answer out of the 3 alternatives, sir. Which one is best? Directly you can say. Now in this question, what have they mentioned? In this question, at present, they have a caseload of how many units? 600 units or 600 cases. Go back here and check here. So 600 means, where does it fall? It falls in this range. 600 falls more than 300 but less than 800. Clearly, option B will give you the least total cost. You yourself can check and calculate. Clear with this, guys? The answer will be that. Look, this is what they have done. Less than 300 cases, it is A. Ideally, it's not correct fully, because at 300 it is either A or B. They have not computed the indifference point. The second one, if you see, 300 to 800 only they have taken. In between, we had this 550 that was not considered. Many students are struggling to understand, sir, why, sir? This is also an indifference point. The conflict resolution is not clearly mentioned in the study material. Final answer they have just given, but clearly understand this is how it needs to be done. Clear with this, guys, right? So look at the range. 300 is one threshold. The next threshold is only 800. Right? And after that, so it's going to be less than 300, at 300, greater than 300, less than 800, at 800, above 800. Clear with this, guys? So now, in this particular question, your answer lies between 300 to 800. Hence, option B, alternative B, will give you the least total cost. Clear with this, guys? So it gives you the least total cost. Present caseload is 600. Therefore, alternative B is best. That's all. Answer is done. That's all you need to write. Suppose, sir, our cases are expected to go up to 850 units. In that case, which one will you go? 850 means above 800. You go for alternative number C. Clear with this, guys? Have a look at this. You go for alternative number C. Clear with this, guys? That's about it. So this is what they have mentioned. As the number of cases expected to go up to 850, alternative C is more appropriate. One look at this range table, you will be in a position to clearly say, sir, this is the output. This is going to be the best alternative for you. If you want, you can check and compute out of the three alternatives, whichever alternative I'm telling you as the answer will give you the least possible cost. Clear with this, guys? But in your study material, as well as in your past exam searched answers, directly they have given this range. Many students struggle to understand how to build the range. Clearly, I've told you right now, this is how you need to build the range by resolving the conflict. Are you guys clear with this? Right? With this, we have completed this particular question. So this I wanted to cover. This is applicable even for CMA students. Please don't think it's not applicable for you. It's a high-end question, one single question. I'm handpicking certain comprehensive questions. I'm doing it so that your entire revision is going to be super comprehensive. So please go and update your library of adjustments. Write down. Please give the cross-referencing and all. Write down indifference point hyphen indifference point hyphen calculation of 3 IDPs for 3 different alternatives, semicolon, range building. So calculation of 3 indifference points for 3 different alternatives, semicolon, range building. We saw the conflict resolution, how to build the range and all that. A very good question to revise this entire concept of indifference point. It has been coming in a lot of exams, past exams as well, both in CA as well as in CMA intermediate level. Clear with this, guys? So with this, we have finished this particular question, and with this we have also quickly revised this entire concept, right? Not quick, in fact we've done in a very elaborate manner as well. Now with this we are done with the concept of indifference point. Now let's move on to the next concept called as volume analysis. Now what is this concept all about? Quickly, I'll just give you guys an example, and with that we will also revise this particular concept of volume analysis. So volume analysis, what is this about? The explanation, everything has been neatly mentioned here. Volume analysis and all, clearly I have mentioned separately. Indifference point, look at this, volume analysis, whatever is the formula mentioned, all these things are here. But how do you arrive? What is the underlying concept here? This is there in our concept decoder for you to understand the logic. I'm quickly recapitulating here. In our courses, we do it in a much more elaborate manner. Since this is a revision, there is a time constraint. Even here, I'm trying to maximize out of the limited time available. Let's quickly get started here. Now, guys, let me just take an example. Our signature style of learning, always we take up examples that, even the complicated things can be easily understood. Now, let us say our selling price is 10 rupees, right? Your variable cost is going to be rupees 6. Your fixed cost is going to be rupees 10,000. Just an example, right? Now, I'm going to prepare an income statement for 2 different levels of output. First, I'm going to prepare an income statement for 5,000 units of output. Then I'm going to prepare another income statement for 7,000 units of output, right? Now, let us take this example. Now, what's your format of income statement and marginal costing? Come on, tell it along. Sales minus variable cost gives you contribution minus fixed cost gives you profit, right? Now, what's going to be your total sales? 10 rupees per unit. So 5,000 units means sales of 50,000, and 7,000 units means 70,000 rupees of sales. What's going to be a variable cost? 6 into 5,000, that's going to be 30,000. And here it's going to be 6 into 7,000, that's going to be 42,000. Right? Next, what's going to be a contribution? It's going to be what? 10 minus 6, 4 rupees is the contribution per unit. So 4 into 5,000, it's going to be 20,000. And here it's going to be how much? So 4 into 7,000, it's going to be 28,000. right? Or you can even say 70,000 minus 42,000. That way also you can arrive. It's going to be 28,000. Next one. Fixed cost in both the cases, it's going to be 10,000, 10,000. Right, guys? Now, what's going to be the profit here? 20,000 minus 10,000, going to be 10,000. And here it's going to be 28 minus 10, it's going to be 18,000. Sir, this is something we know, no, sir. Why are you doing this particular example? I mean, why are you giving all this scenario? Now, one small observation. At 5,000 units level, how much was the contribution? 20,000 rupees. At 7,000 units level, how much was the contribution? 28,000 rupees. My contribution has increased by how much? 8,000 rupees. Correct? My contribution has increased by how much? 8,000 rupees. Now, or in other words, this contribution increase 8,000, right? Now, if you carefully observe, at 5,000 units level, what was your total profit? 10,000. At 7,000 units level, how much was your total profit? 18,000. Now, guys, in this case, your profit has increased by how much? 8,000 rupees. Conclusion, can I say? The difference in profit is purely on account of the difference in contribution. Agreeing with me on this. Sir, overall, my profit increases purely because of the increase in contribution. Absolutely. What do you mean by profit? Contribution minus fixed cost. Here, fixed cost has not changed. So clearly, the change in my contribution is exactly equal to the change in my profit. Are you guys understanding this? Or in other words, can I say the change in profit is exactly nothing but the change in my contribution. Sir, this 8,000 rupees, sir, why it has increased? There's nothing but the contribution. Increase in contribution. Sir, why has my contribution increased? Because, sir, now I am not selling 5,000 units, I am selling 7,000 units. Or in other words, here I have increased my volume by 2,000 units. Or in other words, the contribution pertaining to this 2,000 units is only the increase in my profit. Are you all understanding this? So, guys, one small summary here. The increase in profit is purely on account of increase in contribution. Why is there an increase in the contribution? Because there is an increase in the volume. So contribution per unit remains to be the same, but your overall volume will, because of the overall increase in the volume, sir, for every unit I'm earning a contribution of how much? 4 rupees. Now, from 5,000 units, now I'm jumping to 7,000 units level extra. How many units have I sold? 2,000 units. Every unit extra gave me a 4 rupees of contribution. So 2,000 into 4 extra contribution. How much I earned? 8,000 rupees. That extra contribution itself adds to my profit. Are you guys able to understand this? Are you guys able to understand? Sir, why are we doing this, sir? Why are we doing this, sir? Simple. The difference in profit is nothing but the contribution generated out of the difference in the units, a difference in the volume. Are you agreeing with me on this? If you know this, the entire concept of volume analysis can be mastered. Suppose in exam, they have not given all this data. They have only given you the top line and the bottom line. Sir, what is this, sir? Example, in your exam, they have just given you the scenario, right? They have just given you volume, right? And they have given you, let us say, for example, they have just given you volume, profit. Now, how much is the volume? 5,000 units volume. What is the profit? 10,000 rupees. Now, next, if your volume is 7,000 units, your profit is going to be 18,000 rupees. In exam, let us say this is all they have given. They have asked you to compute the contribution per unit, the fixed cost. This is all they have asked. Or in other words, they have asked you to prepare income statement for 10,000 units volume level. Sir, nothing has been given in this question. How can we calculate? Simple. What you can do is simple. My profit is how much? 10,000. At how many volume? At what volume level? 5,000 units level. If I increase my volume by 2,000 units, my profit increases by how much? 8,000 rupees. or in other words, the 8,000 rupees, the delta profit, the difference in profit is nothing but the difference in contribution, or in other words, this 8,000 rupees is nothing but the contribution generated out of this incremental units of 2,000 units. Or in other words, can I come to a conclusion and say contribution per unit is equal to difference in profit? It is called as delta profit. Delta means what? Difference divided by difference in units, that is volume. Correct? In this case, how much is the delta profit? The difference in profit is how much? So from 10,000 it has increased to 18,000, which means 8,000 rupees is the extra profit, right? This is the contribution generated on account of increase in volume. How much is the difference in volume? 2,000 units. Or in other words, can I say 8,000 rupees is the contribution generated out of 2,000 units. How much is the contribution generated per unit? 8,000 divided by 2,000. This is rupees. 8,000 divided by 2,000. It is going to be how much? Rupees 4 per unit. Are you guys able to understand? Now you got the contribution per unit. Right? With this, you can calculate your fixed cost. Sir, how can we calculate the fixed cost? Simple. We know the marginal costing income statement. Sales minus variable cost is equal to contribution. So we can say, look at this. Contribution minus fixed cost gives me profit. Take any one volume level. Sir, 7,000 units volume level you want to take. Simple. At 7,000 units volume level, what will be the contribution? Just now we computed the contribution per unit. So 7,000 into 4. How much is that? So 7,000 into 4 gives you, so it's going to be 48,000. All right. So you get 48,000. Sorry, 7,000 into 4 gives you 28,000. So sorry guys, 7,000 into 4 gives you 28,000 minus fixed cost gives me, what is the profit at 7,000 units level? 18,000 rupees. Right? So how much the fixed cost? This goes to the other side. I will say fixed cost is equal to 28,000 minus 18,000. It's going to be how much? It's going to be 10,000 rupees. Are you all able to understand? So now with this, we calculated the contribution per unit, we calculated the fixed cost. With this, at any volume level, you can prepare the marginal costing income statement. Suppose they are asking you the question for 10,000 units level, how much is going to be your overall profit? Simple. You just say contribution minus fixed cost gives you profit. What is the contribution? So 4 into 10,000, 40,000 minus fixed cost. Just now we calculated 10,000. You get a profit of how much? 30,000. Clear with this, guys? That's all. So they had just given us the total volume. They had just given us the total profit for two different volume levels, the top line and the bottom line. That is just the top line and the bottom line. If they have given, you can prepare the entire marginal costing income statement for any output level. For this, you need to understand the concept called volume analysis, where here we found out the contribution per unit is equal to delta profit divided by delta units. Sir, why sir this logic? No need to mug up. The delta profit, the difference in profit is nothing but the difference in contribution, and that difference in contribution of 8,000 rupees is nothing but the contribution generated out of the extra units, difference units, that is 2,000 units, which means per unit how much the contribution. We calculated the contribution per unit. With that, we can do all the other calculations and arrive at the fixed cost. Are you guys able to understand this? Are you guys able to understand? Suppose in this question, right, the sales, instead of volume, they have given it in value. Example, I'm telling you, suppose in this question they had given the sales in value, right? So the sales in value here, 5,000 hints of 5,000 units, they have given 50,000 rupees. The profit is 10,000. If my sales is 70,000 rupees, the profit is going to be 18,000. Suppose this data alone they had given. Now what you need to do, very simple. So instead of contribution per unit, I can calculate the PV ratio here. So can I say PV ratio is equal to delta profit divided by delta sales in value. Clear with this, guys? So I can say simple, this 8,000 rupees is the contribution pertaining to the incremental sales. How much was the incremental sales here? So 20,000 rupees of incremental sales. From 50 it became 70,000. Right? So 8,000 rupees is the contribution pertaining to a sales of how much? 20,000 rupees, which means in this case, how much is the PV ratio? I can say the PV ratio is simple, 8,000 rupees divided by 20,000 into 100. It's going to be how much? It's going to be 40%. Are you guys understanding this? You can just play around with the figures. You can literally play around with the figures. So here we saw two formulas. One, contribution per unit is equal to delta profit divided by delta volume, sales in units, or PV ratio is equal to same formula, only instead of units you use sales in value, delta profit divided by delta sales in value. Are you guys able to understand this? Are you guys able to understand this? That's about this area. That's about this area. Fine guys, clear with this? Similar thing you can also do on the cost side. On the cost side, literally the same question they can also give you, right? 5,000 units, 7,000 units are there, right? I will just put it up here. Let us say in the question, this is all they have given, right? So I'll mention it here. Volume and cost. Volume and cost. So what are the two different volumes we have? 5,000 units, 7,000 units, and let us say they are just given cost 40,000 rupees, right? Sir, at 5,000 units level, the total cost is 40,000. At 7,000 units level, the total cost comes out to 52,000. Now, in this case, they are asking us to find out how much is the variable cost, how much is the fixed cost. Will you be in a position to calculate? First, you tell me, is this a fixed cost? No. Why? Had it been a fixed cost, it would have remained constant in total, right? Is this a variable cost? Let us check. Now, variable cost, what is the behavior pattern of variable cost? It remains constant on a per unit level. So 40,000 divided by 5,000, how much you get? It's going to be 8 rupees. Whereas 52,000 divided by 7,000, you get how much? 7.4 something. So literally this is not constant on a per unit level. This is also not constant in total, which means it's a semi-variable cost. It has one component of fixed, one component of variable in it. Now in this case, how will you calculate? How will you arrive at the fixed component, variable component? Very simple, using this formula. Variable cost is equal to difference in total cost divided by difference in the total units. Right? Sir, how will we do that, sir? Simple. If I was selling 5,000 units, what was my total cost? 40,000 rupees. Now, if I increase my volume by 2,000 units, my overall cost increases by how much? 12,000 rupees. Now, why does my cost increase by 12,000 rupees? This cost comprises of variable plus fixed. Now, the increase in cost is purely on account of the variable component, because fixed component will not increase my total cost. Right? Now can I say this 12,000 rupees is nothing but the variable cost pertaining to this extra 2,000 units, right? Or in other words, how much is the variable cost per unit? 12,000 divided by 2,000. This is the variable cost for the extra units of 2,000, which means on a per unit level, how much is it? Delta cost by delta units. Here I will say it is nothing but how much the delta cost here. So the difference in cost is going to be 12,000 rupees. The difference is in units is going to be 2,000 units. It's going to be 12,000 divided by 2,000 units. You get how much? It's going to be rupees 6 per unit, right? Now with this you can calculate the fixed cost. So now how much will your fixed cost be? Simple, take any one volume level. From there, the total cost minus the variable component is going to be your fixed component. So the total cost minus variable cost gives you fixed cost. Now take any one volume level. 5,000 units volume level will take, what is the total cost? 40,000. From that, subtract your variable component. How much the variable component? 5,000 units into 6. So 5,000 into 6 is 30,000. So 40,000 minus 30,000 gives you how much? A fixed cost of 10,000 rupees. Are you guys able to understand? So literally guys, the variable cost is nothing but variable cost per unit is equal to delta cost, difference in total cost, divided by difference in total units. Are you guys clear with this? Are you guys clear with this? Suppose the same thing goes here. The volume, if it is not expressed in units, if they have expressed this in sales, right? If they had mentioned this in sales value, let us say this is going to be rupees 50,000 and this is going to be rupees 70,000. Let us say they had mentioned, when my sales is 50,000 rupees, my total cost is 40,000. When my sales is 70,000 rupees, my total cost is how much? 52,000. In this case, what I will say, sir, this extra 12,000 rupees of variable cost is something that I incur because my sales has increased by 20,000 rupees. Or in other words, this 12,000 rupees is the variable cost attributable to the sales of how much? 20,000 rupees. Or in other words, 12,000 by 20,000. Here you get variable cost ratio. Are you guys able to understand? So here I can say VC ratio is equal to delta cost divided by delta sales in value. Are you all able to understand? This study is called as volume analysis. What we are doing for a change in volume, we are analyzing for the change in volume, the impact it has on your profitability or your cost side. Are you guys clear with this? Literally guys, how did I arrive at this figure? 5,000 units, total cost is 40,000. How did I arrive? Simple. I took the total variable cost plus fixed cost, I added it up and I put it here. Similarly, 7,000 units, what is the total cost? 42,000 plus 10,000, it becomes how much? 52,000. Suppose in exam only this data is given, will you still be able to calculate and do all the workings? Yes, that is what I have just taught you right now. So if you just have the top line and the bottom line, you will be in a position to crack this entire area. So these are all the formulas which we saw here. PV ratio is equal to delta profit by delta sales, or contribution per unit is equal to delta profit by delta units. On the cost side, variable cost ratio is equal to delta cost, difference in total cost by difference in sales value, or variable cost per unit is equal to delta cost divided by delta units. The formula is mentioned here, the logic for that, literally we learned with the help of this particular example. Any sum that comes in this area, you will be able to handle it. Clear with this guys? And that is all about this particular concept of volume analysis. Simple, neat, and that's about it guys. Beyond this, you need not take the pain of mugging up anything, right? This is once again a common concept in your CA intermediate as well as in your CMA intermediate, both in paper 8 and paper 12, right? So with that, we have finished this particular concept of volume analysis, right? So this particular concept is also now over. Now let's go ahead to the next concept called as sensitivity analysis, right? So first we will complete the sensitivity analysis and then we will come back to sales mix. Now guys, this sensitivity analysis, what does this talk about? What does this segment of discussion deal with? Now guys, if you notice in this chapter as of now, we talked about 4 different types of input. That is, there are 4 different factors which can affect our profit. What are these 4 factors? Simple. Selling price, variable cost per unit, right? Then fixed cost, obviously in total, and finally your volume, right? There are 4 different factors which can affect your overall profit, right? Now, which can affect your overall profit. Now, we have studied how these 4 factors impact my profit through certain tools like PV ratio, right? Your break-even point, your margin of safety. Literally, guys, this is a summary of what we have learned till now. Literally, marginal costing is all about studying how these 4 different inputs can impact your profit through these 3 tools called as PV ratio, break-even point, and margin of safety. Now, in this concept, sensitivity analysis, what we are going to revise is that now, keeping the out of these 4 variables or the inputs, let us say I am keeping these 3 inputs constant, I don't change it. Suppose if I increase or decrease my selling price alone, keeping my variable cost per unit, fixed cost and volume unchanged, how is it going to impact my profit is the study called as sensitivity analysis, or in other words, the study of change in impact or the study of change in one variable while keeping the other variables constant and how it impacts my profit is called as sensitivity analysis. Literally guys, this is what I would have mentioned even in our concept decoder. Sensitivity analysis is a study of rate of change in one variable with respect to change in another variable, keeping the other variables constant. Sir, what is this? Quickly, I will just give you guys a practical flow chart and a practical case scenario. It's not a case scenario basically. So I will open up and I will show you a practical flow chart. With this, you will have a crystal clear clarity. Now, sensitive. What do you mean by sensitive? We say my friend is very sensitive. Means what? While other things being constant, suppose if one thing alone happens, how he or she reacts to that is called as sensitivity. Right here, let us say I don't change my variable cost per unit, I don't change my fixed cost, I don't change my volume. Suppose selling price alone, if I increase, how is it going to impact my profit? Will it increase or decrease my profit? We will study the impact of increase in selling price through the impact it has on PV ratio, break-even point, margin of safety. Suppose I keep the other three things constant, variable cost alone I increase, how it impacts my profit? This is a study of sensitivity analysis. Now, no problem. Let me just open this chart and show it to you. Now we will do it together, and this way entire thing we will be completely finishing it off. Now guys, now what are the three tools that we study in this particular chapter? Basically, I told you PV ratio, break-even point, and margin of safety, right? Perfect. Now, one second. Yes. Now, look at this. Let us say I am keeping everything constant. Selling price alone, what I do, I am increasing. For example, let us take the same example which we saw. Selling price at present is 10, variable cost is 6, which means contribution per unit is going to be 4, right? Let us say my fixed cost is going to be 10,000 rupees. 10,000 rupees. Yes. In this case, what is going to be my break-even point? My current break-even point is going to be how much? 10,000 divided by 4. It is going to be 2,500 units, right? At present, my volume, let us say, is 6,000 units, which means at present, my margin of safety is how much? 6,000 minus 2,500, which is going to be 3,500 units. This is my current data which I am presenting it to you. Now, let us say I don't change my variable cost per unit, which means my contribution is also remaining. My contribution will not change because of variable cost. Fixed cost I'm not changing. Let us say the total volume I'm not changing. Selling price alone, let us say I am increasing. Now, what happens to my PV ratio? At present, what is the PV ratio? 4 by 10 into 100. 40% is my current PV ratio. Example, suppose if I change my selling price, if I increase my selling price to 12 rupees, variable cost continues to be 6, which means my contribution per unit becomes how much? 6 rupees, right? So now what is the PV ratio? 6 divided by 12 into 100. Obviously PV ratio becomes 50%. Or in other words, if I do not change the other three variables, an increase in selling price will actually increase my PV ratio, correct? It will increase my PV ratio. Now, what impact will it have on my break-even point? Simple. Now, every time I'm selling one unit, right, obviously I am able to generate more contribution. In this case, now I will be able to recover my entire fixed cost quickly. Guys, clear with this? Which means my break-even point will reduce. Are you guys clear with this? Right? So in this case, my break-even point will reduce. Why? Because I've increased the selling price. Every time I sell one unit, I will be able to generate more contribution, which means that in this case, now I will be able to recover the same fixed cost. Now, how much is the fixed cost? 10,000 rupees. Every time I sell one unit, I will generate 6 rupees. So literally, if you see 10,000 divided by 6, you get your break-even point is 1,666.66 units or 1,667 units. Earlier, it was taking me 2,500 units to actually recover 10,000 rupees. Now it only takes me 1,667 units to recover the same 10,000 rupees. Or in other words, every time I sell one unit, I require more contribution, which means it takes lesser time for me to actually recover the entire fixed cost. My break-even point is less. It drops. Clear with this, guys? Now, what happens to margin of safety? Simple. My total volume remains unaffected, 6,000 units, but my break-even point is now reduced, which means the balancing figure, the number of units sold over and above my break-even point, it's obviously the balancing figure. So this will increase. Are you guys clear with this? So my margin of safety increases, and when my margin of safety increases, margin of safety is nothing but profit generating sales. Obviously my profit increases. Are you guys clear with this? So the impact of change in one variable, right? So what impact it has on my profit, we are studying through these three tools called as PV ratio, break even point, and margin of safety. This study is called as sensitivity analysis. Are you guys clear with this? That's all it is, guys. So an increase in selling price, what will happen? So it increases my PV ratio. So now, because my contribution per unit will increase, now what happens? Since every unit gives me more contribution, I'll be able to recover the entire fixed cost quickly. So my break-even point will fall. Now, volume remains unchanged. Break-even point reduces. The balancing figure, which is basically my margin of safety, will now increase. And when my margin of safety increases, profit will automatically increase, because after all, margin of safety is nothing but your profit generating sales. Are you guys clear with this? Similarly, suppose there is a reduction in your selling price. In this case, what happens? Think and answer. Now, my selling price reduces. Let us say here, instead of 10 rupees, my selling price becomes 8. Variable cost continues to be 6, which means contribution per unit is 2 rupees, right? So now obviously my PV ratio falls 2 by 8 into 100, which is 25% only. Obviously, guys, my PV ratio will fall. Now, what happens to my break-even point? Every time I sell a unit, now I'm generating lesser contribution. It means I will take more time to now break even. So break-even point increases. Now, what happens to margin of safety? Total number of units sold, volume is same, but break-even point has increased, which means now the balancing figure, margin of safety, will fall. And when my margin of safety falls, what happens to your profit? The profit also drops. Are you guys clear with this? That's all it is. That's all it is. Next, now let's go to the second variable. What is the second variable? The second variable is your variable cost. The second input factor is variable cost. Suppose other things remaining constant, I am increasing my variable cost. Visualize. Now, selling price is same. Variable cost I am increasing. If I increase my variable cost, what happens to my contribution per unit? My contribution per unit will fall. So when my contribution falls, obviously my PV ratio will fall. Clear with this, guys? Now, every time I sell a unit, I am generating lesser contribution, which means now it takes more time for me to recover the entire fixed cost. So break-even point will increase. Are you guys clear with this? Now, volume is same. Break-even point is more, which means the balancing figure, margin of safety, will fall. If my margin of safety falls, my profit will also fall. Are you guys able to understand? An impact which a change in one variable has on my profit is studied through these three tools called as PV ratio, break-even point, margin of safety. This study or analysis is called as sensitivity analysis. Now you guys are getting it? Right. Now, the other one, next one. Suppose other things remaining constant, variable cost reduces. Now, per unit variable cost reduces. In this case, what happens? Selling price remains the same. Variable cost reduces, which means my contribution will increase. When my contribution increases, PV ratio will increase. Right now, every time I sell a unit, I'm able to generate more contribution, which means now I will be able to recover my entire fixed cost quickly. So my break-even point falls. Volume is the same, but my break-even point is less, which means my margin of safety balancing figure will now start to increase. So margin of safety is more. When my margin of safety is more, my profit will also increase. That's all, guys. That's all. It is very, very, very simple. Next one. Next one. Now, what is the third variable we've got? Fixed cost. Now, carefully think. Suppose other things remaining constant. Sir, selling price per unit, I'm not changing. Variable cost per unit, I'm not changing. Fixed cost alone, let us say I am increasing. First, you tell me what will be the impact on PV ratio. What is PV ratio? Contribution per unit divided by selling price. Now, fixed cost I am increasing. Because of this, will my PV ratio change? Absolutely not. So, with respect to my PV ratio, there will be no change at all. Now, what happens to my break-even point? Sir, every time I'm selling 1 unit, contribution per unit remains to be the same. But suddenly, fixed cost alone is more. Now, break-even point is fixed cost divided by contribution per unit. Now, in my break-even point, now what happens? The numerator, fixed cost has increased, which means I need to recover more amount right now. Obviously, because of this, what happens? So now I take more time to recover because right now the fixed cost has increased. Are you guys clear with this? So my break-even point increases. Now what happens to total volume remains to be the same, but break-even point has now increased, which means the balancing figure, margin of safety, now reduces. Are you guys clear with this? This is all it is. Now, exactly the opposite of this. Suppose my fixed cost falls down. What will happen in this case? If my fixed cost falls down, now what happens to PV ratio? No change, because PV ratio is nothing but contribution divided by sales, right? Contribution per unit divided by selling price. This will not, fixed cost will not impact my PV ratio. But what happens to my break-even point? Now I need to recover only lesser amount as fixed cost, which means now the break-even point will fall, because now by selling lesser number of units, the entire fixed cost can be recovered. Volume is same, your break-even point is reduced, which means now the balancing figure, margin of safety, will increase. When my margin of safety increases, my profit will automatically increase. Are you guys clear with this? The last one, which is your volume. The last one, which is your volume. Now, other things remaining constant. So, selling price per unit, I'm not changing. Variable cost per unit, I'm not changing. Fixed cost in total, I'm not changing. Volume alone, I am increasing. Now, think and answer. What will happen to PV ratio? Absolutely no change. Why? Because obviously PV ratio is what? Contribution per unit divided by selling price. Now, on a per unit level, the contribution is not changing, right? My selling price is not changing. Even variable cost is not changing. Obviously, here the PV ratio will remain unchanged. Guys, correct? Now, what happens to my break-even point? Break-even point is fixed cost divided by contribution per unit. Now, fixed cost is not changing. Contribution per unit is also not changing, which means even my break-even point will not undergo a change. But now, wow, what happens to my margin of safety? Now, volume alone has increased right now. Let us say now, instead of 6,000 units, I am selling 8,000 units. Now, what happens? Now, what happens, guys? Break-even point remains to be the same 2,500 units, but volume alone has increased, which means the balancing figure, margin of safety alone, increases. Are you guys clear with this? In this case, your increase in volume will only impact what? Your margin of safety, and because of this, automatically you will be able to generate more profits. Are you guys clear with this? This is all it is. Suppose my volume drops, what will be the impact on PV ratio? Absolutely nothing, right? Break-even point, nothing. Why? Break-even point is fixed cost by contribution per unit. Numerator, denominator remains unchanged. What happens to my margin of safety? Now, break-even point is the same, but the total number of units sold is less. Because of this, the balancing figure, margin of safety, falls. Clear with this, guys? This is why generally they say if you sell more number of units, overall profit will increase. Why? Purely because break-even point is a point. Anything excess sold in excess of the break-even point is going to be margin of safety. So if the volume increases, margin of safety will increase. The volume decreases, margin of safety will reduce. Because of that, the profit will increase or decrease, as the case may be. This will not impact your break-even point and other things. Are you guys clear with this? This study is called as sensitivity analysis. If you put this arrow and study, this entire area you'll be able to master, and that's about this area, guys. Clear with this, guys? So literally what we have seen, your profit can be impacted by only these four variables, and what we have seen is a change in any one of these four variables will impact your profit, and we studied the impact of the change in any one of these four variables or inputs through PV ratio, break-even point, and margin of safety. And this entire study is popularly called as sensitivity analysis. As simple as that. Clear with this, guys? Now, we will just go and solve one numerical problem. Once again, we'll be doing this from our CA Inter solved question bank. It's in volume number 2. So please go to question number 15A. Please go to question number 15A. I just want to take this. Yes. Right. Now look at this. This was, I think, I'm not sure if this was a past exam MTP question or an RTP question, but somewhere it was once asked. By noting PV ratio will increase or PV ratio will decrease or PV ratio will not change, as the case may be, state how the following independent situations will affect my PV ratio. They are asking independent, they have asked about 10 scenarios, right? In each of the scenario, just they have asked for the impact on the PV ratio, nothing more. Conceptually you learn, please do not mug up anything, try to attempt it, and that's about this particular question. First, how will your PV ratio be affected? Will it increase or will it decrease or will there be no change? Right, this is what they have asked, right, in each of the following situation. Number one, an increase in the physical sales volume. Now, if I increase my physical sales volume, how will it impact my PV ratio? Now, we all know PV ratio is nothing but contribution divided by, or contribution per unit divided by selling price, right? Now, if there is a change either in the numerator or the denominator, only then PV ratio will change. Now, first, an increase in the volume. Now tell me, will it impact my PV ratio? Absolutely not. We just saw an increase or decrease in the volume will only impact my margin of safety. Nothing else will be impacted. Guys, correct? So in this case, what happens? An increase in the physical sales, it will not impact my, there will be no change. It will not impact what? It will not impact my PV ratio. Look at this. My PV ratio will not change. The ratio of sales value and the variable cost will remain the same irrespective of the change in the sales volume. Obviously, what happens? My numerator denominator does not change. Now, how will my PV ratio change? The next one. If there is an increase in fixed cost, will this change? Will this impact my PV ratio? Absolutely not. This will only impact your break-even point. When your break-even point gets affected, the balancing figure, margin of safety, will also get affected. Definitely, this will not impact your PV ratio. No change. Clear with this? Why? Because obviously here in the numerator or the denominator remains unaffected, right? Contribution per unit is not changing. Selling price per unit is also not changing, right? So obviously in this case, what happens is that your PV ratio will not change. Clear with this, guys? There will be no change. Next one, a decrease in the variable cost per unit. Now, if my variable cost reduces, what will happen? My contribution per unit will increase. Guys, clear? So because of that, obviously my PV ratio will now start to increase. Clear with this? Now look at this. PV ratio will increase. Are you guys clear with this? This is what we have studied in a chart format. Now they're asking this. Easily you will be in a position to answer. The next one, a decrease in contribution margin. Now obviously if my numerator reduces, contribution per unit reduces, what happens in this case? Obviously my PV ratio will also fall. Look at this. PV ratio will decrease. Next situation, an increase in the selling price per unit. Now if my selling price per unit has increased, what will happen? Because of this, contribution per unit will increase. If my contribution per unit increases, obviously my PV ratio will also increase. Now look at the fifth one, PV ratio will increase. Then a decrease in the fixed cost. Fixed cost will not impact my numerator or my denominator, hence my PV ratio will not change. No change here. Question number 6, no change. Next, a 10% increase in both the selling price and the variable cost per unit. Now in this case, now they are not changing one variable, they are changing two variable. How can you answer? You should take a scenario and do it. For example, selling price, variable cost, and then your contribution per unit. At present, let us say 10 minus 6 is equal to 4. What have they said? A 10% increase in both the selling price and the variable cost. 10% in selling price will be what? So 10 plus 1, it is going to be 11. Variable cost, 10% increase. What is this? 6 plus 10% of 6 is 0.6. So it's going to be 6.6. What will happen to the contribution per unit? So 11 minus 6.6 gives you 4.4. So what is the PV ratio at present? 4 by 10 into 100, it's 40%. Here it's 4.4 divided by 11 into 100. Once again, it's going to be 40%. Now, here what happens? There is no change when there is exactly a 10% increase in both the selling price as well as the variable cost per unit. You can take any one fact, any one figure. Right here, model data you can take. On that you can increment and apply the change and check it out. So here there will not be any change. Clear with this, guys, right? This is what you can just go ahead and update. Next one, a 10% increase in the selling price per unit and a 10% decrease in the physical sales volume. First one, understand here also two inputs are changing. One is an increase in selling price, the other one is increase in the volume. Now, first of all, understand, there is a decrease in the volume. Any change in the volume will not affect my PV ratio. So the only impact here is on the selling price per unit. Clear with this, guys? Now, a 10% increase in selling price. What will happen here? Now, if my selling price increases by 10%, obviously my contribution will also increase, and because of that, my PV ratio will only increase. This will not have an impact on PV ratio. This will have an impact on profit. Here in this question, they have only asked for the impact on PV ratio. So my PV ratio will increase. That too, it's purely only on account of what? An increase in your selling price. So point number 8, look at this. PV ratio will increase. Clear with this, guys? The increase in selling price will increase the contribution margin, but the change in volume in any direction will not affect the PV ratio. You should write the reasoning in exam. How will you write it? Just visualize whatever chart which we did, and this is more than sufficient for you to crack these kind of questions, right? Thus, an increase in selling price will decrease your sales volume. With the decrease in sales volume will only increase your PV ratio. Anyways, decrease in sales volume will never affect your PV ratio. So the increase in PV ratio is purely on account of increase in your selling price. The next one, a 50% increase in a variable cost per unit with a 50% decrease in the fixed cost. First of all, understand, a change in fixed cost will not impact your PV ratio. It will impact your overall profitability by way of break-even point and all that. But here in this question, they have only asked for the impact on PV ratio. PV ratio will get impacted in this case only on account of change in the variable cost. Variable cost is increasing. So if my variable cost increases, selling price remains constant, contribution per unit will decrease. When my contribution per unit decreases, what happens? My PV ratio will also fall. So point number 9 here, PV ratio will decrease. Are you guys clear with this? Logically think and answer. That's all it is. An increase in the angle of incidence. Oh, what do you mean by angle of incidence? I will tell you. Very simple. This is actually presented in a graphical format. I will tell you here. 1 second. Now, look at this. This is basically your break-even chart, right? Where here on the y-axis you have rupees, and on the x-axis you have the number of units. Now, simple. As you increase the number of units, this is your variable cost line. What is this variable cost line? Now, if I produce 0 units, variable cost is also 0. That's why it starts from here. If I slowly increase the number of units, parallelly my variable cost will also increase. Clear with this, guys? Right? Now, ideally speaking, here you have a fixed cost line. All these things you would have studied in your foundation or even in your school days economics. Fixed cost line is flat. It will not change with the number of units, right? Let us say fixed cost is 2 lakh rupees, 200,000. Now, if I produce 0 units, still I will be incurring fixed cost alone. That's why your total cost basically is nothing but fixed cost plus variable cost. This line starts from here and it slowly increases, right? Here, this is your fixed cost line. Any increase in volume will not impact your fixed cost. So your total cost alone, what happens? Increases, because parallelly your variable cost line is here, and parallel to this variable cost line you'll be having the total cost line, because total cost is fixed cost plus variable cost. That's why it is running parallel here. Now what we need to do here, this is your total cost line, basically your fixed cost plus variable cost. This is your sales line, right? Sales line, basically it starts from 0. So if I don't sell any units, my revenue is 0. If I keep on increasing my units, obviously my turnover will also increase. Now what happens, guys? This is going to be my sales line. This is going to be my cost line, total cost. Now break-even point is a point where my total sales is equal to total cost. Only in that case, exactly I will be earning a profit of 0, right? So this is my break-even point, right? Now, if you notice, this is going to be my sales line, right? Now, if you notice, below the break-even point, my cost is always greater than sales. This is the reason why you are reporting a loss. At the break-even point, my total cost is equal to total sales. Hence, there is a zero profit or zero loss. And above this break-even point, my sales, right, is greater than my total cost. Hence, above the break-even point, you are always making a profit. This is a graphical presentation. Now, from the break-even point to above, there is an angle that has been generated here, right? This angle is called as angle of incidence. Simple, guys. Now, if the angle is wider, if this angle is wider, obviously it means the difference between my sales and cost is more, or in other words, my profit is more. So, if this angle is more wider, let us say if the angle is like this, then what happens? The difference between my total sales and total cost will be more, and it indicates a more profitability. Or in other words, if there is an increase in the angle of incidence, my profit will increase. Are you guys clear with this? If there is a reduction in the angle of incidence, in that case my profit will reduce. So this is something that you need to understand in a graphical presentation. So now in this question, if you notice, they have asked what will happen, what will be the impact on PV ratio if there is an increase in the angle of incidence. An increase in the angle of incidence indicates that the company is earning at a higher rate, or in other words, there will be an increase in your PV ratio. This is all you need to know. Are you guys clear with this? This is once again logical, provided you know this particular graphical format, and as simple as that. So here we've seen, so my PV ratio will only increase if there is an increase in my angle of incidence. Angle of incidence represents the rate of profit earning after reaching the break-even point. Just now I taught you, right? And increase in the angle of incidence means the rate, there is an increase in the rate of profit earning, which is nothing but the PV ratio that contributes towards the profitability after recovering your fixed cost. Are you guys clear with this? So this is all about it. 10 different scenarios, right? We have just learned it. I mean, we have just revised all these things with a conceptual revision of sensitivity analysis. Now, for this particular question, I request you to please go and update your library of adjustments. So please go ahead and update, write down sensitivity analysis, sensitivity analysis hyphen impact on PV ratio in 10 different situations. In 10 different situations. An excellent question to summarize and revise the entire concept of sensitivity analysis. So this is once again logical. Now, please do not mug up. If you are a person who's been mugging this up, I've just proved it to you how simple and effective you can revise this entire area. Just we have studied conceptually. In fact, in the marathon itself, I have done one numerical problem, right? That's about it, right? In our batches, in our regular or EVO batches, we'll be doing a few more numerical problems. But here, since this is a marathon and I didn't want to miss this question also, so one full-fledged question we are solving, right? So with that, we have completed this particular concept of sensitivity analysis. So this particular concept of sensitivity analysis is now over. Now let's move. Sorry, there was an issue with the mic. So I'll just repeat this area again. So now we are going to get started with the next concept called as sales mix in marginal costing. Now, till now, in sensitivity analysis, we have learned that these four variables or inputs, namely your selling price, variable cost, fixed cost, and volume, these four variables or inputs will only impact your profit. A change in any one of these four inputs is only going to impact your profit. But now, in this next segment of discussion, which is sales mix, we will learn that ideally there is one more fifth input factor called as your sales mix, which will also impact your profitability. Now, let me take the heading here, sales mix and marginal costing. Now, guys, now let me take an example of BMW. Now, as you guys know, BMW is in the business of manufacturing car as well as bikes, right? Now, let me take an example here. Now, I am taking 2 years. Let us say in the year 2025 and in the year 2026, right? Now, between these 2 years, BMW did not change the selling price of bike and car. They did not change the variable cost per unit of their products, bikes and cars. They also did not change the fixed cost. It was also constant. And for your information, the volume was also constant. That is, in the year 2025, they sold a total of 1 lakh units. This 1 lakh comprises of, let us say, 60,000 cars and 40,000 bikes. Now, in year 2026 also, they sold 1 lakh units. So here, the volume did not change, but the composition, that is the sales mix alone changed. Here, if you notice, they sold 40,000 cars and 60,000 bikes. So guys, if you notice here, selling price did not change, variable cost did not change, fixed cost did not change, even the total volume did not change, but the composition of the total volume, basically the sales mix alone changed. Now you tell me, the profit reported in 2025 and the profit reported in 2026 will definitely be different. Why? Sir, the four inputs we saw did not change, sir. Still, why was there a change in the overall profit? This was purely because of the change in the sales mix. Or in other words, sales mix represents the composition of the different products that the company is dealing in. Till now, whatever we have learned is all about a concept of all this marginal costing in case the company deals only in one product. But in real life, companies deal in more than one products. Now, in case when company deals in more than one product, in that case, there is a fifth factor which affects your profitability, which is called as sales mix, right? This is something that is very, very important. Now, guys, in this particular scenario, how do we apply the concepts of marginal costing is the study in this scenario called as sales mix. Now, the most important factor here is regarding calculation of break-even point. Now, guys, we all know break-even point formula. What is the formula to calculate break-even point? It is going to be fixed cost divided by contribution per unit, right? Now, there is a common fixed cost, right, that needs to be recovered by way of generating contribution, right? So fixed cost divided by contribution per unit. Now, let us say the company deals in two products, A and B. Now, in the denominator, should I take the contribution of product A or should I take the contribution of product B or should I jointly take the contribution of A as well as B is the study in this particular scenario. Or simply in other words, now there is a common fixed cost which is incurred right, towards production on sales of two products. In our example, two products. A company can also have three products or any number of products. Now, this fixed cost has to be jointly recovered by both the products put together. In this case, how will you compute the break-even point? And all these things are the subject matter of discussion in this particular scenario. Now, without any further delay, now let's go and take up one numerical problem with the example of, with the help of this particular numerical problem. We will clearly be able to understand the concept of sales mix, and it's a good sum to revisit or revise this entire concept of sales mix, right? So now please go to your solved question bank, CA intermediate solved question bank, and please take question number 19. Question number 19. See, our question bank is comprehensive. Every single question from our study material, right, past exam, RTPs, MTPs, everything has been covered. Beyond this, you don't need any other thing, right, in your exam preparation. Beyond this, there is nothing more do we need. You need, because everything I have compiled it in a single place, right? That two similar questions I've grouped and all. You can see the color pattern. For example, it is 18C. So 18 is the main question. A, B, C and all are questions which are similar to question number 80, something like that. So right, so here you have MTP2, every single thing has been included here. So now please take question number 19. This is about your sales mix. Now the following set of information is presented to you by your client AB Limited, producing the two products X and Y. Now what have they mentioned? Product X, product Y, right? Direct material, direct wages, the cost is given for each of the two products. The fixed expenses during the period was 1600 rupees, right? The variable expenses are allocated to the product at the rate of 100% of direct wages, and the selling price is given as 40 rupees and 30 rupees each, right? Now there are two products X and Y. What is the selling price? 40 rupees and 30 rupees, right? Now what is going to be my total variable cost? Now for product X, literally, if you see, we have 20 rupees direct material, 6 rupees wages, and 100% of direct wages is variable overheads. So another 6 rupees we have here. So literally 20 plus 6 plus 6 comes out to how much? 32 rupees, right? So it's going to be 32 rupees is the total variable cost of product X. Similarly for product Y, 18 material, 4 rupees is your direct wages, and 100% of direct wages, that is another 4 rupees is your variable overheads. If you add this up, how much you get? 18 plus 4 plus 4. So you basically get 26 rupees, right? This is going to be your total variable cost of product Y. So literally the contribution per unit of X is going to be 40 minus 32, 8, and contribution per unit of Y is going to be 30 minus 26, which is going to be 4 rupees, right guys? Now in this scenario, they have asked the proposed sales mix scenario number 1. Let us say they are selling 100 units of X, 200 units of Y. What will be the profit? Scenario 2, 150 units of X, 150 units of Y. What will be the profit? Scenario 3, 200 units of X, 100 units of Y. What will be the profit? You need to compute. The total fixed cost is 1600. Now you tell me 100 plus 200, overall volume is 300 units. 150 plus 150, overall volume is 300 units. 200 plus 100, overall volume is 300 units. Here in these three scenarios, volume is not changing, but the composition, mix alone we are changing. Clearly because of that, what happens? Your profitability will change. Why? Because X is a more profitable product. 8 rupees contribution you get for every unit of X. Y, you get only 4 rupees. So obviously in that mix, if you are selling more of units X, obviously the overall profit will be high. Are you clear with this? Right? This is how it works here. Right? So in each of these scenario, you need to compute the profit. Nothing great. Number of units multiplied by the respective contribution per unit, you'll get the total contribution. From that, subtract your overall fixed cost, you will arrive at your profit. This is not the great thing. The most important thing is with respect to calculation of break-even point. Now this also, the first part I will quickly do, and with that this will be over. Now look at this, the contribution per unit we have done. Suppose I am selling 100 units of X, 200 units of Y. What will be the total contribution here? 100 into 8, I get 800. plus 200 into 4. How much is 200 into 4? That is once again another 800. So literally the total contribution will be 1600 minus your fixed cost, that is also 1600 rupees. So literally you will be left with a zero profit. Clear with this, guys, right? So that is the first situation here. Look at this, 100 into 8 plus 200 into 4, that gives you 1600 rupees contribution minus fixed cost 1600, you get a zero profit. Suppose I'm selling 150 units of X, 150 units of Y. Simple, 150 into 8 plus 150 into 4. So 150 into 8 gives you how much? It gives you 1200 rupees, and 150 into 4 gives you 600 rupees. So overall, you get a contribution of, so 1200 plus 600 is going to be 1800 minus your fixed cost of 1600. It gives you a profit of 200. See, the overall volume didn't change, but just because of the change in the mix, what happens? Your profit is changing. Clear with this, guys? This is not the big deal here. Now, the most important part is calculate the break-even point when the sales mix is 2:1. Now, in this case, now how will we actually calculate the break-even point? This is the most important part of calculation in this entire concept of sales mix. Quickly, we will revise. So now, what is going to be my sales mix? It is going to be 2:1. Now, each of the two products we have got here. Now, let me put it here. We have two products here. What are the two products? Product X and product Y. Now, how much is the contribution per unit of X? 8. Y is going to be 4. 8 and 4. This is going to be my contribution per unit. And what have they given? The sales mix is going to be how much? It's going to be 2:1. So the sales mix is going to be 2:1. Which means what? Sir, every time you are selling 3 units, 2 units come from product X and 1 unit comes from product Y. So for every 3 units sold, 2 units are X and 1 unit is product Y. Clear with this, guys? Now, in this case, we need to compute the break-even point. Now, what is the formula for break-even point? Fixed cost divided by contribution per unit. Now, in this case, will I take the contribution per unit of X or will I take the contribution per unit of Y? Ideally speaking, we should take the contribution per unit of both X and Y. Sir, how will we do that? Very simple. Now, you guys tell me 2:1 is the sales mix, which means for every 3 units sold, right? Now, can you tell me what is the total contribution? Simple, sir. If I sell 3 units, right, 2 units will come from product X, 1 unit will come from product Y. So, 8 into 2 plus 4 into 1. Are you clear with this? 8 into 2 units plus 4 into 1 unit. This will be the total contribution generated for 3 units. So on an average, the weighted average contribution per unit will be how much? Divided by 3. So this is the total contribution for 3 units. If you divide it by 3, on an average, what is the contribution per unit? You can calculate. Guys, clear with this? So how much does it come out to? So 8 into 2 is 16 plus 4 into 1 is 4 divided by 3. So 16 plus 4 is 20. So 20 by 3 comes out to how much? 6.6666. It keeps on going. Or in other words, you can also say, sir, this is nothing but weighted contribution per unit. Actually, we call it as weighted contribution per unit because in this case, this fixed cost is going to be recovered jointly by these two products. Hence, I will have to consider the contribution per unit of both the products. Hence, we don't take the contribution of X or we don't take the contribution of Y. We take the weighted contribution of X and Y. Or in other words, we can also say the weighted contribution can be calculated as follows. So what is product X's contribution per unit? 8. I can say 8 into 2 by 3, that is a sales mix, plus 4 into 1 by 3. This way also you can calculate. The same thing can be rewritten as 8 into 2 by 3 plus 4 into 1 by 3. Are you guys clear with this? This way also you can calculate and show it off. Not a problem. Ideally, this is nothing but weighted average, weighted contribution per unit. Now, in case when a company manufactures more than one products, ideally speaking, the formula for calculating the break-even point is nothing but fixed cost divided by weighted contribution per unit. Are you guys clear with this? So in this case, how much the weighted contribution per unit? 6.6666. So now in this case, you tell me what is going to be your break-even point? My break-even point is equal to, how much is my fixed cost? My fixed cost is going to be 1600. We saw that. The rupees 1600 divided by, what is the weighted contribution per unit? 6.6666. So retain the decimals in your calculator. So it's going to be 1600 divided by 6.6666. You get 240 units. So if I have a total volume of 240 units, I will be able to recover my entire fixed cost of 1600 rupees. I'll be left with no profit or no loss. Now you tell me, is this 240 units of X or units of Y? It is jointly units of X plus units of Y. Now what we need to do, this 240 units, split it into two. So how many units of X, how many units of Y? We know the sales mix. Generally when the company is selling, they will always have the sales mix as 2:1. So which means, so 240 into 2 by 3 will be the number of units of X. 240 into 1 by 3 will be the number of units of Y. So 240 into 2 by 3, how much is that? It's going to be 160 units. 240 into 1 by 3, it's going to be 80 units. Or in other words, if I sell 160 units of X and 80 units of Y, I will be able to break even. That is going to be, I will be able to recover my entire fixed cost of 1600 and I'll be left with no profit or no loss. Are you guys clear with this? This is the way to compute your break even point when you have sales mix, when you have more than one product for the company and the sales mix ratio is given. Are you guys clear with this? So when a company is having more than one product, in this case, how do we compute your break-even point? Break-even point is equal to fixed cost divided by weighted contribution per unit. How do you compute weighted contribution per unit? The respective contribution per unit multiplied by weight of that particular product. Are you clear with this? As simple as that. Or you can also say total contribution divided by the total number of units in that particular mix. Are you guys clear with this? It's absolutely logical. Nothing needs to be mugged up here. And this is exactly what I've solved and showed here in this particular solution. Look at this. All these solutions I have improvised, right? So this is not as it is in the study material. It's not a copy paste. This entire question bank, we have revamped it, and literally the presentation also, just like how I've done here, I've presented it. So basically it's going to be 240 units. Ideally this is wrong. It has to be 240 units. Right? So 240 units. So 2/3 and 1/3. Ideally, when the company sells 160 units of X and 80 units of Y, it earns zero profit. That's going to be your break-even point. Are you guys clear with this? Right? This is the most important learning objective here. Suppose if there is a change in your sales mix, accordingly, what happens? Recalculate the break-even point when the sales mix is 1:2. Very simple. Now suppose it is going to be 1:2. Right? So what happens here? Instead of 2:1, it's going to be 1:2. Then what do you do? Recalculated the weighted contribution per unit. So weighted contribution per unit is equal to 8 into 1 by 3 plus 4 into 2 by 3. Correct? Because 1:2 right now. Right? So 8 into 1 by 3 plus 4 into 2 by 3. Now once again, you need to compute. Quickly, let me do this here. Product X, product Y. What is the contribution per unit? Just now read it here, 8 and 4. So rupees 8, rupees 4. The sales mix is going to be 1:2, which means the weighted contribution per unit is going to be 8 into 1 by 3 plus 4 into 2 by 3. Alright, so how much is this going to be? 8 by 3 plus 4 into 2 is 8. So 8 by 3. Right? Or in other words, is going to be 16 by 3. So 16 by 3 is going to be what? 5.3333. So here the break even point is going to be fixed cost 1600 divided by weighted contribution per unit 5.3333. Right? So now here, how much is that going to be? 1600 divided by 5.3333. You get an overall 300 units. So if I sell 300 units overall, I will be able to break even. Now, what is the breakup of that? X and Y. So X has to be, so 1:2, right? Overall, X needs to be 300. 1 second. So X, number of units of X to be sold is going to be 300 into 1 by 3. Number of units of Y is going to be 300 into 2 by 3. So this is going to be how much? 100 units of X, and this is going to be how much? 200 units of Y. Or in other words, if I sell 100 units of X and 200 units of Y, I will be able to break even. This is how you need to arrive at it. Are you guys clear with this? So the most important part when it comes to sales mix is that the calculation of break-even point. So break-even point formula is going to be your fixed cost divided by weighted contribution per unit. And remember one more thing. Suppose in the question contribution is not available, PV ratio is available, I can say simply this is nothing but, so break-even point in sales value is going to be fixed cost divided by weighted PV ratio. As simple as that. If you want the figure in value, instead of contribution per unit, use PV ratio. Clear with this, guys? But that has to be a weighted PV ratio because you need to consider all the products for recovery of your fixed cost. As simple as that, guys. Clear with this? This is all about this particular question, and using this question we learned the concept of sales mix. The other part of the question is fairly simple, right? In fact, we have done that also, right? The most important part is with respect to calculation of your break-even point. So now please go and update your library of adjustments. Write down sales mix hyphen calculation of profit and break-even point in different scenarios. Calculation of profit and break-even point in different scenarios, right? That's about this concept of sales mix. Look at this. We can just knock off all these concepts without mugging up anything. That's the beauty of costing, guys. Trust me. Costing, FM, these subjects should never be mugged up. Mugging up is not even a sin. I told you it's a crime. So you should never mug up in these subjects and all. As simple as that. So here the break-even point is what? Fixed cost by weighted contribution per unit, or fixed cost by weighted PV ratio. How will you do that? Simple. The respective contribution per unit into the weights, or the respective PV ratio into weights, and as simple as that, guys. Clear with this, right? And that's about this particular concept of sales mix and marginal costing, right? With this we have completed this particular concept called as sales mix. Now let's move on to another concept called limiting factor. We will do one concept called as limiting factor. Quickly we will revisit this area. So let's get started. So I will take this up here. 1 second. Okay, guys. So limiting factor. Okay. Now guys, let us say I deal with two products, A and B. Let us say the selling price is going to be 10 rupees for product A and 10 rupees for product B. The variable cost is going to be 6 rupees for product A and 4 rupees for product B. The contribution per unit is going to be 4 rupees for product A and 6 rupees for product B. Now, you guys tell me, these two products are there. Which product will I manufacture? Now, you might say, sir, product B, sir, I will manufacture because it gives me a higher contribution per unit. Now, I will say, why only product B? Product A is also giving me some positive contribution. So, I will produce both A and B, no? Who is stopping me? Yes, I can sell as many number of units of B possible. I will also parallelly sell as many number of units of A possible. Guys, clear with this? So why should I limit my production to only one product? I can produce as many products as possible, right? So generally, when there is no constraint, no one is stopping you from producing a product which has a positive contribution. You can produce all the products which will generate a positive contribution. Are you clear with this? Now, let me add one more data here. Let us say both these products are produced by using a common raw material called X. Now this X needs to be imported from, let us say, China, right? Now there is some import restriction, and the Indian government has clearly mentioned that you cannot import beyond 10,000 kgs of raw material X, or in other words, raw material X is a scarce product. It is called as limiting factor. Are you clear with this? Any factor that limits your production or output is called as a limiting factor. In this scenario, your raw material is a limiting factor. So now you guys tell me, what is the total kgs of raw material available? 10,000 kgs. Clear with this, guys, right? And let us say to produce 1 unit of product A, I require 1 kg of raw material. To produce 1 unit of product B, let us say I need 2 kgs of raw material. And overall in the Indian market for product A, let us say I have a total demand of 2000 units, and for product B I have a demand of, let us say, 8000 units. This is the scenario. Now guys, first you tell me, in the market I have a total demand of 2000 units of product A and 8000 units of product B. Will I be able to fulfill the entire market demand? Is that possible right now? So to fulfill the entire market demand, sir, to produce 2000 units, 2000 into 1, I need 2000 kgs of raw material plus 8000 units of B, sir. 8000 into 2, 16,000 kgs of raw material. Overall, 2 plus 16, I need a total of 18,000 kgs of raw material. If I have 18,000 kgs of raw material, I can satisfy the entire market demand for product A as well as product B. But now you tell me, how many kgs of raw material do I have? Only 10,000 kgs of raw material, which means raw material is a scarce component. I call that as a limiting factor. This is a factor that limits my production. In this case, what should I do? I should judiciously and very, very carefully, I should use my raw material. Now, how am I going to use it? Which means I need to use this raw material properly and very judiciously towards production, right? Now, you guys tell me, I need to prioritize, sir, which product should I produce first, A or B? Once I fulfill all the first priority product, then if any kgs of raw material is left, I will go to the second priority product. Now you guys tell me, which product should I manufacture first, raw material A or raw material B? We should do a ranking. Now, many of you might think, sir, first ranking will go to product B because it has a high contribution per unit. First produce this particular product B, then if you are left with any raw material, then you can produce product A. So which means product B should get the first rank, product B should get the second rank, priority. The answer is wrong. Why? Now you need to compute something called as contribution per limiting factor. What is the limiting factor here? Raw material. So contribution per kg of raw material. Here, product A, you generate 4 rupees by consuming 1 kg, which means 4 by 1. My contribution per kg of raw material is 4 rupees. Whereas product B, no doubt, you generate a contribution of 6 rupees, but this 6 rupees can be generated by consuming 2 kgs of raw material. 6 divided by 2, you get how much? Rupees 3 per kg. Now you guys logically think. Now every time I lift a particular kg of raw material from my stores and issue it for production, if I use it for producing product A, this kg of raw material, if it gets converted into product A, every kg of raw material used for product A can generate 4 rupees. Whereas every kg of raw material used for producing B can only generate 3 rupees. Why, sir? No doubt product B has an advantage of higher contribution per unit, but product A has an advantage of lower consumption per kg, which may lower consumption per unit. So which means in this case, so you need to consider both the contribution as well as the consumption. Hence, what we do is we do the ranking by considering contribution per limiting factor. In this case, contribution per kg of raw material. Literally, this 6 rupees can be achieved by consuming 2 kgs of raw material, or in other words, per kg of raw material used for producing product B, I can generate only 3 rupees, whereas if the same raw material is used for producing product A, I can generate 4 rupees. So now what we do here is, now I do the ranking. So as per the ranking, the first priority will go to product A. So use all the kgs of raw material and try to fulfill the entire market demand of product A. 2000 units of product A you produce. If you are left with the balance kgs of raw material, then you go ahead and use it for producing product B. That is going to be the second ranking product. So the first step in questions which have limiting factor is, doing the ranking. Ranking should be based on what? Contribution per limiting factor. In this question, I told you the limiting factor is raw material. Now, maybe in some question, they could have given you the limiting factor could be labor hours, right? The total labor hours available is 10,000 hours. In that case, what you need to do? Example. So, the labor hours per unit will be given in the question. Arrive at the contribution per labor hour, do the ranking, and then you need to do the allocation. So, basically, guys, the first step that we need to do here is about what? So, the step number 1 is ranking. Now, step number 2 we need to do, which is allocation. Sir, how will I allocate? So, allocation of raw material to the products. Sir, using this 10,000 kgs, what is the best possible combination of product A and B that I can produce so that I will get the maximum possible profit? Now, for this, actually, I have a template here. Rank product kgs per unit, kgs, and cumulative kgs. Sir, what is this? A very, very proper and a structured way of cracking questions here. First, what is the first rank product? Product A, right? 1 second, I think I missed out one thing. Okay, so here I will write it down. Units, kgs per unit, kgs, and cumulative kgs. I will tell you what this is. Product A. Now, what is the maximum possible demand of a product A? 2000 units, right? So, 2000 units. Now, to produce 1 unit of product A, how many kgs of raw material do I need? It's given in the question, 1 kg. Which means to satisfy this entire 2000 kgs, 2000 units, how many kgs do I need? 2000 into 1, 2000 units. So, till now, cumulative kgs I've consumed is how much? 2000 units. Next, what is the second rank product? B. Now, come from the reverse. After I produce A plus B, totally how many kgs of raw material would have been consumed? The total 10,000 kgs, right? The total 10,000 kgs, right? So this is not units, this is kgs. Now, out of this 10,000, already I would have consumed 2000 kgs for producing first product A, which means how many kgs are available for producing product B? Balance 8,000 kgs only. Now, to produce every unit of product B, how many kgs do I need? 2 kgs of raw material, which means using this 8,000 kgs of total raw material, how many units of B can I produce at max? 8,000 divided by 2. Max, I can produce only 4,000 units of product B. Are you guys clear with this? Or in other words, the most optimum allocation of this raw material is you produce 2000 units of A and then produce 4000 units of B. This combination will only give you the maximum possible profit. Now, if you deviate from this mix, definitely your profit will definitely reduce as compared to this particular allocation. Are you guys clear with this? So there are 2 steps involved in your limiting factor questions. Number 1, ranking your the products based on contribution per limiting factor, and step number 2 is allocation of your limiting factor to the products. Are you guys clear with this? In this scenario, right, what we did, I narrated one particular question, and based on this particular facts, we have seen that the best optimum possible production is going to be to produce 2000 units of A and 4000 units of B. So we are fulfilling entire product A's demand product B, out of 8,000, we can only produce 4,000. This is because of the constraint of raw material. Are you guys clear with this? And that is all about the concept of limiting factor. With this, any kind of sum you will be able to do. And in fact, in our courses, in our regular and EVO batches and all the sums we do here. But since this being a marathon revision, right, here also I have taken one numerical example to explain the concept of limiting factor. The same logic you can apply for in case of instead of raw material. Suppose in the question it is being mentioned that labor hours or machine hours is a limiting factor. In that case, automatically instead of raw material you can use your labor hours or machine hours, as the case may be. Calculate the contribution per labor hour or contribution per machine hour, do the ranking and do the allocation. As simple as that. Clear with this, guys? So with this, we have also completed the next concept called as limiting factor. So let's go and tick off the scoreboard, right? So that's about this concept of limiting factor analysis. So now let's move on to the next concept called as shutdown point. Now what is this concept of shutdown point? Now I've clearly explained this in our concept decoder notes as well. The limiting factor is mentioned, shutdown point, right? So I have neatly condensed all the formulas and everything has been mentioned here. So all these things, whatever I've written down here, it was actually done during our, the batch, that is your regular and EVO batches and all. So we use the same book, in fact, for all our, regular batches as well, and even in our exam-oriented batch. But anyways, this concept of shutdown point, right, it is applicable under situation of off-season or recession. A company may need to evaluate whether it should shut down. Remember, it's a temporary closure, or continue with the operations. Now, guys, what are they talking about in this particular scenario? Now, this concept is called as shut down point. Now, guys, now understand, in some extreme cases, the market might be very, very dull. For example, COVID time. Now, what happens? Though my product is very, very good, it has all quality, it provides value addition to my customers, but still, during certain time of recession, a perfect example is COVID, people might not be having the money to buy the product, though my product is very good in all other aspects. Now, in this case, COVID time, let us say for the next 3 months, I am expecting that, there is going to be a complete lockdown. My business is going to be dull. Now, after 3 months, once again, my business will pick up. Till now, my business is very good. Temporarily, for this next 3 months, right? Now, the market is going to be dull. I need to take a decision whether I should continue my operations for this next 3 months or I should keep my factory shut down. Clear with this, guys? This is called as shut down or continue decision. In this chapter, we're going to take decisions. That's all, right? Shut down or continue decision. Sir, after 3 months, I will continue. That goes without saying. This is a temporary or a short-term decision we are taking. In our subject, we only take short-term decisions. We don't take long-term decisions. Long-term decisions are taken in financial management. Only short-term decisions are taken in cost and management accounting. Now, guys, now, how do we do this? Simple, based on cost-benefit analysis, right? What is this? Sir, if I shut down, what is going to be my benefit? What is going to be my cost? We need to compute. If my benefits are going to be more than the cost of shutting down, then I will definitely shut down. If it is the other way around, that is costs are greater than benefit, then I will continue. Are you guys clear with this? Now, let me take an example. Now, let us say I run a coaching institute. Example I'm giving you, right? In a face-to-face model, I have hired one classroom, and on an average, let us say 200 students generally come and attend my class. Now, during COVID, what happens? I got an inquiry only from 8 students. Everyone preferred online, right? I'm talking about a face-to-face batch. Now, only 8 students said, sir, we are living nearby in the same street. We can come, sir. Don't worry. Now, instead of 200 students, now I have a demand of only 8 students. In this scenario, now I'm going to take a call whether this particular batch or for this particular next 3 months, should I shut down or should I continue? Now, if I shut down the batch, what are all the benefits? I will write it down here. If I shut down the batch, because of shutting down, what are all the extra costs? I will write it down here. Now, guys, let us say I'm running an academy with multiple faculties, right? Now, let us say I have fixed costs, right? There are two types of fixed costs. One is called as avoidable fixed cost. The other one is called as unavoidable fixed cost. Now, what are these two, sir? Example. Now, the same example of coaching institute. Now, let us say I'm going to cancel the upcoming batch, face-to-face batch. Because of this, can I go ask my landlord, sir, next batch is not going to happen, so I will not pay your rent for the next 3 months? Can I tell him that? Absolutely not. So clearly, rent is an example of unavoidable fixed cost. Whether you shut down or you continue, definitely this rent has to be incurred. Whereas, let us say I have faculties for multiple subjects and I'm going to pay them for every batch. If you take one batch, I will be paying you a fixed amount of so much. It is not dependent on the number of students. Example, I'm telling you. Suppose if I cancel the next batch, I need not pay my faculties, obviously, because the batch is not conducted. Clear with this, guys? Now, the faculty fee payment is an example of avoidable fixed cost. It is fixed cost only. Both rent as well as faculty payment are examples of fixed cost, but your faculty payment is avoidable in nature, rent is unavoidable in nature. Are you guys clear with this? If I shut down, I will be able to save my avoidable fixed cost. Are you guys clear with this? So the benefit of shutting down, there is only one benefit. What is this? Savings in avoidable fixed cost. Are you guys clear with this? Savings in avoidable fixed cost, right? Now, what are the costs if you shut down exclusively? What are the costs you are going to incur? Now, don't say unavoidable fixed cost. Unavoidable fixed cost, example, rent will be incurred whether you shut down or you continue. On the cost side, what you should mention, if you shut down, only because of shutting down, if you are incur specifically some cost, that alone should be captured here, because we're doing a cost benefit analysis. If I shut down, what is the benefit? If I shut down, what is going to be the cost we are going to compute, right? Now, let us say during COVID, right? Now, lockdown was there. Now, we couldn't move around. So, lockdown was there, let us say for 1 month. After this 1 month, now, what happened? If you are going to start your two-wheeler, right? Because you cannot move around, your two-wheeler would have been just like that. You would have kept it down, right, in your garage or in your parking area. After 2 months, if you start this two-wheeler, it will not start. So the first place you will go is the mechanic shed. Or in other words, basically, guys, this is the thing that happens for all machines. If you don't use a particular machine, then it requires some extra maintenance. Clear with this, guys? Similarly, if I am planning to shut down my factory for the next 3 months, I need to incur some extra cost which I will not be incurring if the business is running. Clear with this, guys? I need to do some trial run, extra overhaul, maintenance, lubrication, other things I need to do just to make sure that the machine will run after 3 months of shutting down. Clear with this, guys? So, or in other words, this is called as shut down cost. What do you mean by shutdown costs? The costs which are exclusively incurred if I am shutting down my business. Are you guys clear with this? So if I shut down, there is an exclusive cost which I incur. It is called as shutdown cost. So this is one cost which I incur only if I shut down. Clear with this, guys? Next, there is one more cost, opportunity cost. This is nothing but the contribution lost on shutdown period demand. What is this? Now, I told you, instead of 200 students during the shutdown period, or in other words, during this 3 months upcoming batch, I got inquiries from 8 students. Now, because I am shutting down, now what happens? I cannot generate the contribution on this 8 students also. Are you guys clear with this? So, if I shut down, what happens? I am losing out on the contribution that I could have otherwise generated on the shutdown period demand. Whatever less demand it is, on that I could have generated some contribution, that also I will be losing. Clear with this, guys? Right? So now there is one benefit and there are two costs here. If the benefits exceed the cost, then you can go ahead and shut down. If your costs exceed the benefit of shutting down, then do not shut down, go and continue. Clear with this, guys? But there will be one point where the benefits is equal to the cost, that is called as shutdown point, and at that point, whether you shut down or you continue, basically you will get the same result because your benefits is equal to cost. Now let me give you a numerical example. With the help of this, you will be able to understand. Now let us say, guys, right, this is example number 1. So I'm classifying this benefits and cost. Let us say avoidable fixed cost is equal to 1 lakh rupees. Sir, if you shut down, you will be able to save fixed cost of 1 lakh rupees. But what happens? Sir, exclusively for shutting down, you need to incur some extra maintenance. How much is that? 40,000 rupees. And contribution lost, how much is it? Let us say, sir, for the upcoming 3 months, I predict I'm going to get a demand of 8,000 units. Sir, generally, sir, for this 3 months, generally 1 quarter, I get a demand of 70,000, 80,000 units generally. Whereas now I'm getting only 8,000 units. But if you shut down, that 8,000 units also cannot generate a contribution. Ideally, if I sell 1 unit, I could have generated 4 rupees of contribution. But since I'm shutting down, 8,000 into 4, I'm losing how much? 32,000 rupees. Guys, are you clear with this? So now total cost is how much? 72,000. Or in other words, if you see, if you shut down, how much amount you will save? 1 lakh rupees benefits, right? But because of shutting down, extra how much you lose? 72,000. Net off, you have a net benefit. If you shut down, you save 1 lakh rupees, but extra you incur is 72. Net off, there is only 28,000 rupees of net benefit. So now what will you say? Sir, the decision is please go ahead and shut down, right? Because the benefit of shutting down exceeds the cost of shutting down. Are you guys clear with this? Now let me give you a second situation. Sir, if I shut down, benefits, avoidable fixed costs, I can save 1 lakh rupees. This will not change. Cost, shutdown cost is going to be equal to 40,000 rupees. This also will not change. Contribution lost. Suppose, let us say, during the next 3 months, I am predicting a demand of 20,000 units. I am predicting a demand of how much? 20,000 units. Each unit, I will be losing contribution of how much? 4 rupees. So literally, the contribution loss is going to be how much? 20,000 into 4, 80,000 rupees. Clear with this, guys? This case, what is the total amount I'm losing if I shut down? 1,20,000 rupees. But what is the benefit I'm getting because of shutting down? Only 1 lakh rupees. Here, the cost of shutting down exceeds the benefits of shutting down. In this case, what I will do? Sir, please do not shut down. It is better to continue. Are you guys clear with this? Right? Now, guys, why did we change the decision? Why did we change the decision? There is only one factor that played a role. Avoidable fixed cost did not change. Shutdown cost did not change. The entire thing here changed because of the shutdown period demand. Volume is the biggest hero of this chapter. Now, what happened here? If the shutdown period demand was only 8,000 units, right? Then in that case, I didn't lose much. Overall, I was losing 72,000, right? But I was getting 1 lakh. Here, now since the shutdown period demand increased, so the contribution lost, opportunity cost increased significantly. Hence, what has happened? The costs exceeded my benefits, and hence what happened in this case? I felt no, please don't shut down, because if you shut down, what happens? You lose 20,000 units, and every unit you generate a contribution of 4 rupees. You have lost 80,000 rupees of contribution. Because of this, the entire decision changed. Are you clear with this? Or in other words, there is one point where my benefit is equal to cost. That point is called as shutdown point. Or in other words, shutdown point is nothing but how much demand of during the shutdown period do you expect, so that your benefit will be equal to cost. That is, the demand level at which my benefits is equal to the cost is called as shutdown point. How will we do this? Simple, equate the two. So at the shutdown point, benefit should be equal to cost. So here I will say 1 lakh should be equal to 40,000 plus 40,000 is this, plus I need to calculate the shutdown point only. I will keep the number of units as X into every unit will generate 4 rupees, or can I say this is nothing but 40,000 plus 4x. Guys, clear with this? So now can I say, I'll put it on to the other side, 4x is equal to, now this goes to the other side, 1 lakh minus 40,000. So 1 lakh minus 40,000, or in other words, x is equal to 1 lakh minus 40,000 divided by 4. Are you guys clear with this? Or in other words, x is equal to 1 lakh minus 40,000 is 60,000 rupees divided by 4. How much is this? 60,000 by 4. It's going to be 15,000 units. Are you guys able to understand? So my shutdown point is equal to 15,000 units. Sir, with this shutdown point, what can we conclude, sir? What can we conclude? Sir, shutdown point is going to be equal to 15,000 units. What can we conclude, sir? Simple. Sir, shutdown point is 15,000 units. Suppose your expected demand, sir, during this next quarter, I am expecting the expected volume is less than your shutdown point. In that case, market is not vibrant. You can just go ahead and shut down. It is better to shut down, right? Suppose your expected demand for this upcoming quarter or the next 3 months or 2 months, as the case may be, is greater than the shutdown point. In that case, what will you do? Definitely you should continue, because the cost of shutting down will exceed the benefits of shutting down. Clear with this, guys? So if your expected demand, right, shutdown period demand is less than the shutdown point, it is better to shut down. If your expected shutdown period demand is less than the shutdown point, better to shut down because market is not vibrant. Now if your expected shutdown period demand is more than the shutdown point, it is better to continue. And at the shutdown point, whether you shut down or you continue, you will get the same result. Are you guys clear with this? Or in other words, guys, nothing. Shutdown point is nothing but, now in the numerator you had 1 lakh minus 40,000. What is 1 lakh? Avoidable fixed cost. Correct? 1 lakh was avoidable fixed cost. What is this 40,000? This is nothing but shutdown cost divided by 4. What is this 4 rupees? This is nothing but contribution per unit. Are you guys clear with this? Or in other words, my shutdown point is nothing but avoidable fixed cost minus shutdown cost divided by contribution per unit, right? This is all the formula, guys. Or in other words, this is very similar to your indifference points analysis. Difference in fixed cost divided by difference in contribution per unit. But here, look at this. This is nothing but difference in fixed cost divided by difference in contribution per unit. But if I shut down, I don't have a contribution per unit. So there is only one contribution per unit. Directly you can say difference in the two fixed costs. What are the two fixed costs here? Avoidable fixed cost minus shutdown cost divided by your contribution per unit itself. Or in other words, your shutdown point is an extension of indifference point analysis, and directly you can arrive at the shutdown point by using this formula: avoidable fixed cost minus shutdown cost divided by contribution per unit. With this shutdown point, what can you take a decision? If during the upcoming 3 months or 2 months, as the case may be, it will be given in the question, for the shutdown period, if the expected demand is less than the shutdown point, market is not vibrant, go ahead and shut down. If the expected demand during the shutdown period is more than the shutdown point, it is better to continue. If your expected demand is exactly equal to the shutdown point, whether you shut down or you continue, you will get the same result. Are you guys clear with this? This analysis is called as shutdown or continue decision using the concept of shutdown point. As simple as that, guys. Beyond this, there is nothing here in this question, in this particular concept. Now if you go and read all these things, you will be able to understand. It is applicable under situation of off-season or recession. The company may need to evaluate whether it should shut down temporarily or to continue the operations. Now all these things has been given, and finally the shutdown point can be calculated using this formula: avoidable fixed cost minus shutdown cost divided by contribution per unit. Now shutdown point is also nothing but volume only, demand only. If you want to express this in units, in the denominator use contribution per unit, or if you want to express this in value, use PV ratio. As simple as that. Clear with this, guys? If the expected demand is less than the shutdown point, it is better to shut down. If it is equal to shutdown point, whether you can shut down or continue, it will give you the same result. If the expected demand is greater than the shutdown point, it's better to continue. And in the doubt buster segment, clearly I have mentioned here what is this. The shutdown point concept is based on indifference point concept, and the formula is derived from indifference point formula, change in fixed cost divided by change in contribution per unit. As simple as that, guys. Beyond this, there is nothing great at all. So now let's quickly go and solve one numerical problem. So please take question number 18. One second. It's okay. We will take question number 18 from our CMA Inter book, right? Paper 8, cost accounting. Please take question number 18. So I have handpicked all these questions. So just so that we cover. Now for CA Inter students, please don't think that, sir, this is not applicable for me and all. Absolutely not. Absolutely not. In fact, in the CA Inter material also, few CMA questions I've kept for a simple reason. Right, separate books only, but still I've kept because in past I've noticed one trend. If a good question comes in CMA intermediate, now our CA institute is keeping it here, right? And at times CA Inter questions are being tested in CMA intermediate, so these kind of shuffling keeps happening. So please do not worry. If I'm doing something, it's absolutely applicable for your syllabus. Clear with this, guys? So now let's go and do this question number 18. Please remember, this question number 18, we are doing it from CMA Intermediate, paper 8, cost accounting. That book, you can please download it. So it's on page number 275, right? So this book, so cost accounting, paper 8, cost accounting, question bank. From here we are going to do this question, right? So quickly let's get started. 1 second, I'm taking out the question for you. Okay, so yes, question number 18. It's on page number 275. Mr. Young has 1,50,000 rupees of investment in business. He wants a 15% profit in his money. From an analysis of recent cost figures, he finds that his variable cost of operating is 60% of the sales. Means what? Variable cost ratio is 60%, which means PV ratio is going to be 40%. And fixed cost is going to be how much? 75,000. Show the supporting computations for each of the solution. Okay, what sales volume is required to break even? What sales volume is required to obtain his 15% return on investment? Right, these two are general questions. Right, this is on break-even point. This is on calculating the required sales to earn a profit. Now the most important part, shutdown point, comes here in point number C. Mr. Young estimates that even if he closed the doors of his business, he would incur 25,000 rupees as expenses per year. At what sales would he be better off by locking his sales up? Now they are using some technical language and all, nothing great. No, the best part is nowhere in the question they have used the word shutdown point or anything, right? But ideally this question comes from your shutdown point analysis only. Now what they are saying, first of all, understand. Now in this particular question, there is no contribution per unit, so you should use your PV ratio. How much is the PV ratio? The variable cost ratio is 60%, which means my PV ratio is going to be 40%. As simple as that. Perfect. That's all it is. Next. Now, what is the formula for calculating your shutdown point? Shutdown point is going to be avoidable fixed cost minus shutdown cost divided by PV ratio. Correct, guys? Now, carefully read this question. How much is my total fixed cost? 75,000 rupees. Now they have said, even if I closed the doors of his, even if he closed the doors of his business, which means what? Even if he shuts down, he would incur 25,000 rupees per year. Means what? 25,000 rupees is unavoidable fixed cost. Clear with this, guys? So out of the total fixed cost of 75,000, 25,000 rupees is unavoidable, which means the balance 50,000 could be avoided if he shuts down the business, right? So avoidable fixed cost is going to be 50,000 rupees. Are you guys clear with this? Right? Now, shutdown cost is how much? Don't say shutdown cost is 25,000. Shutdown cost means what? A cost which I will incur only if I shut down. In this case, I am not shutting down my business at all. I mean, in this case, I am not going to incur any specific fixed cost or any specific cost if I shut down. They have not given anything. So in this case, I will take my shutdown cost as 0, right? So by substituting it here, avoidable fixed cost 50,000, right, minus shutdown cost 0 divided by PV ratio 40%. So how much does it come out to? 50,000 by 0.4, you get 1,25,000 rupees as your shutdown point. Are you guys clear with this? Now here they have used a different formula and all, but ultimately the answer matches. But trust me, this is the correct formula. Please write that only in your exam. Now 1,25,000 rupees is the shutdown point. What is the meaning of this? Sir, if in the expected upcoming next few months or in the year, as the case may be, right, for the temporarily in the next period, if your expected demand is less than 1,25,000, please shut down your business. If it is more than 1,25,000, please continue. If it is exactly equal to 1,25,000, whether you shut down or you continue, the result will be the same. Are you guys clear with this? This is the concept of shutdown point, and many students make a mistake in arriving at the correct avoidable fixed cost and the shutdown cost. They generally take a wrong figure. 25,000, they take it as a avoidable fixed cost directly. No, it is unavoidable fixed cost, which means out of the total fixed cost, 25,000 will be continued to incur even if I shut down, which means it is unavoidable, which means only the balancing figure 50,000 is avoidable fixed cost, and shutdown cost would be specifically given in the question. You can't assume anything. If it is not given in the question, take it as 0. As simple as that. Clear with this, guys? That is all about this particular question. Right here we are focusing on the shutdown point analysis, and as simple as that, guys. Very, very simple. And we have taken one question from CMA Intermediate paper 8, right? But don't think it is not applicable. Please do not think. Even CA inter students can definitely follow this question, right? It is 100% applicable for your examinations, because these kind of questions, right, gets tested across different courses, CA, CMA. In fact, I've also noticed in US courses like CMA and all, certain questions, if it gets tested in one attempt, our CA Institute or CMA Institute are also taking, because globally costing FM, these questions are all, I mean, these subjects are all same, uniform. It is not country dependent. It is globally, it's going to be more or less the same. Hence, these kind of question gets tested in all professional courses that are having these subjects in their syllabus. Clear with this, guys? So with this, we have completed this particular question number 18. Please go and update your library of adjustments. Please write down. Please write down calculation of shutdown point. Please write down calculation of shutdown point. All right, fine, guys. So that's about this particular concept of shutdown point. So with this, we have completed this concept of shutdown point as well. Now let's move on to the next concept. So now let's move on to the next segment of discussion, which is marginal costing versus absorption costing. Now, guys, this segment of discussion alone goes on to achieve the objective of your profit computation, your stock valuation and profit computation. All other aspects of this chapter will go on to achieve the objective of decision making. Only this segment of discussion goes on to achieve the objective A of our subject, which is stock valuation and profit computation. Now, guys, in this segment, right, we are going to see how stock gets valued in marginal costing and absorption costing, and accordingly we will be preparing this income statement under marginal costing and as per absorption costing, and finding out the difference between the profit reported under these two methods. And we will also be seeing the reason why each of these two methods or systems of costing, right, report different profits. Ideally, they are not methods, they are called techniques of costing. Now, right, once again, guys, this is a common segment in your CA Intermediate, your paper 4 cost and management accounting, in your CMA Intermediate paper 8 cost accounting, and paper 12 management accounting. It's a common area. Now, guys, basically cost is broadly classified into two: manufacturing cost and non-manufacturing cost. Basically, manufacturing cost means cost that is incurred inside the factory. And non-manufacturing cost refers to all the costs incurred outside the factory, basically in your corporate office, administration overheads, and your sales depot, selling overheads, right? Now, generally, all non-manufacturing costs are considered as period cost, which means they are not considered for the purpose of stock valuation. They are P&L items. They are not trading account items. They are not considered for the purpose of stock valuation, right? However, CMA Institute, right? CMA students, generally CMA Institute considers administration overheads also as a product cost. However, in this segment of discussion, even in CMA, they have taken it only as period cost. Now, administration overheads and selling overheads are always considered as period cost, both under marginal costing as well as under absorption costing, right? Now, manufacturing cost, that is cost incurred inside a factory, can be classified into direct material, direct labor, direct expenses, and production overheads. Now, this production overheads can be further categorized into two: variable production overheads and fixed production overheads. Now, guys, under absorption costing, right? Now, every unit of stock is valued at full manufacturing cost, or in other words, right? Product cost means all the costs incurred inside the factory. That is direct material, direct labor, direct expense, called as prime cost, plus entire production overheads, which means variable as well as fixed component of production overheads. Whereas marginal costing is dead against it. It says, no, every unit of stock can be valued at direct material, direct labor, direct expense, and variable production overheads. However, fixed production overheads should never be treated as a product cost, and it should never be unitized for valuing every unit of output. Who says this? Marginal costing. Clear with this, guys? Because marginal costing is completely against unitizing your fixed cost. Now, if you are incurring a fixed cost, even though if it is incurred inside the factory, I should treat it only as a period cost. I should never treat it as a product cost. Clear with this, guys? This is what marginal costing says. Or in other words, direct material, direct labor, direct expense, and variable production overheads, these four components are always treated as a product cost, both under marginal costing as well as under absorption costing. The only issue or the difference between marginal and absorption costing lies with respect to treatment of fixed production overheads. Now, in fixed production overheads, absorption costing consider this as a product cost, whereas marginal costing consider this as a period cost. Marginal costing literally says anything which is fixed should never be unitized, should never be considered as a part of product cost. It should always be period cost. Clear with this, guys? Or in other words, under absorption costing, every unit of stock or every unit produced is valued at full manufacturing cost. Whereas, can we say, marginal costing values every unit produced at variable manufacturing cost. Clear with this, guys? Variable manufacturing cost. Don't say variable cost. Why, sir? Now, administration overheads, selling overheads. Here also, some variable component could be there. But marginal costing says anything incurred outside the factory should never be considered as a part of stock valuation. Clear with this, guys? So, AOH and SOH are always period cost, irrespective of whether it is variable component or fixed component. So, marginal costing is very clear. It says stock should be valued at variable cost, that too incurred inside the factory. So, variable manufacturing cost alone is considered for the purpose of stock valuation. Clear with this, guys? Right? Under marginal costing. So, clearly understand, with respect to non-manufacturing cost, AOH, SOH, always treated as period by both the systems of costing. And with respect to prime cost components and variable production overheads, always considered as a product cost under both the systems of costing. The only issue with respect to treatment of fixed production overheads. Now, absorption costing, consider this as a product cost, whereas marginal costing, consider this as a period cost. Simple, guys. Now, there is a famous movie dialogue in Tamil. So, there is a movie dialogue that says, நண்பன்ல எங்கம்மா நல்ல நண்பன் கெட்ட நண்பன் நண்பனாலே நல்லவன் தான். Right? For those who do not understand Tamil, it's okay, fine, just a movie reference. Now, similarly, marginal costing says, fixed la engama product period, fixed nale period da. So, fixed cost means period cost, right? Now, whether it is incurred inside the factory, outside the factory, marginal costing is completely dead against unitizing your fixed cost. It says simple. If it is fixed, even though if it is incurred inside the factory, I will only consider that as a period cost. Clear with this, guys? Or in other words, in marginal costing, every unit of stock is valued at variable manufacturing cost, whereas absorption costing values every unit at full manufacturing cost. The only difference between the two is with respect to treatment of fixed production overheads. All other areas, marginal costing and absorption costing, are agreeing. The only disagreement is with respect to fixed production overheads. And we all know in absorption costing, what we do is that, right? So we arrive at the predetermined rate and all, budgeted fixed overheads divided by your budgeted base quantity. Using absorption technique, we charge it to the product. At the end of the period, you take the absorbed overheads, compare that with actual overheads, arrive at under or over absorption, give the adjustment. Here in marginal costing, there is no question of absorption itself. Only then will the question of under or over absorption come. So all these things are not even there in marginal costing. Only in absorption costing that issue is there. Clear with this, guys? Now, with this background, let us go and do one numerical problem. With the help of this numerical problem, we will clearly understand the difference between your marginal costing and absorption costing. Why will there be a difference in the profit reported? If so, why? And all these things we will clearly understand. This is a masterpiece question, right? It has all the variety combinations, all the different kinds of combinations possible, right? And with this, the entire concept of marginal and absorption costing will be covered here, right? So please go to your CA Intermediate Solved Question Bank, volume number 2, and please go to question number 27. It's on page number 449. This is equally applicable for CMA students. So the kind of questions which I am picking here in the marathon revision is purely which is common for everybody, right? If there is something which is not common, I will clearly indicate. You need not have to worry about that, right, guys? So now on that note, let's get started with question number 27. Now, from the following data, compute the profit under marginal costing and absorption costing and reconcile the difference in profit. Now, the selling price per unit is how much? 8 rupees. The variable cost is 4. Fixed cost is 2. Assume all these are manufacturing costs incurred in the factory. Literally, guys, which means what? The total cost of production, the full cost, full manufacturing cost is how much? 6 rupees. Right? So under absorption costing, every unit of stock will be valued at 6 rupees, whereas under marginal costing, every unit of stock will be valued only at 4 rupees. Perfect. Now, the normal volume of production is 26,000 units per quarter. Every quarter, I plan to produce how many units? 26,000. Normally, this is the production level. The opening and closing stock consists of both finished goods and equivalent units of WIP as follows. Literally, what they have said. Q1, Q2, Q3, Q4. 4 quarters they have given. Quarter wise, how much is the opening stock? How much is the production? How much is the sales? How much is the closing stock? Everything is given. Q1, no opening stock. 26,000 units I produced and I sold entire 26,000 units, which means I'm left with no closing stock. Closing stock of Q1 becomes opening stock of Q2, 0. Plus production is how much? 30,000. So I have 30,000 units, out of which I have sold 24,000 units, which means units unsold. Closing stock is 6,000 units. Now this becomes the opening stock for the next quarter. So 6,000 plus 24,000 they have produced in that quarter. Overall, how many units are available for sale? 30,000. Out of this, they have sold only 28,000, which means the balance 2,000 is the closing stock, becomes the opening stock for the next quarter, right? Add 30,000. Overall, 32,000 units are available for sale. They have sold entire 32,000. Hence, closing stock is 0. Clear with this, guys? Quarter wise, they have clearly given opening stock, production, sales, closing stock. All the data is given. Now, what we need to do, quarter wise, we need to compute the profit. First under marginal costing, then under absorption costing. We will see what is the difference between the two. Clear with this, guys? Now, remember, in marginal costing, every unit of stock will be valued at what? 4 rupees. Clear with this, guys? Please have this very, very clearly. Now, one more thing in this question. Now, how much will be the fixed cost? Now, they have not given anything in specific. So, clearly we know normal production volume is how much? 26,000. So 26,000 per quarter. So 26,000 into 2 comes out to rupees 52,000. So quarter wise, 52,000 rupees is going to be my fixed cost in total. Clear with this, guys, right? I will take this. Now, with this, let us go and prepare the profit statement under marginal costing system quarter wise. Now, first sales figure. How much is the sales figure? Respective number of units multiplied by the selling price 8. So 8 into 26,000 is equal to 2,08,000. So 24,000 is equal to 1,92,000. 28,000 is equal to 2,24,000. 32,000 is equal to 2,56,000. Literally quarter wise sales figure is done. Now from your sales, you should subtract the cost of goods sold, correct? Only then you will arrive at, ideally speaking, only then you will arrive at your correct profitability. So for the units sold, I should subtract, right, whatever is the cost of goods sold. But remember, every unit should only be valued at a variable manufacturing cost. Now first you guys tell me, how will I be valuing my cost of goods sold? Simple. Cost of goods sold is what? Literally this is my FG area. I have my opening stock plus the current year I have some production, right? This is the total units available for sale. Out of that, I have sold some units, right? I have sold some units and the balance is my closing stock. Can I say the cost incurred in respect of units sold is going to be opening stock plus the current year cost of production minus closing stock? Agreeing with me? If I do this, literally I will be able to arrive at the cost of goods sold. But remember, all these units should be valued at 4 rupees variable cost. Clear with this, guys? So opening stock plus variable cost of production minus closing stock, I will arrive at variable cost of goods sold. Are you guys clear with this? So literally for Q1, opening stock is 0, right? Now variable cost, I mean per unit is how much? 4 rupees, right? So variable cost of production is at the rate of 4 rupees. Now what we need to do, everything, opening stock should be valued at 4 rupees, closing stock should be valued at 4 rupees. Now come on, tell me, now every quarter how much is the opening stock? The first quarter 0, second quarter 0, third quarter 6,000 units. So 6,000 units each should be valued at 4. So 6 into 4 is 24. Fourth quarter 2,000 into 4, it's going to be 8,000. Clear with this, guys? Similarly, so number of units of production, variable cost of production. So every unit should be valued at 4 rupees. 4 into 26,000 is equal to, you get 1,04,000. 30,000 is equal to, you get 1,20,000. 24,000 is equal to, you get 96,000. And 30,000 is equal to, you get 1,20,000. Clear with this, guys? Similarly, closing stock, first quarter 0, second quarter 6,000. So 6,000 into 4 is 24,000. 2,000 into 4 is 8,000. And 0 is the closing stock in Q4. That's going to be 0. So literally the variable cost of goods sold is going to be how much, guys? Variable cost of goods sold, right? It's going to be opening stock plus current year cost of, I mean the variable cost of production for that quarter minus closing stock. If you adjust 0 plus 1,04,000 minus 0, it's going to be 1,04,000. Here 0 plus 1,20,000 minus 24, it's going to be 96. So 24,000 plus 96,000, right? You get how much? So 24 plus 96, you get 1,20,000 minus 8,000, you get 1,12,000, right? Similarly, 8,000 plus 1,20,000 minus 0, you get 1,20,000. Literally, quarter wise, now we have arrived at variable cost of goods sold. Clear with this, guys? Are you all able to understand? So now, sales minus variable cost of goods sold, call it as gross contribution. It's not the final contribution. Why? Till now, we have only considered the variable manufacturing cost. Now, there could also be some variable SOH, AOH and all. Right? Only if I subtract all my variable cost from my sales, I will arrive at my net contribution. Till now, we have only adjusted for what? The variable cost incurred inside the factory. Hence, I call this as gross contribution. So, sales minus variable cost of goods sold. 2,08,000 minus 1,04,000 is 1,04,000. 1,92,000 minus 96 is 96,000. 2,24,000 minus 1,12,000 is 1,12,000. And 2,56,000 minus 1,28,000 is 1,28,000. Clear with this, guys? Now, from this, further subtract variable selling and distribution cost, right? Variable cost incurred outside the factory, that is variable AOH, variable SOH. In this question, nothing is there. Hence, I am putting this as nil. From this, you will arrive at the net contribution. It's nothing but the same figure because there is no variable selling and distribution cost. Clear with this, guys? Now, from my contribution, now I should subtract my fixed cost. Fixed cost incurred where? Whether inside the factory or outside the factory. Anywhere you incur, I am not bothered about the location. Fixed means period with respect to marginal costing. So month quarterly, how much the fixed cost? We saw this 26,000 into 2, it was 52,000. So directly go ahead and subtract 52,000 every quarter. So now what you get is the profit, quarter wise profit reported under marginal costing. Are you guys clear with this? As simple as that. Simple, same statement. Sales minus variable cost gives you contribution, minus fixed cost gives you profit. The same thing we are doing, but since this has stocks and all, here alone extra thing we are doing, variable cost of goods sold first we are computing. How do we do that? Opening stock plus variable cost of production minus closing stock, you get variable cost of goods sold, right? Sales minus variable cost of goods sold, you get gross contribution. From that, further subtract variable cost incurred outside the factory, you get the net contribution. From that, you subtract fixed cost, you arrive at the profit. Everything is same, but here the manner of presentation alone differs when you have stocks here. Are you guys clear with this? That's about it, nothing beyond this. Now quarter wise, we have arrived at the figures, that is a profit reported under marginal costing: 52,000, 44,000, 60,000 and 76,000. As simple as that. Clear with this, guys? Next, now we need to compute the profits under absorption costing. Now before we do absorption costing, first you should understand one thing. Under absorption costing, every unit of stock is valued at how much? 6 rupees. Now also remember one more thing. In absorption costing, what we use is we use predetermined rate to absorb the fixed production overheads. Correct? Now for that we need to know the budget fixed cost, the budget fixed overheads. We need to arrive at it. Clear with this, guys? Now divided by the budget units and all we do. Accordingly we arrive at the predetermined rate. So that is how we need to do it. Now in this question, right, nothing is specifically given with respect to how much is the budgeted fixed overheads and all. Nothing is given. So we will assume that the budgeted fixed overheads is 52,000 rupees. How did we get 52,000? 26,000 units per quarter into 2 rupees. You get 52,000 per quarter. Guys, clear with this? And actual overheads incurred was also 52,000 rupees. In the absence of information, generally you can assume, right, your budgeted fixed overheads is equal to actual fixed overheads. Ideally, this is a discussion which is covered in overheads, which we have seen in detail in our regular classes, right? But I just want to set the context right even in this marathon. That's the reason this is a standard assumption you will take. Clear with this, guys? Now with this, first we should compute how much is the under or over absorption. How will you compute under or over absorption? Absorbed overheads should be compared with actual overheads, and based on this you will arrive at under or over absorption. Now the predetermined rate is 2 rupees, right? Absorbed overheads is going to be, right, your predetermined rate into actual production. So quarter wise you should arrive at the absorbed overheads first. So 2 into 26,000, 2 into 30,000, 2 into 24,000, 2 into 30,000 will be the absorbed overheads for the respective quarters. First we should compute under or over absorption. So absorbed overheads is going to be actual output into predetermined rate. So actual output we saw here 26,000, 30,000, 24,000, 30,000, right? Multiply that with 2 rupees of predetermined rate. How much you get here? If you look at it, it's going to be 52,000 for the first quarter. Second quarter, it's going to be how much? 30,000 into 2, it's going to be 60,000 here. Look at this, it's going to be how much? So it's going to be 60,000. For the third quarter, how much is it going to be? So 24,000 into 2, it's going to be 48,000. And for the fourth quarter, how much is that going to be? 30,000 into 2, it's going to be 60,000 rupees. Clear with this, guys? Right? Now what is the actual fixed overheads for every quarter? In the absence of information, we said budget is equal to actual. Every quarter it was 52, 52, 52 and 52. Clear with this, guys? Which means how much is the under or over absorption we need to calculate. Now for Q1, actual is 52, absorbed is also 52, which means there is no under or over absorption. In quarter 2, actual was 52, absorbed was how much? 60,000 rupees, which means absorbed is more than actual. There is an over absorption to the extent of 8,000 rupees. Clear with this, guys? For Q3, Actual was 52,000, absorbed was only 48,000, under absorption to the extent of 4,000 rupees. And for Q4, 52 is the actual, absorbed was 60,000, over absorbed to the extent of 8,000 rupees. Clear with this, guys? So now literally quarter wise we have computed the under or over absorption, because this is an adjustment we need to do at the end. Now guys, coming back to the profit statement under absorption costing system. First, sales figure, you can just do it, the respective selling price multiplied by the respective units sold, you will be getting it, right? From sales, if you subtract the cost of goods sold, right, from the sales, if you subtract cost of goods sold, right, you will arrive at the gross profit. Visualize your trading account, right? From the sales, you should subtract your cost of goods sold, you will arrive at what? Your gross profit. Now guys, under absorption costing, every unit is valued at how much? 6 rupees, right? So what I will do here, so opening stock is valued at 6 rupees, current year units produced is also valued at 6 rupees, and even the closing stock is valued at 6 rupees. So the respective units, right, multiplied with 6 rupees, I will arrive at the respective figures. For example, here opening stock value will be 6 into first quarter is 0, second quarter is 0, third quarter is 6,000. So 6,000 into 6 gives you how much? 36,000 rupees is the value of opening stock for Q3. And for Q4, it's going to be 6 into 2,000, it's going to be 12,000 rupees. Clear with this, right? Now, cost of production, here you look at this. So 26,000, so 6 into 26,000 gives you 1,56,000 for Q1. So it's 1,56,000 for Q1. For Q2, how much is that? 30,000 into 6, so how much is that? 1,80,000. For Q3, how much is that? So 24,000. So 24,000 into 6 is 1,44,000. And for Q4, how much is it? It's going to be 30,000. So 30,000 into 6 gives you how much? 1,80,000. Clear with this, guys, right? And closing stock, similarly, so 6 into 0 is 0. 6 into 6,000 is going to be 36,000. Here look at this, closing stock 36,000, and 6 into 2,000 gives you how much? 12,000 rupees, right? And Q4 it is nil. So opening stock plus current year cost of production minus closing stock, if you do, you will arrive at the cost of goods sold for the respective quarter, right? Sales minus cost of goods sold, you will arrive at the gross profit. Gross profit is only reported in your trading account. From your gross profit, subtract all the non-manufacturing costs, selling and administrative expenses. Here variable or fixed, everything, irrespective of the nature of variable or fixed. We don't classify here as variable, fixed. Any cost incurred outside the factory comes in your P&L account. Clear with this, guys? You subtract, in this case it is nil. But remember, one more very important adjustment you need to do, which is with respect to under or over absorption. Ideally, all these things are a subject matter of discussion in your overheads area. Right? So under or over absorption, Q1, there is no adjustment. Q2, now what I would have done, I should have accounted only for 52,000. I have accounted how much? 60,000 already, which means I need to reduce the cost to the extent of 8,000 rupees. Reduction in cost will result in increase in profit. So add 8,000 rupees. So over absorption is added to the profit or reduced from the cost. Since you're computing profit directly, add it. Are you guys clear with this? All these are very technical discussion in your overheads area, right? And I hope, since this being a marathon, I'm not getting into too many details with respect to this area, because it's covered in overheads actually. Clear with this, guys? Next one, with respect to quarter 3, you should have accounted for 52. You have accounted only for 48, which means 4,000 rupees is under absorbed, which means now you need to account for, you need to introduce cost to the extent of 4,000 rupees. So adding to the cost will reduce your profit. So 4,000 should be subtracted. Next one, 52,000 actual should have been accounted, but we have already accounted 60,000, which means 8,000 rupees of cost should now be reduced. Reduction in cost will result in addition in your profit. So 8,000 rupees should be added. Clear with this, guys? So from the gross profit, if you make the following adjustments, your net profit ideally that you will get is minus 52,000 in Q1, 56,000 in Q2, 52,000 in Q3, and 72,000 in Q4. Clear with this, guys? So these are all the profits reported under absorption costing, right, for each of the 4 quarters. Clear with this, guys? This is what it is. So now first we have prepared, this is not minus 52. So this is ideally, this is not minus 52, this is positive only. 52,000 minus 0 is 52,000. 48,000 plus 8 is 56,000. 56 minus 4 is 52, and 64 plus 8 is 72. Clear with this, guys? Now what happens? Now you tell me, is the profit reported under marginal costing and absorption costing the same? Here we have different figures. 52, 44, 60, 76. Here we have 52, 56, 52, 72 and all. The profit is different. Now why is there a difference between the profit reported under marginal costing and absorption costing? Some of you might be thinking, sir, this is on account of under or over absorption. Absolutely not. Now in marginal costing, right, we subtract the actual overheads, whereas in absorption costing, we consider absorbed overheads, but at the end of the year, we match the absorbed with actuals. For example, here in Q2, I would have accounted for 60, but I compare it with actual and I say, look, by mistake I accounted 60. So now I will reduce my cost to the extent of 8,000 and net off I end up only accounting for actual overheads. Clear with this? So clearly understand, under or over absorption is not the reason for the difference between your marginal costing and the absorption costing profit. Sir, then what is the reason for difference? There is only one reason for difference, which is nothing but your difference in stock valuation. Now guys, in marginal costing, fixed production overheads is not considered for the purpose of stock valuation, whereas in absorption costing, the fixed production overheads is also unitized and it is considered for the purpose of stock valuation. Agreeing with me on this, right? Now what happens? Always every unit of stock is valued more under absorption costing and it is valued less under marginal costing. Do you agree with me on this? Yes, absolutely, because every unit of stock is valued at 6 rupees under absorption costing, whereas every unit of stock is valued only at 4 rupees under marginal costing. Or in other words, absorption costing always values every unit of stock at 2 rupees more as compared to marginal costing, right? Now what happens in Q1? Now what happens? Opening stock is how much? 0. Closing stock is how much? 0. Now understand one thing, guys. Opening stock is on the debit side, closing stock is on the credit side. Now in this case, there is no opening and closing stock at all, right? Hence what happens? Net stock is not there. Because of this, there is no more stock valuation or under stock valuation. Hence in the first scenario, the profit reported under marginal costing 52,000 is exactly equal to the profit reported under absorption costing 52,000. Sir, can you elaborate more? Don't worry, the second quarter we will take. The second quarter, what happens? Opening stock is 0. Closing stock is how much? 6,000. Closing stock is on the credit side, right? Now credit side, 6,000 units are there. Every unit is valued at 2 rupees more, where under absorption costing. So 6,000 into 2, how much is it? 12,000 rupees. So 12,000 rupees is more on the credit side, only under absorption costing. Hence clearly absorption costing will be reporting a more profit to the extent of 12,000 as compared to marginal costing. If you want, you can go and check it. Marginal costing profit is how much? 44,000. How about absorption costing? 56,000. 56,000 minus 44,000. How much is this? 12,000 rupees. Why, sir? Because there is a net closing stock and the closing stock is on the credit side and always stock is valued more under absorption costing. So 6,000 into 2, 12,000 rupees is the difference. This is what I would have mentioned here, right? There is a net closing stock of how much? 6,000. So 6,000 into 2, 12,000 rupees is the difference in profit. Clear with this, guys? Let's go to the third scenario. Now under third scenario, what happens? Opening stock is 6,000, closing stock is 2,000. You have both opening and closing. Now you guys tell me, opening stock is how much? 6,000 units. Closing stock is how much? 2,000 units. If you net off the two, there is a net opening stock, correct? The opening stock is more than the closing stock. Net opening stock is how much? 4,000 units. This is on the debit side. And always remember, stock is valued more only under absorption costing. So 4,000 into 2, how much is it? 8,000 rupees is more on the debit side, where under absorption costing, right? Now when the debit side is more, obviously the profit will reduce. Hence in this case, your absorption costing will be reporting a lesser profit than your marginal costing, exactly to the extent of 8,000 rupees. If you want, you can check. Marginal costing is 60,000. whereas absorption costing is only 52,000. The difference between the two is 8,000 rupees. That is nothing but your fixed production overheads sitting inside your net stock. 6,000 minus 2,000, net opening stock is there. Always stock is valued more under absorption costing. If the stock is on the debit side, the debit will be more, so profit will be less. If the stock is on the credit side, so credit is more, hence profit will be more. Are you guys clear with this? Right? So don't say more stock valuation means always absorption costing will be reporting more profit. No, it depends on where the profit is lying. If there is a net opening stock, right, the debit is more under absorption costing, hence your profit will reduce. If there is a net closing stock, so your credit will be more, again under absorption costing only, but this time since the credit is more, the profit will be higher. Are you guys clear with this? And look at Q4. What happens? Opening stock is how much? 2,000. Closing stock is how much? 0. So there is a net opening stock only. Once again under absorption costing. So always absorption costing value stock more. So 2,000 into 2, how much is it? 4,000 rupees is actually valued more on the debit side. So more debit means a lesser profit. Exactly what happens right now. Absorption costing will be reporting a lesser profit to the extent of 4,000 rupees. If you want, you check. 76,000 is the marginal costing profit. 72,000 is the absorption costing profit. The difference is what? 4,000 rupees, 2,000 into 2, net opening stock into, yeah, right, your fixed cost in sitting inside your net stocks. Clear with this, guys? Or in other words, we can come to a conclusion. When there is no stocks, or when opening stock is equal to closing stock, that is net stock is 0, right? The profit reported under absorption costing is equal to profit reported under marginal costing. Scenario number 1. When opening stock is more than the closing stock, or in other words, there is a net opening stock, right? So the debit side is more under absorption costing, hence the profit of absorption costing is less as compared to your profit under marginal costing. Clear with this? Which scenario is this? Scenario quarter 3 and quarter 4. There is a net opening stock. Clear with this, guys? So always in this case, see, marginal costing was reporting more profit, 60, 76. Here it was only 52 and 72. Clear with this, guys? Right? So when my opening is greater than closing stock, right, that is the net opening stock is there, absorption costing will report a lesser profit. When there is a net closing stock, or in other words, closing stock is greater than opening stock, in this case what happens? So obviously now the credit side is more, hence absorption costing will start reporting more profit as compared to marginal costing. This is quarter number 2. What happened here? So quarter number 2, I had a net closing stock, so here 6,000 into 12,000 rupees was more under absorption costing, 44 in marginal, but what happened? 56 in absorption. Are you guys clear with this? So a simple one-line summary here, you can say 4 scenarios when there is no opening stock or closing stock, or when opening stock is equal to closing stock, or when opening stock is greater than closing stock, or when opening stock is less than closing stock, or in other words, closing stock is more than opening stock. Clear with this, guys? When there is no opening or closing stock, right, marginal costing profit will be equal to absorption costing. Let us keep absorption costing as the base. Absorption costing profit will be equal to marginal costing profit. When opening is equal to closing, once again there is no net stocks here, absorption costing profit will be equal to marginal costing profit. Next, when opening stock is greater than closing stock, what happens in this case, guys? What happens in this case? So debit side is more under absorption cost. Always absorption costing will only have a more stock. If the net stock is on the debit side, profit will be less. If the net stock is on the credit side, profit will be more under absorption costing. Clear with this, guys? Here net stock is more on the debit side, hence absorption costing will be reporting a lesser profit than marginal costing, or you can say marginal costing reports more profit than absorption costing, right? When the opening stock is less than closing stock, or in other words, there is a net closing stock is more, in that case what happens? Absorption costing will report more profit than marginal costing. Are you clear with this, guys? And always remember, the difference in the profits reported under these two systems are exclusively on account of what? The fixed production overheads sitting inside your net stock. Are you guys clear with this? And that is the only reconciling item between the profits reported under marginal costing and absorption costing. And this question is a masterpiece question that covers all the situations that we saw here, right? The net, there is no the net opening stock is equal to closing stock, or opening stock is greater than closing stock, or opening stock is less than closing stock. All the scenarios in a single question, it gets covered. That was the reason why I wanted to cover this sum in the marathon itself. Clear with this, guys, right? And that's about the concept of marginal versus absorption costing. So I hope this completely recapitulated the entire concept, right? I think ideally, in a marathon itself, we are literally covering all the entire concepts here, right? Even for first timers, it could be useful, right? So please go and update your library of adjustments. Write down marginal costing versus absorption costing hyphen preparation of income statement under marginal costing and absorption costing for 4 quarters and reconciling the profits So marginal costing versus absorption costing hyphen preparation of income statement under marginal costing and absorption costing for 4 quarters and reconciling the profits. Clear with this, guys, right? So with this we have completed all the concepts in marginal costing area, right? We have completed all the concepts in marginal costing area. The last segment of discussion is exclusively there for students doing paper 8 of CMA intermediate. That will be covered exclusively for them, right? With respect to others, with respect to your CA intermediate, right, this is all about it, as well as even for CMA inter paper 12, this is all about it. That's an accept or reject of special order, which is exclusively for CMA inter paper 8 students, right? Fine. So now let's move on to the next and the last segment of discussion, which is accept or reject a special order, right? Ideally, though it is specifically a concept covered, it's not a specific concept as such, it is a variant of a question. Though it is, I've mentioned that it is exclusively applicable for students doing CMA intermediate paper 8. Now, I feel this is also a question which you can expect at your CA intermediate level, right? So definitely this is something even CA inter students can also expect in their exams, because it is not a separate concept, it is more of an application driven area. So I would rather still suggest students doing the CA intermediate to follow this with one particular numerical question from your CMA intermediate paper 8, right? Cost accounting. From that, I will take up one question. With the help of that, I will be doing this particular area. Once again, guys, let me tell you very, very clearly, this is not something that is, a specific concept as such, but this is one area which even CA inter students can expect in their exam. On that note, let's get started with one numerical problem from your CMA intermediate paper 8, right? Cost accounting solved question bank. So please take question number 12 of your paper 8 solved question bank. It's on page number 269. Now, look at this. The operating statement of a company is as follows. Now, what have they mentioned? Sales 80,000 units at the rate of 15. The sales value is given. Variable cost, material, labor, overheads. The total variable cost is given, right? Which means how much is the variable cost per unit? 7,20,000 divided by 80,000. 7,20,000 divided by 80,000. How much is that? The variable cost per unit is rupees 9. Correct? Overall variable cost per unit is how much? 7,20,000 total variable cost divided by the total units, right? Next one. How much is the fixed cost? It's given in the question as 3,20,000. The total cost is variable plus fixed. The profit is sales minus total cost they have given. Right, guys? So literally as of now, what you can make out is that how much is the sales? The selling price is going to be 15. Variable cost is going to be 9. So currently the contribution per unit is going to be how much? 6 rupees, right? That's what it is. The profit of 1,60,000, how did they arrive? 6 into 80,000. So 80,000 into 6. 4,80,000 is the contribution. From that, subtract 3,20,000 of your fixed cost. You will arrive at 1,60,000. Marginal costing income statement you can prepare. Next. The capacity of the plant is 1 lakh units. Overall, I have a capacity of 1 lakh, out of which currently I'm selling how many units? 80,000 units, which means 20,000 units I have an idle capacity. Sorry, 20,000 units I have an idle capacity. Next one. A customer from USA is desirous of buying 20,000 units at a net price of 10 rupees per unit. Now, a foreign customer, special order, he says, look, I am willing to buy 20,000 units from you, but max, the selling price which I will pay you is only 10 rupees. Advise the producer whether or not the offer should be accepted. We need to decide whether this offer should be accepted or not. And will your advice be different if the customer is a local one? This is actually a theory question. What it is, I will tell you. Now, you guys tell me, advise whether or not the offer should be accepted. Very simple. Logically, you think, I have a capacity to produce 1 lakh units. Currently, I'm producing 80,000 units, which means the extent of 20,000 units, I have an idle capacity. One guy is coming to me, US client, he's customer, he's saying, I'm willing to pay 10 rupees for every unit. Now, you guys tell me, to produce every unit, what is the variable cost you incur? 9 rupees, correct? Now, on this extra 20,000 units, each unit, right, you are going to earn how much? He says, he will pay you 10 rupees, right? And variable cost is how much? 9. So literally for every additional unit that you are selling, this 20,000 units, you'll be able to generate 1 rupee of contribution, right? So 1 into 20,000 units. So literally extra you will be getting 20,000 rupees of contribution that will overall build your profit. Are you guys clear with this, right? That's all it is, no, right? So clearly, can you accept the offer? Yes. Why? Because as long as for this extra units, I am able to recover my variable cost. The selling price is more than the variable cost. So on each of these extra 20,000 units, I'm getting a positive contribution. So whatever I get extra is going to build my profit, guys. Because for this extra 20,000 units, no specific fixed cost is incurred. Already this fixed cost, 3,20,000 units, right, is being recovered by the existing 80,000 units, and I'm already reporting a profit of 1,60,000. Right, the extra 20,000 units I'm going to sell. Each unit selling price is 10, variable cost is 9, contribution is 1. So 1 into 20,000 units is going to give me 20,000 rupees of extra profit. Guys, clear with this, guys, right? So literally speaking, extra profit that you're going to get, the profit will be increased by 20,000 by accepting the order. Hence, it is advised to accept the same. Clear with this, guys? Now, what they have done, simple. They have prepared the entire marginal costing under 80,000 units. Now, for this extra 20,000 units, what will be the sales? So 20,000 into 10, 2 lakh, minus all the variable costs. So 20,000 into 9, if you get, overall variable cost is how much? 1,80,000. So 2 lakh minus 1,80,000 gives you a contribution of how much for this incremental, for this extra 20,000 units? 20,000. No specific fixed cost is incurred for this. So literally your profit will be increased by 20,000. So what they have done, 80,000 units, they have prepared an income statement, marginal costing income statement. For this extra 20,000 units, they have prepared the marginal costing income statement, 80,000 plus 20,000. Overall for 1 lakh units, they have prepared the marginal costing income statement. But in my opinion, directly you can say no, right? So on this extra 20,000 units, I'll be able to generate a contribution, incremental contribution of 20,000 rupees, right? Clearly you can accept the order because your overall profit will increase by another 20,000. So from 1,60,000, add another 20, the new profit becomes 1,80,000. This way also you can answer and you will say, yes, as a profit increases by 20,000 rupees, you can please go ahead and accept the order. Clear with this, guys? Now, will your answer change if the customer is a local one? Yes. Now, this is not from a costing perspective. This is from a non-cost perspective. Now, generally, I sell it locally. 80,000 units I'm selling. Local sales price is how much? 15. For one customer alone, if I sell it at 10 rupees per unit, obviously the remaining people in the market, they will not be, silent. They will come and ask. For one guy alone, you are giving discount. Why can't you give discount to me also, right? It will create tension and rift in the local market. Since this guy is an outsider, right, an export order or an international customer, whatever sales price I fix for him, right, generally is not known to the local market. Suppose in the local market, if I'm making this distinction, right, it will create a problem in my business. So ideally, if you are if this customer is a local customer, no, do not encourage that. It's basically a theoretical one. If the order is from local one, it should not be accepted because it will adversely affect the present market. This is what they are saying. It is from a theoretical perspective. Are you guys clear with this? That's all this question is all about. Clear with this, guys? Now you tell me, is there any specific concept here? No, this is just one variant of testing a particular question in marginal costing. That's why I said even CA intermediate students can just have a look at this kind of question. You can watch out for these kind of questions in your exam, right, guys? So with this, you can just go and update your library of adjustment. Write down accept or reject a special order. Please write down accept or reject a special order. Fine, guys, right? So with this, we have also completed the last part, though I mentioned it is only for CMA intermediate paper 8 students, but still, in my opinion, other TA inter students can also definitely watch out for this area because it is a common sense driven area. Clear with this, guys? So with this, we have literally covered this entire chapter of marginal costing. In fact, though it was marathon, we actually solved about 5 or 6 exact questions we solved, right? In the marathon itself, we solved the 2 comprehensive questions touching about every single concept covered in this particular chapter, right? It's more than a marathon ideally, in my opinion, because every single thing we have derived it based on concepts and other things. But during our regular lectures and all, right, during our regular or the exam oriented batch, we cover a lot of numerical problems, some 30-40 numerical problems depending on, right, the respective courses, CA, CMA and all, whatever is there, we do in detail. Since this being a marathon, here also I didn't condense on the concepts. Every concept was actually revised. Every single concept we did, along with a few numerical problems, which in my opinion were very important for revision. With this, we have comprehensively covered this particular chapter called as marginal costing, right? On that note, let's move on to the next chapter. So now let's get started with the revision of yet another important chapter called as applications of marginal costing in short-term decision making, right? Now guys, in this chapter we have about 12 to 13 learning objectives: opportunity cost, pricing decisions, make or buy decision, accept or reject an offer, limiting factor or key factor analysis. Then you have this replacement decisions, evaluation of alternative choices, subcontract or not decision, expansion or not decision, then shutdown or continue decision, basically a shutdown point, differential costing, indifference point analysis and other areas. Now guys, basically if you see, this particular chapter is nothing more than the previous chapter, marginal costing, plus a little bit of common sense. That's all this chapter is. So if you notice here, what is the name of this chapter? Applications of marginal costing in short-term decision making. Our subject, cost management accounting, right? Both cost accounting and management accounting, both the subjects actually deal exclusively in short-term decision making, because the long-term decisions are taken under financial management. That's why in financial management alone you have this concept of time value of money and all. So literally our subject, management accounting in this case, right, deals only in short-term decision making. By the way, this particular chapter, applications of marginal costing, is applicable exclusively in your paper 12, CMA Inter paper 12 management accounting. This is not there in your paper 8 cost accounting. Now guys, if you notice the learning objectives which I just mentioned, you can see a repeat of certain concepts, right? For example, accept or reject an order, right? Just now we saw in marginal costing. Limiting factor analysis, this also we have covered in marginal costing. Shutdown or continue decision, your shutdown point, this was also covered there. Indifference point analysis, this was also covered there. Literally these are a repeat areas from your marginal costing chapters, right? And in this particular chapter, right? Literally in our regular and exam oriented batch, every single problem we have covered, including the past exam questions and all, are covered in the regular batch. But here in this marathon, I will quickly revise this entire chapter, right? And the core of this particular chapter lies in the first concept called as opportunity cost, right? So the concept of opportunity cost, what it is, I will once again revise it with the help of some 4-5 examples. With the help of this, the foundation of this particular chapter will be done. So in this marathon, right, we will do opportunity cost, pricing decisions, make or buy decisions, and literally guys, these 4 areas, right, 6, 7, 8, 9, these 4 are nothing but, they are not separate concepts as such, they are different numerical problems based on the concept of your marginal costing only. So ideally, replacement decision, right, whether I have to replace a machine or not. Now this is not a concept. Using the principles of marginal costing, you actually arrive at a decision. Evaluation of multiple choices available, subcontract or not decision, expansion or not decision, these are ideally nothing but a library of adjustments pertaining to multiple questions. But I have just put it here as a separate learning objective. They are not separate concepts. So in my opinion, these 4 will come under one bucket. Now in this 4, I will take up one numerical problem and I will do it in this marathon. But remember, in our regular and exam oriented batches, every single sum you can see in our solved question bank is solved, right? Every single sum. In fact, our regular batch, even the past exam question, we don't even leave a single question. Everything I do it in the class, right? We do it along with the students, so that's how it works, right? And we'll also be doing differential costing in this particular chapter. Clear with this, guys? So this is the agenda for discussion in this particular chapter, right, of in this particular marathon of this chapter, right? Trust me guys, it is a very easy chapter, provided you actually have the right guidance and you start off with the most important concept, opportunity cost, and you develop the chapter. Now let's get started guys with the revision of this particular chapter, applications of marginal costing. Now the first concept that we are going to see is the concept of opportunity cost. What do you mean by opportunity cost? Basically, opportunity cost is nothing but the value of the next best alternative foregone, right? The amount of sacrifice of the next best alternative. Sir, can you give us an example? Yes. Example number 1. Let us say you have completed your CMA course. You are a qualified cost accountant, cost and management accountant. You are sitting in the campus interview. Let us say you get placed in 2 companies. You get offer letter from 2 companies, ITC and HUL, Hindustan Unilever, HUL. ITC is Indian Tobacco Company Limited, right? Now ITC, they are offering to pay you 1 lakh rupees per month salary. Hindustan Unilever is offering to pay you 1.5 lakh rupees per month salary. Now you tell me, between these 2 companies, which company will you prefer? Logical. Now assume that now the work is actually, the workload and all other parameters are same in these 2 companies. Just based on the cost consideration, the amount, your financial consideration, your financial factor, between the 2 companies, which one will you prefer? Obviously you will prefer HUL. Why? Sir, they are paying me 1.5 lakh rupees, sir, right? Whereas ITC is paying me only 1 lakh. So 50,000 rupees they are paying me more. Guys, correct? Now, or in other words, without even knowing, you actually applied a concept called cost benefit analysis. Sir, what is this cost benefit analysis? Now, you took HUL and you said, look, if I choose HUL, what is the benefit I get? 1,50,000 rupees per month, right? That is the benefit. But if I choose HUL, I will obviously have to sacrifice ITC offer. You can't work in 2 companies, right? Parallelly, right? So you will have to sacrifice this offer. So how much do you lose because you actually say okay to HUL? So you lose 1 lakh rupees per month, right? So net off, you get 50,000 rupees more. Are you all able to understand? So the net benefit is positive here. Are you guys clear with this? Or in other words, this 1 lakh, right, which is nothing but the sacrifice of the next best alternative, is called as opportunity cost. Now, do you pay this 1 lakh rupees out of your pocket every month? You earn 1.5 lakh from HUL and pay 1 lakh to ITC? No. cost does not necessarily mean an outflow. It is a broader term. It also takes into account the opportunity cost, the sacrifice. Are you guys clear with this? Right? Suppose if you take ITC as the base, right? Sir, what is the benefit of joining ITC? 1 lakh rupees. What is the cost, opportunity cost of joining ITC? If you join ITC, you should say no to HUL. So it is going to be 1.5 lakh per month. So the net benefit is going to be minus 0.5 lakhs, or in other words, negative 50,000 rupees. Or in other words, you say, if I choose ITC, the net benefit is minus 50,000. So I will not go for it. Or in other words, if I choose HUL, the benefit is positive 50,000. Hence, I will go for it. Or in other words, for the purpose of arriving at a particular decision, the concept of opportunity cost is very important, which is nothing but the sacrifice that you make. Are you guys clear with this? Yes. Now, sir, how is this relevant in multiple decision making areas in our chapter? Wait, I will tell you with the help of a few more numerical examples. With the help of this, the base or the fundamental of opportunity cost will be concrete here. Now, example number 2. I've coined all these examples for the purpose of ease of understanding the chapter. Now, forget the concept of opportunity cost. I will involve it at the right time. First, logically, you think, let us say I am a manufacturer of a pen. Every time I produce and sell 1 unit of pen, the selling price I will earn is 10 rupees. The variable cost to manufacture every unit of a pen is 6 rupees, which means the contribution per unit is how much? Sir, every time you sell 1 unit of pen, you earn 4 rupees. Clear with this, guys? Yes. Now, the fixed cost for the company is 10,000 rupees. Now, let us say the maximum capacity, 100%, if I operate at maximum capacity, I have the capacity in my factory to produce 10,000 units of pen. But currently, I am only functioning at 80% of my total capacity, which means my actual volume is going to be only 8,000 units. Why, sir? Because that is the demand in the market. In the market currently, only people are ready to buy 8,000 units from me. So that is going to be my actual demand. Clear with this, guys? Now, what is going to be my current profitability statement? Logically, you think very simple. Sir, I am selling 8,000 units, sir. Right? Every time I sell a unit, I generate a contribution of 4 rupees. 8,000 into 4. How much is that? 32,000 rupees the contribution, minus fixed cost of 10,000 rupees. So 32,000 minus 10,000. Sir, currently I earn a profit of 22,000. Or you can put up the entire marginal costing income statement. Sales 8,000 into 10, 80,000, minus variable cost 8,000 into 6, 48,000, gives you a contribution. That's nothing but 8,000 into 4, 32,000, minus 10,000 fixed cost. You get your profit. This way also you can arrive. Simple. Now, sir, what is this? What is a great thing here? Wait. Now I am adding some information. Suppose I get a new order, customer order. Let us say I'm getting a new order from United States. A US customer is approaching me and he's saying, look, I want you to sell me 2,000 units. He's asking me to sell him 2,000 units, but he says he will give me only a selling price of 9 rupees, not 10. Clear with this, guys? The question is decision making. Should I accept this order or not? Should I accept this order or not? Simple. Sir, currently I'm producing 8,000 units. I have the capacity to produce 10,000 units. Literally, this 2,000 units is idle capacity. I have the capacity to produce, but I am unable to sell. Suddenly, one guy is coming and he's asking me, look, will you supply me 2,000 units? I will give you a selling price of 9 rupees. Should I accept? Very simple. For these 2,000 units, what is the variable cost you incur? 6 rupees. And that guy is ready to pay me how much? 9 rupees. So which means 9 minus 6. On every unit of this export order, I will earn 3 rupees of contribution. Guys, correct? So 3 into 2,000, literally, I will be able to earn an extra contribution of how much? 6,000 rupees. Right? That 6,000 rupees is the extra contribution earned over and above my current profit. That 6,000 rupees extra contribution is nothing but extra profit only. Guys, clear with this? Because for this export order, I need not incur any specific fixed cost. So which means my profit will be 22,000 currently on this 8,000 units sold in the domestic market. Plus on this extra 2,000 units, I'll be earning a contribution of 9 minus 6, 3 rupees. So 2,000 into 3, extra 6,000 rupees I will earn. So overall, my profit is going to be increased by 6,000 rupees. So my the overall profit after accepting the export order is going to be 28,000. So definitely you can go and accept the export order. Are you guys clear with this? Right? Sir, where is the opportunity cost? Wait, it has not come yet. I will tell you. Clear with this, guys. Look at this. This is what we did. Domestic order profit is 22,000. On the export order, literally on these 2,000 units, right? So the sales value is how much? 2,000 into 9, 18,000. What is the variable cost? 2,000 into 6, 12,000. So what is the contribution? 6,000 rupees. Or directly you could have said, sir, 9 rupees the selling price, 6 rupees the variable cost, 3 rupees the contribution on this export order. Correct. So 3 into 2,000 units, you get 6,000 rupees. On this export order, I don't incur any specific fixed cost. So this itself is an incremental profit. So current profit plus extra profit, overall I get a profit of 28,000. Or in other words, sir, if I sell only 8,000 units in domestic market, 22,000 rupees profit. I have an idle capacity, right? 2,000 units I can produce, but there is no existing demand for that. So on this, someone is approaching me and asking me to sell the units, I'll be more than happy to provide them. Are you guys clear with this? In this case, 6,000 rupees, my profit will increase if I accept the export order. So it can be accepted. Now, let us go on to the next example. Now, look at this. Now you will understand the concept. The same data, right? Selling price per unit is 10, variable cost per unit is 6, contribution per unit is 4. Fixed cost is 10,000 rupees. Now, I have a capacity to produce 10,000 units. Currently, the actual capacity is also 10,000 units, which means what? In the domestic market, currently I'm selling how many units? 10,000 units, right? The maximum possible production is how much? That is also 10,000 units. Now, at present, what is going to be my overall profitability? Simple, sir. 10,000 units into 4. Currently your contribution will be how much, sir? 40,000 minus fixed cost of 10,000 rupees. Currently you are earning 30,000 rupees by selling 10,000 units in the domestic market. Clear with this, guys? Now that same US client is coming to me and he is asking, sir, can you supply 2,000 units at rupees 9 selling price? Clear with this, guys? He's asking me, supply 2,000 units at the rate of 9. So now the decision is, should the decision making, what is the decision that you need to take? Should the export order be accepted? Now, you tell me, max, I can produce only 10,000 units. Already I'm producing and selling 10,000 units in the domestic market. Now, in this case, suppose if I have to accept the export order, it means what I need to do, sir, which means in the domestic market, right? 2,000 units you need to take from the domestic market and you need to supply it to this US client. Are you the US customer? Are you clear with this? Or in other words, maximum possible production is 10,000 units. Right now, already I'm selling 10,000 units in the domestic market. In this case, I can't produce anything extra. Clear with this? Now, suppose a US customer is asking me to supply 2,000 units. In this case, what should I do? I should sacrifice 2,000 units in the domestic market, and then this 2,000 units need to be supplied to this guy in the US. Are you guys clear with this? Or in other words, in this case, if at all I accept the order, which means I need to supply 8,000 units in the domestic market and supply 2,000 units in what? Your export order. That is for your US client. Are you guys clear with this? In this case, if I accept, how will the profitability situation look like? Simple. Domestic sales are 8,000 units you're selling, right? So on this, what will be the profit? So 8,000 into 4, contribution 32,000 minus fixed cost 10,000. So profit from the domestic order is going to be 22,000. On the export order, 2,000, right? So here selling price is 9, variable cost is 6, contribution per unit is 3. So 2,000 into 3, 6,000 rupees is going to be what? Your contribution from your export order. On this export order, there is no specific fixed cost. So this itself is going to be the profit from your export order. So the total profit is going to be how much? 22,000. It's going to be how much? 22,000 plus 6,000 rupees. Overall, you get how much? 28,000 rupees. Now, literally, guys, if you look at it, if I sell the entire 10,000 units in the domestic market, what is my total profit? 30,000 rupees. If I sell 8,000 units in the domestic market and 2,000 units for the export order, what is my profit? 28,000 rupees. Or in other words, my profit decreases if I accept the export order in this case. Guys, clear with this? My profit reduces by how much? So 30,000 reduces to 28,000. So which means I lose how much amount of profit? 2000 rupees of profit if I accept this particular export order. Guys, are you all able to understand this? Or in other words, why did I lose? Simple. If I sell in the domestic market, what is the contribution per unit? 10 minus 6, 4 rupees. If the same unit, if I sell in the export order, how much do I get? 9 minus 6, 3 rupees. Now, what you did, so you are operating at full capacity, you didn't have any idle capacity. Still, if you want to satisfy the export order, you should sacrifice your domestic sales and instead you should supply it to this foreign customer. Guys, clear with this? Now, how many units we had to sacrifice? 2000 units. Now, 2000 units we had to sacrifice, right? From a 4 rupee contributing market to a 3 rupee contributing market, which means for every unit sacrificed, we lost 1 rupee of contribution. Guys, clear with this? So 1 into 2000, this 2000 rupees is going to be the contribution that I forego because I accept the export order in this case. Are you all able to understand? So in this case, if you accept the export order at a selling price of 9 rupees, right, the overall contribution foregone is going to be 2000 rupees. Are you all able to understand this? Yes. So in this case, the opportunity cost of accepting the export order at a selling price of 9 rupees is 2000 rupees. So I will definitely not go for the export order. I will continue selling in my domestic sales only in this case. Why? Because I am operating at full capacity. Full capacity, if you're operating at, you have an opportunity cost. Why? If you're already operating at full capacity, if you want to accept an extra order, which means in the current order or the current sales, you have to sacrifice something and go there. So only if that export order is actually giving me a more selling price than the current domestic sales, only then it will be lucrative for me. Else the sacrifice that I make here, the contribution will be much more, so hence I will not go for it. Are you guys able to understand? This is the logic that you need to understand here, right? And finally, guys, one final masterpiece we will actually do here. Now, all the data is same as example number 3. Now look at this. They are not asking us whether you should accept the export order or not. Look at the question. What should be the minimum selling price that I need to quote to accept the export order? Now you have said, if you fix the selling price as 9 rupees, the export order, right, you will not accept the order. Then you tell me, what is the minimum amount of selling price that you need to fix on the export order for you to accept this particular export order? Simple. Sir, for this 2000 units, every time I sell this unit to this particular US customer, what is the variable cost I incur? 6 rupees the variable cost I incur. So 2000 units into 6 rupees on this 2000 units, totally how much the variable cost I incur? 12,000. Definitely he need to pay me that. Next. Now I am already operating at full capacity. Guys, clear with this? Now, if this export order, I need to satisfy this export order, I need to sacrifice the units in the domestic market. Correct. Every time I sell a unit in the domestic market, I will generate how much? 4 rupees of contribution. So if that guy, the export order, is ready to pay me this 4 rupees, then I will accept it, which means over and above my variable cost. Now, how much is the contribution foregone on the domestic sale if I accept the export order? 4 rupees into 2000 units. So 8000 rupees the total contribution foregone. So literally he needs to pay me 20,000 rupees for 2000 units. 20,000 divided by 2000 units. So 10 rupees if he pays, right? Then so basically I can also satisfy, I can also instead of selling the domestic market, I might say okay to this export order. Clear? This is the minimum selling price, right? Now if he is quoting more than this, I will be more than happy, but definitely if he quotes the export order, if it is less than 10 rupees, then it is not advisable for me to go to this particular export order, because I get more money in the domestic market itself. In that case, my opportunity cost of accepting your export order will be much more, so hence I will not go for it, or in other words, the net benefit will be negative, so I will not go for it. So which means the minimum price that I need to quote, right, in order to accept the export order will be 10 rupees per unit. Are you guys clear with this? Suppose, guys, the same example they are asking, right? Example 4. What is the minimum price to be quoted? Suppose I have an idle capacity that is 10,000 units I can produce, but I'm only selling 8,000 units in the domestic market. Now, what will I say? Now, every time I produce and sell one unit to my export order, I'll incur a variable cost of 6 rupees. Yes, so 2000 into 6, 12,000. But is there any opportunity cost of contribution foregone? No, because I have an idle capacity. Guys, correct? Suppose I have an excess capacity, there is no ready market at the domestic sale. I am not sacrificing anything. So the contribution foregone is nil. So it is enough if he pays 12,000 rupees for each of, or overall this 2,000 units, or in other words, it is enough if he pays 6 rupees. That is the minimum price I will quote. Guys, are you clear with this? But in this case, right now, I am operating at full capacity. Hence, I have an opportunity cost, or I have my contribution foregone. In that case, he also needs to pay me whatever amount I am foregoing. Are you guys clear with this? Right? Or in other words, in case of idle capacity, the opportunity cost is 0. Clear with this? Why? I don't lose anything. I don't make a sacrifice in case I have an idle capacity. Clear with this, guys? This was the previous example we saw here, right? The second example, there was an idle capacity. I don't lose anything. So extra whatever I get is my incremental profit. Whereas in the third example, if I had to accept, since I was operating at full capacity, no idle capacity, if I have to accept my export order, I need to necessarily make a sacrifice in my domestic order. Hence, there came the concept of opportunity cost. So this is the conclusion which I'm giving you. In case of idle capacity, the opportunity cost is equal to 0. Are you all able to understand? This is one of the most important basis that you need to have for solving so many number of numerical problems in this particular chapter. So that's the most important thing. And one more thing, they can even frame this as an MCQ in your exam. So you have MCQs, right? So they can even frame this as an MCQ. You can just go with confidence if you know this particular concept. Clear with this, guys? With this, we have completed the concept of opportunity cost, and that's about it. Now, let's go on to the next subject matter of discussion, which is pricing decisions. Now, what do you mean by pricing decisions? You need to fix your selling price. That is called the pricing decision. Look at this. So in your study material, look, there is no separate concept as such for pricing decision. Directly there are numerical problems. Still, in our concept decoder book, I have just summarized the concept of this particular every single thing: pricing decision, make or buy decision, what it means, right? Opportunity cost concept. Look at this, where the choice of one course of action requires that an alternative course of action be given up. The financial benefits that are foregone or sacrificed are known as opportunity cost. Just now we said, right? Just now we saw, right? If I choose the export order, right? So what is the what is going to be the course of action that requires an alternative course of action be given up? The financial benefits that are foregone or satisfied, the contribution foregone on domestic sales, is called as an opportunity cost. Just now we saw even that ITC HUL example. So opportunity cost thus represent the lost contribution to profits arising from the best alternative foregone, and they arise only when the resources are scarce and have alternative uses. Opportunity cost must therefore be included in the analysis when presenting relevant information for decision making. This is all they have given in your institute study material also, which I've kept in your concept decoder. But the impact of the concept of opportunity cost is completely there in this entire chapter. This is like an oxygen for this chapter. It cannot be seen as such, but its presence is felt throughout the chapter. That's the reason why I took 4 examples to explain the concept of opportunity cost. So there are so many different what do I call the learning objectives which I mentioned there. So I have mentioned a short summary of all of that in your concept decoder, but this chapter is more to do with practical solving. Now, in pricing decisions, what you need to do, they will give you a particular case scenario, or they will give you a particular situation. In this particular situation, you need to fix and arrive at the correct selling price. That's what you need to do. The price to be charged for the product, right? That is what we need to do. So all these theoretically are mentioned, but look, directly we just go and do one numerical problem. So please take the first question number 1. So if you notice, whatever marking we have done here, I have done here. This is all the discussion which we did during the course of our lectures, right? The full-fledged lectures. During the course of our lectures, all these, every single sum we did. So here, for the purpose of marathon alone, I'm handpicking a few sums just in order to revise, so that the most important concepts are getting revised even with the help of a numerical problem in the marathon itself. Right? So now let's go and do the first question here, guys. Question number 1. A company is manufacturing a product, right? A company is manufacturing a product which marks an average net profit of 2.5 rupees per use per piece, per unit, on a selling price of 14.3 rupees. What they are saying, sir, the selling price of every unit is going to be 14.3 rupees, and it marks a profit per unit of 2.5. Right? By producing and selling 6,000 units, which is equivalent to 60% of the capacity. Currently, they are selling 6,000 units, and currently the selling price is 14.3 rupees per unit. Currently, they are making a profit of 2.5 rupees per unit. This is what is given. Perfect. Next, the cost of sales are as under: direct material 3.5 rupees, direct wages 1.25 rupees, works overheads 50% fixed. Means what? Out of the 6.25 into 0.5, 50% is going to be how much? Fixed. The balance is variable. So fixed variable. So fixed is 3.125. Variable is 3.125. Clear with this? Now what do we do? Fixed cost makes sense only if it is represented in total. 3.125 into 6,000. This is going to be the total fixed cost, whereas a variable cost makes sense only if it is presented on a per unit level. It is 3.125 per unit. Clear with this, guys? Next, sales overhead 25% variable, which means what? Once again, fixed variable. Variable is 25%. So 0.8 into 0.25. How much is that? 0.20. Which means the balance 0.8 into 0.75. So 75% is fixed component. So fixed component will be what? 0.6 into 6,000 pieces. Overall, you will arrive at the fixed cost in bulk. Clear with this, guys? Perfect. Next, during the current year, he intends to produce the same number of units. All this data are for the previous year. Now, in the current year, he plans to sell the same number of units. Means what? He wants to sell 6,000 units, but anticipates that the fixed cost will go up by 10%. All the fixed costs, wherever you see fixed cost, it will go up by how much? 10%. Remember, fixed cost will increase by 10%. You first arrive at the total fixed cost. On the total, you apply the 10% increase. Right? Whereas the direct labor rate and the material will increase by 8% and 6% respectively. So my material cost will increase by 8% and my labor cost will increase by how much? 6%. This increase will be on a per unit level. Why? Because it's a variable cost. Right? Next, he has no option of increasing the selling price, which means the selling price should continue to be how much? 14.3. Under this situation, he obtains an offer for further 20% of this capacity. Means what? Currently he is selling 6,000 units. 6,000 is equal to 60% of the capacity, which means 100% of the capacity is how much? It's going to be 10,000 units. I have the capacity to produce 10,000, but currently I'm only selling how much? 6,000 units. Clear with this, guys? Which means 4,000 units idle capacity. Now, suddenly he's getting an offer for selling how many units? 2,000 units, 20% of the capacity, right? No opportunity cost here. Why? It's only an idle capacity. Someone has come. Okay, let me accept it. But wait, what is the question here? What is the minimum price that you should recommend for acceptance in order to ensure that the overall profit of the company is how much? 16,730. What they are saying, find out the selling price on this 2,000 units order to make sure that the overall profit 6,000 units plus this extra 2,000 units, right, put together, overall profit of the company has to be how much? 16,730 rupees. Which means, first understand, for the first 6,000 units, the selling price will have to be 14.3. That cannot be changed. So there is no decision making here. Right? What is the decision we need to take here? We need to arrive at the selling price of this extra 2,000 units, that for the new order of 2,000 units that I'm going to get. Clear with this, guys? How will we do that? Very simple. Very simple. First, on the current 6,000 units, let us arrive at the profit. How do you arrive at the profit? Sales minus variable cost gives you contribution, minus fixed cost gives you profit. But wait, on the variable cost and fixed cost components, there are some increase in the costs as well. Fixed cost will increase by how much? 10% they have given. right? And direct labor will increase by 8%, material will increase by 6%. All these changes we need to apply. How do we go about with this? Though the solution is given, right, during our regular courses and all, I have neatly presented it. Every single sum has been handwritten. So 1 second, I quickly take this up, and then we will do this question. Just a minute, guys. So just taking this first question. By the way, you can download this, whatever I've written there. Here, this entire, the handwritten notes can be downloaded from our website under the free resources section. So you can easily download it. 1 second. Okay, I think it's here. Yes. Now, please have the question with you. Please have the question with you. With that, let's get started. Now, what have they given? At present, guys, what is going to be for the computation of profit on the 6,000 units, right? The current 6,000 units after increase in cost. Now, you guys have the question with you. What is going to be the selling price on these 6,000 units? 14.3. There is no change, right? How much is going to be the variable cost? First one, direct material cost. How much is it? Presently, it is 3.5. But remember, my material cost will go up by how much? Material cost will go up by 6%. Be careful. Direct labor by 8%, material by 6% respectively. Respectively has been given. So first was your labor and second was your material. Clear with this, guys? So which means 3.5 into 106 percentage, it will increase by 6%. So 3.5 into 1.06 is going to be 3.71 rupees my material cost. Next, direct labor. How much is it? At present, it is 1.25. It will increase by 8%. So 1.25 into 1.08. How much is it? 1.35 rupees. Right? Next, how about the variable component of your works overheads? Variable component of works overheads is how much we calculated. How much was it? 3.125. Now there is no increase here, right? Or have they given? Yes. So 6.25 into 50%, 3.125. There is no change here. Next, sales overheads. What is the variable component? We calculated 25% of 0.8. It came out to 0.20 rupees. 0.20. You add up everything, the variable cost per unit on the 6,000 units was how much? 8.385. Clear with this, guys? So what is the contribution per unit? 14.3 minus 8.385. It gives you 5.915 rupees per unit. Right? So this is the contribution per unit. So 6,000 units into 5.915 gives you how much? A total contribution of 35,490. Clear with this, guys? From this, subtract your fixed cost. How much is your fixed cost? There are two different fixed costs here. One is your works overheads, fixed component. Sales overhead, fixed component. Works overhead, what is the fixed components? 3.125, right? Into 6,000 units. 3.125 into 6,000. But wait, they have given in the question, all the fixed costs will go up by 10%, which means this was the original fixed cost, 3.125 into 6,000 into 10%, increase. So 3.125 into 6,000 gives you 18,750 into 1.1. So the revised fixed cost of, the works overheads comes out to how much? 20,265. How about your sales overheads? So the fixed component is 0.6 per unit. So it's going to be how much? 0.6 per unit, 0.6 into 6,000, right? 0.6 into 6,000 into 1.1, 10% increase. So 6,000, 0.6 into 6,000, 3,600 into 1.1 gives you 3,960. Clear with this, guys? So the total fixed cost comes out to 20,625 plus 3,960. The total fixed cost comes out to 24,585 rupees. So my profit is going to be contribution minus fixed cost. So it's going to be 35,490 minus 24,585 gives you 10,905. Basically, guys, what can I say? Sir, from this current 6,000 units, I will be able to generate a profit of how much? 10,950 rupees. Because on these 6,000 units, selling price, you can't change. It's given. right? So selling price minus variable cost gives you contribution per unit. So contribution per unit into the number of units gives you contribution. Contribution minus fixed cost gives you the total profit that can be generated out of what? Out of the 6,000 units. Perfect. How much was that? 10,905. Now, what is the question asking you to do? I am getting a new order. On this new order, right, what should be, for how many units? 2,000 units. What should be the selling price that you need to fix? Very simple. Now, I want to earn a total profit of how much? 16,730. Now, out of the 16,730, I have already earned a profit of 10,905 by selling the first 6,000 units, which means on these next 2,000 units, how much is the extra profit that I need to earn? So the required profit on the 2,000 units is how much? So 16,730 minus 10,905. 16,730 minus 10,905 gives you 5,825. So 5,825 rupees should be the profit earned from the extra 2,000 units. Correct. Now, on each of these 2,000 units, I incur a variable cost. Yes. How much is the variable cost per unit that I'm going to incur? 8.385. So which means the selling price that I need to recover, the sales value that I need to recover on these 2,000 units has to be, so the customer needs to pay me for the entire variable cost that I incur on these 2,000 units, plus he should also contribute towards a profit of the differential amount 8,000 to 5,825. So, or in other words, the required selling price in the 2,000 units is going to be the incremental cost you incur on these 2,000 units, which is nothing but the variable cost, plus the difference profit that I need to generate from these 2,000 units. That will be the total sales value that you divided by 2,000 units. You will arrive at the selling price required on these 2,000 units. As simple as that. That's why I said this chapter is nothing but your marginal costing plus common sense. That's all it is. Each and every question is like that. There is not much of concepts. It is just about logical application of questioning. So look at this here. Computation of selling price. Now 2000 into 8.385 comes out to 16,770 plus the required profit on these 2,000 units. Overall, I want to earn 16,730. Minus I've already earned 10,905 from the 6,000 units. The difference amount is 5,825. So the required sales value is going to be the sum total of these two, which is 22,595. So I need to generate 22,595 sales value by selling 2,000 units. So divided by 2,000, how much is it going to be? The required selling price is 11.2975. On these 2,000 units, we need to fix a selling price of 11.2975. Only if we fix a selling price of 11.2975, you will be able to overall generate a profit of how much? 16,730. Are you guys clear with this? This is a very, very logical way of approaching the sum, right? In your institute study material also, they have given the same thing, right? But the presentation is not that up to the mark. That's why for every single question, I have given my own better presentation, which is definitely accepted in your exam. Look, stepwise we have done it, right? And I follow this color coding also, all the headings in, the green ink and all that, important markings in red ink, right? And in the black ink, you write down whatever we do in the class. So this color coding the day before your exam, if you look at it, absolutely, right? Whatever mistakes you make, if you highlight it in a red ink, definitely these red ink items will pop up the day before your exam, and you will be able to properly make sure that you don't commit the mistakes in your exam. Fine. So with this, we have completed the first question. Please go and update your library of adjustments. Write down pricing decision hyphen calculation of selling price of a special order. Pricing decisions hyphen calculation of a selling price selling price of a special order to earn the required profit. To earn the required profit. Fine, guys? Yes. Now, with this, we have also completed this concept of pricing decision. So, opportunity cost pricing decision is over. Now, let's go and do one area called differential costing. Now, what is this concept of differential costing? Now, guys, till now, whatever we have learned both in marginal costing as well as in the applications till now. Now we have certain assumptions. Basically, number one, my selling price per unit remains constant, correct? Now, for an increase in the volume, right, there is no change in the selling price. Selling price per unit remains to be the same. For example, sir, first 10,000 units, one selling price. Next 10,000 units, another selling price. We don't have this concept here, right? If you have this concept, then you can't use all these formulas that we used, right? For example, calculation of break-even point. Break-even point calculation is fixed cost by contribution per unit. Right, contribution per unit, how do you arrive? Selling price minus variable cost. If you have different selling price, now how will you arrive at a single contribution per unit? No. Clear with this, guys? So the fundamental assumptions we take in the basics of marginal costing is selling price per unit remains constant, variable cost per unit remains constant, and fixed cost in total remains constant. All these things will not change with your volume, guys. Correct? No? This is the assumption we take. Yes. Now, what happens in case you break any of these assumptions, one or more of these assumptions? If you break, right, in that case, how do we apply the concepts of marginal costing? Right, for example, my fixed cost changes, guys. Right, now how will I calculate my break-even point? Break-even point is fixed cost divided by contribution per unit. Let us say for the first 50,000 units, my fixed cost will be, example, 10,000 rupees. Now suppose if my volume is more than 50,000 but less than 1 lakh, in that case my fixed cost will become 12,000 rupees. Right, now I have two fixed costs here. How do I calculate the break-even point? Break-even point is fixed cost divided by contribution per unit. Guys, are you clear with this? Now I have two different fixed costs and all. How will I do this, sir? Now this is a subject matter of discussion in your CMA final level. However, to a very limited extent, we have a concept called differential costing that deals with, now, what happens in case any one of these assumptions are broken. In this case, how do you take a decision is the subject matter of study in this particular concept. Right, now let's go and do one numerical problem. Please take question number 21 of your solved question bank that talks about the differential costing concept, a very important concept. With the help of this, we will understand how do we tackle this situation. Right, only a particular situation is there. How to calculate the break-even point in case your fixed cost changes or selling price changes, variable cost changes and all. So we have a concept of step fixed cost and all these things is subject matter of discussion in your CMA final, that I'll be dealing it in a depth manner. Right now we are just focusing on the concept of differential costing, wherein we are saying this one of these assumptions are broken. In that case, certain decisions, how do you take? Now let's go and hit question number 21. So it's fully organized, guys. So we've fully organized all these things in terms of the sequence of doing the sums. Can't directly do question number 1, 2, 3, 4. It's not the same order in which we do in the classroom, because it needs to be structured properly. So the structuring takes a lot of time and efforts. That's what actually I do it during the course of our lectures, and for every single sum I would have dictated the library of adjustments, which please, if you have attended my lectures, please have it along with the discussion here. Right now all these questions are already there in your notebook. We did it during the class. Right, follow this marathon along with that particular notebook. In case you have already attended my lectures, it's going to be super useful for you. Now question number 21, what have they asked? A company has a capacity of producing 1 lakh units of a certain products in a month. In a month, I can produce a maximum of 1 lakh units. The sales department reports that the following schedule of sale prices is possible. Volume of production. If I operate at 60% of the total capacity, that is, if I sell 60,000 units, I should fix a selling price of how much? 0.9. Right? Now, if I reduce the selling price to 0.8, which means now I can sell more units, 70,000 units. Are you guys clear with this? Or in other words, the law of economics functions here. Reduction in the selling price will increase your volume. If you fix a selling price 0.8, you'll be able to sell 70,000 units. 70% of the total capacity, 70,000. I've written it down here. Right? So if you further reduce it to 0.75, your volume will increase by another 10,000. So 80,000 units. Further, if you reduce your selling price to 0.67, you'll be able to sell 90,000 units. Further, if you reduce the selling price to 0.61, you'll be able to sell 1 lakh units. Now, the variable cost of manufacture between these levels is 15 paise per unit. Variable cost per unit is how much? 15 paise. Fixed cost is how much? 40,000. But in this case, selling price changes with your volume. See, one of one of your particular assumption is broken. Guys, clear with this? This is why I actually started this concept with the basic concept of your underlying assumptions. Now you guys are able to understand here, variable cost per unit is not changing. Fixed cost as a whole is not changing, but what is changing is only your selling price. Clear with this, guys? Now what they are saying, prepare a statement showing incremental revenue and differential cost at each stage. At which volume of production will the profit be maximum? Right? Now I have a better way of presentation. Instead of this, once again, please go to this handwritten notes. Right? You can download this from our website. I told you. Now a very good and a fundamental concept is what I'm going to explain with the format which I've done here. Now look at this. Determination of the capacity at which the profit will be the maximum using the concept of differential costing. So now what they are saying, sir, how many units should I sell? This is the decision making when there is a change in the selling price based on my output level. Clear with this, guys? Now if the selling price is going to be the same, what will be the answer? Sir, try to produce the maximum number of units as possible. Clear with this, guys? But look at this here. So 1 lakh units I will say, but here the selling price itself is changing. So for each level we need to compute what is the profit and we need to analyze this, right? So that we will do it in a certain way in which you can take a proper decision. Look at this, guys. Now first, capacity in percentage. This is the first column. Then we will write down units: 60, 70, 80, 90, 100. So which means units is 60,000, 70,000, 80,000, 90,000 and 1 lakh. Right, guys? Now the next column should be sales. Then you should have a variable cost. Variable cost is 0.15 per unit, right? Then you have fixed cost, right? Then you have total cost. Total cost is nothing but variable cost plus fixed cost, right? Then you have a column called differential cost. What it is, I will tell you. Then you have a column called incremental revenue, and you have a column called net benefit. I will tell you what is what. You need not have to worry. Now units are available. Yes. Now please have the question with you. Please have the question with you. Now what we will do is, first, what is the selling price? Now at 60,000 units the selling price is 0.9. So what will be my total sales value? 60,000 into 0.9, 54,000. At 70,000 units, what is the selling price? 0.8. So 70,000 into 0.8, how much is that going to be? 56,000. Then 80,000 units, what is the selling price? 0.75. 80,000 into 0.75, how much is that? 60,000 rupees. Then 90,000 units, 90,000 into 0.67 is the selling price. So the sales value is 60,300. And at 1 lakh units, what is the selling price? 0.61. So 1 lakh into 0.61, 61,000 rupees is the sales value. So at every single volume level, we have now calculated the sales value. Yes. Now what is the variable cost? Sir, variable cost is 0.15 rupees per unit. Right? Now use the calculator trick. Right? Now for those who do not know the calculator trick, very simple. What you need to do, 0.15 rupees. Right? So is the per unit cost of, per unit variable cost. Now how much is the variable cost for every single output level? 0.15 into 60,000, 0.15 into 70,000, 0.15 into 80,000, 0.15 into 90,000, 0.15 into 1 lakh. Or in other words, the same number needs to be multiplied with different numbers. Now what some students do is they keep on repeatedly doing it. 0.15 into 60,000 is equal to, they write down. Once again, 0.15 into 70,000 is equal to, they write down. Don't waste your time in exam. I will give you a calculator trick. Now take your calculator, right? In your calculator, just follow the steps I tell you. Write down 0.15, right? Then click on the multiply button twice. Into. Now what is the first number with which you want to multiply this 0.15? 60,000, right? Write down 60,000. So 60,000 and click is equal to, how much you get? 9,000, right? So 0.15 into 60,000, click is equal to, how much you get? 9,000, right? Wait. The next number that you want to multiply this 0.15 is what? 70,000. Don't do anything. In your calculator display, you have 9,000 now. Yes. Now don't do anything. Just type 70,000 and put is equal to, how much you get? You get the next figure, 10,500, right? Then next you want to multiply this with 80,000. Don't do anything. Directly type 80,000 and click is equal to, how much you get? 12,000. Then don't do anything. The next number, 90,000. 90,000 is equal to, you get 13,500. Next number, 1 lakh. 1 lakh is equal to, you get 15,000. In a single click of a button, right, you get respective figures. So 0.15 into 60,000 is equal to, write down, 70,000 is equal to, write down, 80,000 is equal to, write down, 90,000 is equal to, write down, 1 lakh is equal to, write down. In a single click of a button, all these figures you will get it. Are you all able to understand? This is a very, very useful hack during your course of your examination, because in your exam you are not left with the luxury of time. Clear with this, guys? Right? So you get all the variable costs. Now how much the fixed cost? It remains to be 40,000 in all the cases, right? Now in each of the case, calculate the total cost. Total cost is variable plus fixed. So 9,000 plus 40,000, 49,000. 10,500 plus 40,000, 5,500. 12,000 plus 40,000, 52,000. 13,500 plus 40,000, 53,500. And 15,000 plus 40,000 gives you 55,000. So for every single volume level, we have computed the total cost. Guys, correct up? Now what you need to do, first calculate the differential cost. Differential cost means what? Incremental cost. Now for the first base, it will always be nil. Why, sir? I will tell you. Now 60,000 units if I produce, what is the total cost, guys? 49,000. Now if I produce 10,000 units more and move on to the next level, that is 70,000 units if I go, right? In this case, you tell me how much will be my total cost? 5,500, or in other words, my cost will increase by how much? The differential cost, incremental cost. How much is that going to be? So from 49,000 it becomes 50,500. So 5,500 minus 49,000, the extra cost you incur is how much? 1,500. Perfect. Now what happens, guys? Now if I sell 10,000 units more as compared to the current level, if I move to the next level, what is the extra cost I need to incur? 1,500. What is the extra revenue you will be getting? Sir, instead of 54, now I will be getting 56,000. So the incremental revenue is going to be how much? 2,000 rupees. Now you guys tell me, from 60,000 units level, if I jump to 70,000 units level, right, the extra revenue I will get is 2,000 rupees. But to get this 2,000 rupees, I need to incur a differential cost, extra cost of how much? 1,500 rupees. Net of how much extra do I earn? 500 rupees. That is a positive net benefit of 500. Now will I be motivated to move to the next level? Yes, because if I move to the next level, extra I will get is 2,000. For this I need to earn extra is, incur extra is 1,500. The net profit or the net benefit, extra incremental extra benefit is going to be how much? 500 rupees. Are you guys clear with this? Yes. Now you are at the 70,000 level. Now let us see if you will be motivated to move to the next 80,000 units level. Let us see. Now if I move to the next level, now as compared to the previous level, how much is the incremental cost, differential cost, extra cost? 52,000 minus 5,500. I need to incur extra 1,500 rupees. For this, how much is the incremental revenue? Instead of 56,000, now you will get 60,000 rupees. The extra revenue is 4,000 rupees. So if I move to the next level, I earn an extra revenue of 4,000, for which I need to incur an extra cost of 1,500. Guys, clear with this? Which means the net benefit over and above, right, from the 70,000, if I move to 80,000 units level, the extra benefit that I will get, net benefit is how much? 4,000 minus 1,500. It is going to be 2,500 rupees I'll be getting extra. Yes. So will I move from 70,000 units to 80,000 units level? Yes, I will be motivated because it has a positive net benefit. Are you all able to understand this? Yes. Now I am operating at 80,000 units level. Now let me see if I can move further. If it gives a positive net benefit, I will go for it. Now if I move from 80 to 90,000 units, how much is the extra total cost, differential cost? How much is that? So 53,500 minus 52,000, I need to incur an extra cost of how much? 1,500 rupees. Now how much is the extra revenue will I get? Now instead of 60,000, I will now get 60,300. Are you clear with this? Which means the extra revenue will be 300 rupees. Or in other words, if I move from 80,000 units to 90,000 units level, I will get an extra revenue of 300 rupees. But to earn this 300 rupees revenue, I need to incur an extra cost of how much? 1,500 rupees. Which means if I move from 80,000 units to 90,000 units level, the net benefit will be negative 12,000 rupees, so 1200 rupees. What will I do? I will not move to the next level. I will stop here. So, or in other words, you keep on trying to move to the next level as long as you are having a net benefit. The moment the net benefit turns out to be negative, you will stop there at this level. Clear with this, guys? So first I started off at 60,000, 60%, 60,000 units level. If I move from 60% to 70% of the capacity, my profit increased by 500, so I went. Now I was at 70% capacity level. If I move to 80% capacity level, my profit further increased by 2,500 rupees. So I felt it made sense. Now from 80% to 90% capacity level, I saw if I further move on to the next, that is from 80%, if I move to 90% capacity level, I will start incurring there will be an incremental loss only for me, which means I will stop here at 80% capacity. Beyond this, I will not move. Or in other words, the optimum capacity level, or in other words, my profit will be maximum only if I operate at an 80% capacity level by selling 80,000 units. Are you all able to understand? This is a very, very important understanding for you. Clear with this, guys? If you want, you can also do, sir, for some reason I went to 90%. Further, if I go to 100%, what will happen? Incremental differential cost 55,000 minus 53,500. I need to incur an extra cost of 1,500. How much will be the incremental revenue? 61,000 minus 6,300, 700 rupees. So I will earn 700 for extra. For me to earn the 700 extra, I'll have to incur 1,500 extra. 700 minus 1,500, incremental loss of 800. Anyways, I will not even go to 90%. What is the question of going to 100%? Clear with this, guys? So this is a concept of differential costing. What we do at every single capacity level, we calculated the differential cost, compared that with the incremental revenue, arrived at the net benefit, and we will be motivated to move to the next level as long as my net benefit is positive. Or in other words, incremental revenue is greater than differential cost. The moment my incremental revenue became less and the differential cost became more, I will not move to the next level. I will stop at that level itself. Are you guys clear with this? Or simply put, let us say, sir, for every capacity level, if you want to arrive at a profit amount at the first capacity level, what is the total profit? Sir, sales 54,000, total cost is 49,000. Subtract the two, 5,000 rupees the profit. Yes. Sir, 70% capacity level, what is the profit? 56,000. 56,000 minus 5,500 is going to be 5,500. 80% capacity level, what is the profit? 60,000 minus 52,000, 8,000 rupees. 90% capacity level, 6,300 minus 53,500, 6,300 minus 53,500. How much is it? 6,800 rupees profit. And 100% capacity level, look at the 61,000 minus 55,000. How much is it? 6,000 rupees. Now, if you notice, where is the profit maximum, guys? The profit is maximum only at 80% capacity level. We ourselves have seen here, guys. Clear with this? If you want to go based on the total approach also, clearly it will tell you that only at 80% capacity level, your profit will be maximum. Look at this. At 60%, it was 5,000. 70%, it slowly increased. If you move to the next level, 80%, it further increased to 8,000. Now, if you want to further increase your output, what happens? Your profit starts declining. Clear with this, guys? This is clearly shown in the concept of differential costing, where we compared the differential cost with the incremental revenue, and we slowly made a progress to the next level. And we decided to stop at 80% capacity level, because if you move beyond this, the differential cost exceeds my incremental revenue. Obviously, I will not go for it. Are you all able to understand? This is the concept of differential costing. As simple as that. Please go and update your library of adjustments. Write down differential costing. That's all. There's only one sum with respect to differential costing, and that sum we have covered here in this marathon as well. So please go and update your library of adjustments. Write down differential costing. Differential costing. Fine, guys. Yes. Now, with this, let's move on to the next concept. So even differential costing is done here. Let's move on to the next concept called as make or buy decision. Now, what do you mean by make or buy decision? Now, let me take an example of a company called Maruti Suzuki. All of us know Maruti Suzuki. What business are they into? Manufacturing of cars. Now, this concept of make or buy decision, please understand what it talks about. What decision are we going to take here? Now, For me to produce, for me, 1 unit of output is a car. Correct? 1 unit of output is a car. Correct? Now, every car requires one component called a steering wheel. Right, guys? Correct? The steering wheel is actually a raw material, or I can call it as a component. Now, this particular concept of make or buy decision says, should this component or raw material, steering wheel, should I make this raw material? Should I manufacture the steering, or should I buy it from outside and should I assemble it? Clear with this, guys? Or in other words, please understand here the make or buy decision is not about, sir, should I make the car or should I buy the car? No. If I buy and sell the car, I'm not a manufacturer, I am a trader. The question is not about the FG. This decision of make or buy should be applied on the raw material or the component. So please understand what this concept says. Make or buy decision is something that you need to apply on your raw material, not on your FG. Now, the steering wheel is a raw material. Should I manufacture the raw material in-house, or should I purchase the steering wheel? Should I purchase a steering wheel and should I use it for my FG? Are you guys clear with this? That is the decision we are going to take here in this particular concept of make or buy decision. Clear with this, guys? Sir, what is a big deal here, sir? Now, guys, always understand one thing. Now, let us say Maruti has one big factory for manufacturing their car. Now, if they decide to make a steering wheel also, near this factory, they will start one small workshop. In this workshop, what they will do? They will be in what? They will start manufacturing the steering wheel. Right? That is, they will buy plastics, they will buy whatever is the required component, wiring and all these things, right? Metals, all these things, raw material. With this, they will come up with the output called steering wheel. This steering wheel will now become a raw material for this final car. Are you guys clear with this? Or in other words, here for this raw material of steering wheel, the question is, should I buy it from outside? Right? Or should I start my own small factory for it? Or inside our normal factory itself, should I dedicate a place for this and start manufacturing my component in-house? Is the decision we take here. Always remember, guys, if you make your own product, it is cheaper. If you buy it from a vendor, if Maruti decides to buy the steering wheel from an outside party, definitely it will be a little costlier. Clear with this, guys? Now the next question is, sir, then what is the decision making here? You yourself told us, if you buy, it is always costly. If you make the raw material, it is cheaper. Guys, correct? Then, sir, always make it by yourself. No, have a factory in-house. Even you produce your raw materials, sir. Why do you have to buy it from outside? Because if I buy it from outside, my supplier will add his margin and he will sell it to me. Guys, clear? So obviously, the cost of buying is costlier than the cost of making, or making is cheaper than buying. Then you make the raw material, sir. Don't buy it. Why is the decision making here? No, it's not as simple as that. There is an issue in this area. What is that issue? We will understand with the help of one numerical problem. But for that, first you should understand the context. That is the reason why I explained this make or buy decision concept. Right? Now, with this, let's go and do a numerical problem. Question number 32. So, let's do this question number 32. Yes. Now, let me read out the question for you guys. So it's question number 32. I'll also take the question separately. 1 second. Yes. Now, look at this. You are the management accountant of F and Co, which manufacture stoves, right? The gas stove, right? And it has an opportunity to buy handles for its stoves. Now, every stove requires a handle, right? Or let us say the burner. Now, there is a stove here. This stove has burners in it, right? This is where the burner, that is basically, this is where you will light your, the stove, and you will keep your vessels on top of it. Now, they are in the business of manufacturing the stove. In this handle, or let us say the burner, right, is a component which either they can actually buy from an outside party and assemble it in the stove, or they can make even this component can also be manufactured by them. Look at this. They have an opportunity to buy the handles for its stove for 8 rupees per unit. What is the meaning of this? Sir, if I buy the handle, it is going to cost me 8 rupees. The MD is not sure about what should be done for the best interest for the company, and he needs your help in arriving at a decision. This purchase would affect the prices, volume, and cost as follows. What they are saying: buy and make. Buy and making of what? Of the handle, not the stove. I am in the business of manufacturing stoves. If I buy the stove itself and sell it, then I will not be a manufacturer. I will just be a trader. We are not talking about that. We are talking about a manufacturing concern. In one of the raw material for me in the stove is a handle. Should I buy the handle or make the handle is the decision here. Now, if I buy or make the handle, what will happen? In either which case, the unit selling price of what? Selling price of my final product, which is the stove, will continue to be how much? 340. What will be the volume? Sir, whether I make or buy my component, output volume will not change. 500 units every month I will be able to sell. What is this? Stoves. 500 units of stove I will be able to sell. How about my unit variable cost? If I buy my particular the component called as handles, then the variable cost will be 88 rupees, right? And the purchased part, that is nothing but your purchase price of the handle, will be how much? 8 rupees. Or in other words, if I buy the handle, right, now in that case the purchase cost for buying the handle is 8, plus obviously there will be other costs for manufacturing the stove. It is going to be 88 rupees. Clear with this, guys? Or in other words, the total variable cost is going to be 88 plus 8. How much is that going to be? It is going to be 96 rupees. Whereas if I make my own handles, the total variable cost is going to be 95 rupees only. 95 plus 0. I don't buy anything. I manufacture. Clear with this, guys? Or in other words, if I make my own stove, if I make my own handle, the variable cost of manufacturing 1 unit of FG is 95 rupees. Whereas if I buy the handle, remaining I manufacture by myself, in that case the total cost is going to be 96 rupees. And look at this fixed cost. How much is it? 4,700 rupees if I buy. Whereas if I make, it has to be 5,500 rupees. Now, you are required to decide whether the part that is nothing but your handle should be made or bought, which is nothing but make or buy decision. Now, what will you do here? Very simple, guys. What will we do here? Simple. If I buy, what is the total profit? If I make, what is the total profit? You arrive at it. Now, whichever gives you the maximum profit, you will actually go with it. As simple as that. Guys, clear? Yes. Now, what do we do here? Look at this. Simple, sir. Now, whether I buy or make, what is going to be my total sales units? 500 units. What is going to be my selling price? 340 rupees. So 500 into 340, my sales value is going to be 1,70,000. Sales is going to be 1,70,000 whether I buy or I make, right? What is going to be my variable cost? Sir, if I buy, my variable cost is going to be 88 plus 8, 96 rupees per unit. Whereas if I make, my variable cost is going to be 95 plus 0, it's going to be 95 rupees per unit. So simple. So 500 units into 96, how much is it? So it's going to be 48,000. Whereas if I make, what is the total variable cost? So 500 units into 95, 47,500. So what is the contribution here? 1,70,000 minus 48,000. It's going to be 1,22,000. Here it's 1,70,000 minus 47,500. It's 1,22,500. Clear with this, guys? Minus fixed cost. What is the fixed cost? Sir, if you buy the handle, fixed cost is 4,700. If you make the handle, the fixed cost is 5,500. Populate the figures here. 4,700, 5,500. Overall, what's going to be the profit if you buy? 1,22,000 minus 4,700. 122,000 minus 4,700, you get 1,17,300. Whereas if you make it, it's going to be 122,500 minus 5,500. It's going to be 1,77,000. Or in other words, guys, if you buy it, if you buy the component, the total profit is going to be 1,77,300. if you make the component, it is going to be costing you, it is going to give you a profit of how much? 1,17,000. So here it's 1,17,300, it is 1,17,000 here. Between the two, which gives you a maximum profit, sir. Only if I buy the component, it gives me a maximum profit. My profit increases by how much? 300 rupees. So in this case, sir, I would say it makes sense to buy the product. Do not make it buy and assemble. Clear with this, guys? Look at this. So the operating profit of the company increases by 300 if I purchase or buy the handles rather than making them. So the company should outsource and buy them instead of making them. Clear with this, guys? In this situation, it made sense to buy and not actually make it. Clear with this, guys? Now, sir, you only told me, sir, if we buy it is generally costly, sir, but if we make by ourselves, it is generally cheaper, right? Then, sir, how in this case, if I buy, it gave me a more profit? This doubt is there or not? Yes. Now, remember, guys, remember, always remember this. Now, if you notice in this case, if I buy this particular component, my total variable cost was 96. If I made this component, my total, the total variable cost was how much? Only 95. Obviously, no doubt, making was cheaper than buying. But what happened if I buy? My fixed cost was only 4,700. Whereas if I make, I need to set up a small, workshop and all. So overall, the fixed cost changed because of this decision. Guys, clear with this? So fixed cost increased. Are you guys clear with this? Or guys, in other words, can you see between buying and making? Right now, you can't directly jump to the conclusion and say, sir, always make, sir, it is only cheap. No. Now, if I make, I have an advantage of a lower variable cost. Whereas if I buy, the advantage is by way of a lower fixed cost. Now, guys, does it ring any bell? Are you able to connect? This is nothing but the concept of indifference point here. Now, both the alternatives have one advantage and one disadvantage each. Hence, this is nothing but a concept of indifference point. Are you guys able to understand? In this case, selling price is also there. Guys, are you all clear with this? So literally 340. If you notice here, if I buy or make, what is going to be my contribution per unit? Simple. It is going to be 340 minus 96. 340 minus 96. How much is that? 244 rupees is going to be my contribution per unit. Whereas if I make my own product, how much is going to be my contribution per unit? 340 minus 95. 340 minus 95 gives you 245. Clear with this, guys? It gives me 245. Clear with this, guys? So now if you look at it, making gives me an advantage of a more contribution per unit, or in other words, lesser variable cost. Whereas what happens to the fixed cost? 4,700 rupees the fixed cost of buying, whereas making the fixed cost is 5,500, which means, sir, which one will I go for it? First, you arrive at the indifference point. Indifference point is nothing but the difference in fixed cost divided by difference in the contribution per unit, or difference in fixed cost divided by difference in variable cost per unit. All the concepts we have seen in marginal costing itself. Clear with this, guys? How much is the indifference point here? Sir, 5,500 minus 4,700. How much is it? Sir, 800 rupees. Right? Divided by the difference in contribution per unit. How much is it? 245 minus 244. 1 rupee. Or in other words, difference in variable cost per unit. 96 minus 95. The difference is only 1 rupee. So divided by 1. So the indifference point is 800 units. Guys, clear with this? Now, why do we calculate the indifference point? If your estimated volume is less than your indifference point, you should go for that option that gives you a lower fixed cost. Now, between the two, which gives you a lower fixed cost, buying option. Right? Now, if your estimated volume is more than your indifference point, you will go for that option which gives you a higher contribution per unit, or in other words, a lower variable cost per unit. Which one is that? You will make it. Clear with this, guys? And at the indifference point, whether you buy or you make, it will give you the same profit only. Clear with this, guys? Now, in our example, what was the volume? Sir, the volume was only 500 units. Now, 500 units lies below your indifference point. Hence, in this case, buying was beneficial to us. Are you guys clear with this? Whereas, if the estimated volume was more than 800 units, then manufacturing your own component would have been beneficial. Are you guys clear with this? Or in other words, this is the reason why we have a make or buy decision. You can't always say making is good or buying is good. Both the alternatives have one advantage and one disadvantage each. So you need to arrive at an indifference point and arrive at this decision. Clear with this, guys? In this question, they didn't ask you to calculate the indifference point. For the given volume, they just asked, arrive at the total profit for both the alternatives and go for the one which gives you the maximum. However, I am telling you the fundamentally behind this, the concept of indifference point lies. In exam, they can even ask you on this parameter. Are you guys able to understand? So this is the reason. No doubt, making gives you a lower variable cost, but buying you need not fix any amount. You need not commit any amount on having your own workshop for manufacturing your steerings. Right? You can just go and buy. So there is literally a lower fixed cost here. Both the alternatives have one advantage and one disadvantage each. Hence, at times buying could be beneficial, at times making can be beneficial, and at one point both will give you the same alternative or same profit. That is called as indifference point. Clear with this, guys? This is beautifully the concept of make or buy decision. As simple as that. So please go and update your library of adjustments. Write down make or buy hyphen with change in fixed cost. Make or buy hyphen with change in fixed cost. Clear with this, guys? So literally with this, even the concept of make or buy decision is over. So opportunity cost, pricing decisions, make or buy, differential costing, all these are over. Now let's go and do one particular numerical problem in this segment. These are not separate concepts as such. Replacement decisions means what? Should I replace or use my existing machine? So there is no concept here. Using the principles of marginal costing, you need to do it. Evaluation of alternative choices means what? They will give you multiple alternatives. You will go for that alternative which gives you the maximum profit. In fact, make or buy decision, also the previous sum which we did, it is one type of evaluation of alternative choices only. Between the two, we went for this alternative because it gives me the maximum profit. As simple as that, right? Subcontract or not decision, we will do one numerical problem in this area, right? And expansion or not decision, basically, should I expand, add one more product line or not? Simple. Arrive at the total profit. If it gives you the maximum profit, you go for it. If not, continue with the existing business. Clear with this, guys? Basically, these four I have categorized into one because they are not concepts as such. They are just different varieties of numerical problem. In our marathon, I am picking one numerical problem, right, in these four areas. Subcontract or not decision, I'm just taking one numerical problem and we're going to do with this. But in our exam oriented or regular batch, every single sum that you see in the book is being solved. 100% of your institute study material, and in fact in your regular classes, even the past exam question, every single question, in fact even the institute has not given a suggested answer, but we do it in detail, just like how you saw here. I write it down, every single solution, and we do it. That is the level of depth with which we actually do in our classes. But in a marathon, due to limitation of time, it's a revision area. So I'm taking one representative sum and we are going to do here. So please take question number 12. Please take question number 12. 1 second. Just taking it out for you. Yes. Question number 12. Okay, guys, let's get started. Now, question number 12. TTD Limited manufacturing a single product has a normal working capacity of 8,000 units per annum. So they can produce 8,000 units per annum. The sales manager has projected a sales of 10,000 units for the year 21-22 at a price of 250 rupees per unit. So generally they produce 10,000 units, but this guy, the sales manager, he has projected that the sales for the upcoming year is going to be 10,000 units. The selling price is also given as 250 rupees per unit. The operating budget is given as follows. So the sales 8,000 at the rate of 250, 20 lakhs. The cost of production, they have given the total amount they have given. Raw material cost, direct wages, Your works overheads, 1,40,000 rupees is the total works overheads. Out of this, 50% is fixed, which means the balance 50% is variable. Admin overheads, 60,000, 0.6 lakhs, everything is fixed. Selling and distribution overheads, 1 lakh rupees, 80% fixed, which means the balance 20% is going to be variable, right? So the total cost is how much? The sum total of this is going to be how much? 18 lakh rupees, and the profit is 20 minus 18, 2 lakh rupees. Now, in order to increase the production to meet the sales demand, two proposals have been put forward. Now, what they have said, this is the current data. Now, in order to increase the overall production to meet the sales demand, they have come up with two proposals. Option number one, subcontract the production of 2000 units at the rate of 225 per unit. What is the meaning of subcontracting? Now, using your factory, you produce 8,000 units, right? Now, sir, I'm going to get a demand of 10,000. What if I only produce 8,000? Balance 2,000 units, sir. What will I do? You don't produce. You ask another manufacturer to produce these 2,000 units and supply it to you. You just sell it. Or in other words, you manufacture 8,000 units and sell 2,000 units. You subcontract it. You purchase it from another person and sell it. Clear with this, guys? Now, subcontract the production for how much? 2,000 units at the rate of 225, which means what they are saying, if they subcontract, they have mentioned that the person to whom I subcontract, he is going to charge me 225 rupees per unit. So I will purchase it at 225 rupees and sell it. Or in other words, to the extent of these 2,000 units, I'm going to become a trader. And 8,000 units I manufacture and I sell. Clear with this, guys? Next, or option number two, install an additional machine which will entail the following expenses. Cost of a machine is going to be 2 lakh rupees with a life of 20 years. Recruitment of 10 workers, including direct workers, to operate the machine at a wage rate of rupees 500 each per month, and add 25% towards employee benefits. None of the existing workers will be utilized for this purpose, and the interest on capital required for purchase of the machine is going to be 15% per annum. Now, what have they said? Look, currently, sir, normally I have a capacity to produce only 8,000 units. But if you're asking me to produce and sell 10,000 units, how can I do this? Two options. Number one, the difference, 2,000 units, you purchase it from outside and sell it. Or number two, you increase the capacity of the plant to accommodate this extra 2,000 units. So if I increase the capacity of the plant, what will I do? I need to purchase a new machine. The cost is given, the life is given. With this, I can arrive at the depreciation per annum, right? And on top of this machine needs to be operated. Automatically, my raw material will not get converted into an FG. So recruit 10 workers. That includes direct workers to operate on the machine. The wage rate is going to be how much? 500 each per month, which means 500 into 10, 5,000 rupees per month. Clear with this, guys, right? And plus 25% I need to pay them for employee benefits. Ideally, guys, all these are new workers, not the existing workers. Now, and the interest on this, the new machine is going to be 15%. The following additional fixed expenses will be required under both the alternatives. Means what? Whether I subcontract or I install a new machine. Now, in this case, additionally, the following fixed expenses will be incurred. Admin, 10,000 rupees per year. Selling and distribution, 20,000 rupees per year. You are required to prepare, number one, a statement showing the respective profitability of the two methods of increasing the production. And number two, comment upon the choice of one of the two proposals. Simple. Basically, we have three situations. Situation number one, sir, existing, sell 10,000, 8,000 units. Situation number two, overall sell 10,000 units. How? You manufacture 8,000 and 2,000 units, you purchase it. That is subcontract it to another person, purchase it from him and sell it. This way you can achieve 10,000 units. Or another way of achieving 10,000 units is expand, own expansion. You purchase another machine and now what you are going to do, the entire 10,000 units you are going to manufacture. Now between these three, whichever gives me the maximum profit, I will go for that particular proposal. Are you guys clear with this? Extra, I have only two proposals, but we will also take the current position, because suppose current position is better off than either of the two, then I will not go for expansion only. Are you guys clear with this? So literally we have three situations and we need to arrive at whichever situation gives me the maximum profit. Clear with this, guys? As simple as that. Now, how do we go about with this? First, find out what is the selling price per unit. Find out what is the variable cost per unit. Find out what is the fixed cost in total for the respective alternatives. Prepare the profitability statement for each of the three alternatives and go for the one that gives you the maximum profit. As simple as that, guys. Simple. And you just need to have a presence of mind. This is the reason why I said this chapter is nothing more than marginal costing plus some common sense. Now, look at this. Literally, this entire sum, I've done it. Now, what happens in this case? Now, first, I'm putting up rupees in lakhs, which means all these are totals. Income statement of the proposed alternatives. First one, guys. Now, A, sales. Now, whether I subcontract or whether I do my own production, whatever it is, what is going to be my selling price? 250 rupees per unit, right? So presently, how many units? 8,000 units. 8,000 into 250, how much is that? 20 lakh rupees. So rupees in lakh, I've just mentioned 20. Next, if I subcontract, in this case, overall, how many units, sir? 8,000 plus 2,000, 10,000 units into 250 rupees. Selling price is going to be 25 lakhs. If I do an own expansion, in that case also 10,000 units into 250, 25 lakhs. Clear with this, guys? Perfect. Next, come up with the variable cost. First, what is going to be my raw material cost? Have the question with you. Now, raw material cost, how much is it? 12 lakh rupees, sir. At present, the raw material cost is how much? 12 lakh rupees. Now, guys, understand. If I do a subcontract, what will be the raw material cost? Understand the raw material cost will continue to be 12 lakh. Right? This is the reason why I have written it down in a red ink. Right? During our regular lectures and all, we discussed this. Right? Many students made the mistake. That's why it is written down in a red ink. Now, how, sir? 10 lakh, 12 lakh. Sir, here I'm producing 10,000 units. No, you don't produce 10,000. You only produce 8,000 units. 2,000 units, you purchase it. You subcontract. For the subcontractor, you pay a separate subcontract cost of 225 rupees. Separately, we will say. So, raw material cost is incurred only on this 8,000 units. All the other costs are incurred only on this 8,000 units here in case of subcontractation. Are you guys clear with this? Right? Whereas if I do an own expansion, I am now going to produce how many units? 10,000 units. What will be the raw material cost? Simple, sir. 12 lakh rupees the raw material cost for 8,000 units. How will be the raw material cost for 10,000 units? So 12 lakh divided by 8,000 into 10,000, you get 15 lakh rupees. Proportionately, it's a variable cost, right? Or you can say 12 lakh divided by 8,000. 150 rupees is the variable raw material cost per unit. Into 10,000, you get 15 lakh rupees. It comes as the raw material cost for own production. Have the clarity. This requires some presence of mind. That's all, guys. Next one. How about my direct wages? 3 lakh rupees is my direct wages. Variable cost only? Yes. So, subcontract, if I do, it continues to be 3 lakh. Why? I only produce 8,000 units. On this 2,000, you will not incur a cost. We will separately have a subcontract cost. We will deal with that later. Clear with this, guys? How about own expansion? Sir, 10,000 units I'm going to produce. Simple. 3 lakh is the cost for how many units? 8,000 units. So what is the labor cost per unit? 37.5 into 10,000. You get how much? You get 3 lakh 75,000. Clear with this, guys? All right. So 1 second. This is what you have here. 1 second, guys. Okay. I'm sorry here. Look at this. Ideally speaking, it has to be 3,75,000 here, right? But look what they have done. Look, existing workers. So for them, they've only produced 8,000 units. Sorry, look at this. What is given here? For this extra 2,000 units, even if I do an own expansion, I will recruit 10 workers. To each of these workers, I will pay 500 rupees per month. Guys, correct? Plus another 25% I need to pay as an employee benefit cost. So literally, how much is going to be my labor cost on this extra 2,000 rupees, 2,000 units? Guys, be very careful here. Now, how much is that going to be? So 10 workers into 500 rupees each month. So 10 into 500 gives you 5,000 rupees per month. Into 12 gives you how much? 60,000 rupees per annum. Guys, correct? So 60,000 rupees is the cost per annum, right? Plus 25% of the 60,000 is also another benefit that I'm going to give them, or in other words, into 1.25. How much is that? You get a total of 75,000 rupees. Are you all clear with this? Or in other words, direct wages, if you look at it, 3 lakh rupees is the cost for labor cost for 8,000 units. The balance 2,000 units, I have a separate direct labor. Why? So new machines are on that separate direct labor. On this, the cost is how much? 75,000. So you can't proportionate. I stand corrected. So here, 3 lakh plus 0.75. Overall, the cost is 3 lakh 75,000. Though the amount is same, the calculation needs to be separate. I will have to hire an additional worker. Calculation, sir, 5,000 rupees per month. right, into 125 percentage, because 25 percentage more I pay into 12 months. Clear with this, guys? Right. Next one, works overheads. How much is it? 1,40,000. Out of this, 50 percentage is fixed, which means the balance 50 percentage is variable, right? So 1,40,000 into 50 percentage, 0.7. It's the present data. Sir, for subcontract, I'm still producing only 8,000 units. With respect to 2,000 units, the only cost incurred is subcontract cost. I'm just being a trader for the remaining 2,000 units. So here it continues to be 0.7, right, or 70,000. Whereas own expansion, how much will it become? Sir, 70,000 is the cost for 8,000 units. How much will be the cost for 10,000 units? Or in other words, you have to do a proportionate calculation. 0.7 or 70,000 divided by 8,000 into 10,000, you get 87,500. Or if you want to express it in lakhs, it comes out to 0.875. Next, selling and distribution overheads. What is the variable component here? So 1 lakh out of this 80% is fixed, which means 20% is variable. Guys, correct? And so that's going to be 20,000, or you can put it as 0.2. Now if I subcontract, sir, I'm producing only 8,000, sir, continues to be 0.2, right? Own expansion. So now in this case, it will increase proportionately. So 20,000 is a cost for 8,000 units. How much will be the cost for 10,000 units? 20,000 by 8,000 into 10,000. So 25,000 rupees, or if you want to express in lakhs, it's going to be 0.25. Clear with this, guys? The next one, subcontract cost. Many students miss this out. That's why after doing everything, they miss this. So please, that's the reason why I'm writing it out in the reading. Please don't miss this. Now, subcontract cost, it is incurred only in second alternative. So 2,000 units I'm subcontracting. I'll purchase at the rate of 225. 2,000 into 225. How much is that? 4,50,000. Or you can call it as 4.5. This is not incurred in the present situation. This is not incurred in the own expansion also. Now, if you total up, you will get the total variable cost here. Right, guys? You'll get the total variable cost. Present situation, total variable cost is 15.9 lakhs. Subcontract 20.4 lakhs, and own expansion 19.875 lakhs. Clear with this, guys? So now what's going to be the contribution? Respective sales minus respective variable cost gives you the contribution. So 20 minus 15.9 is 4.1 lakh. 25 minus 20.4 gives you 4.6 lakh. 25 minus 19.875 gives you 5.125 lakhs. You get the contribution. From this, subtract your fixed cost. Now, sir, how do you compute the fixed cost? For this separate working note, I have present, subcontract, and own expansion. Now, at present, right, first, what is the works overhead, sir? Fixed component, sir, 1.4 lakhs. Out of this, 50% is how much? 70,000 or 0.7. So now I will incur this works overheads of 0.7 irrespective of my output level. So in all the three situations, I will incur. Yes. Next, admin overheads are 0.6 lakhs, all fixed. So this 0.6 lakhs is also incurred in all the three situations. Next, our selling overheads, 1 lakh out of this 80% is fixed. So 0.8. So 0.8 is also incurred in all the three situations. Guys, are you all able to understand this? Yes. Now, look at this. Look at this. What have they mentioned? The following additional fixed overheads, fixed expenses will be required in respect of both the alternatives. What are they? Admin and selling and distribution. Extra, how much is it? 10,000 and 20,000 per year. Guys, correct? So 10,000 and 20,000 per year. So additionally, if you notice here, additional overheads, how much is it? So 10 plus 20, 30,000 rupees is an additional fixed cost I will incur in both the alternatives of subcontracting as well as own expansion. So 0.3 and 0.3, this will be additional overheads. Clear with this, guys? And on top of this, understand, if I'm going for our own expansion, I will have to buy a new machinery. So for this machine, every year additional new machine, new extra depreciation, how much is that? 2 lakh divided by 20. So 2 lakh divided by 20 gives you how much? 10,000 rupees the additional depreciation every year. So 0.1 lakh. Clear with this, guys? And one more thing, this 2 lakh rupees of extra, the new machinery, on this I'm going to buy it at by paying an interest of 15%. So 2 lakh into 0.15 gives you 30,000 rupees of interest. That is also going to be another cost. So 30,000 is nothing but 0.3 lakhs. Clear with this, guys? But let me tell you one thing, in our subject we will never consider this particular interest cost and all. However, in this question they have considered. So that's the reason why I am also not changing this approach. So this is also being considered. If you add up, what is the present fixed cost? 2.1 lakh. Subcontracting in this particular alternative was a fixed cost 2.4 lakhs. If you add it up, own expansion gives you a fixed cost of 2.8 lakh. This breakup, I think it's not properly given even in the study material. Directly, they have just given all these figures. That's why every single line item we did during our lectures, that is what I'm presenting to you right now. Clear with this, guys? So 2.1, 2.4, 2.8. Finally, you arrive at the profit. So contribution minus fixed cost. 4.1 minus 2.1. 2 lakh rupees the current profit. 4.6 minus 2.4, 2.2 is the profit under subcontracting alternative, and 5.125 minus 2.8 gives you 2.325 lakhs is the alternative for, the profit for own expansion. So between the three, which gives me the maximum profit is earned under, alternative, the third alternative, or in other words, own expansion. So which means given all these situations, it is better to do an own expansion by purchasing a new machinery. Clear with this, guys? This is the conclusion which you can give. Are you all able to understand? That's all about it. Now in a single sum, if you notice, there is absolutely nothing new in terms of concepts, but it requires some presence of mind where you had to do some proper calculations, arrive at the correct figures and do it. Simple, we use the same marginal costing income statement. Sales minus variable cost gives you contribution, minus fixed cost gives you profit. But every line item required a detailing with all the proper working notes is what we saw in this question. This is why I said it's not a separate concept as such. All these are not separate concepts as such. These are different variety of problems. Ideally, in my opinion, these are all library of adjustments, right? However, these four I'm talking about. However, fine, I wanted to do one representative sum with the marathon, but remember, we do every single sum in our lectures, right? But I just want you guys to make sure that we are revising this also, and that is the reason why I included this in our marathon. On that note, please go and update your library of adjustment. Write down question number 12. Give all the cross-referencing. Write down subcontract or not decision hyphen profitability under different alternatives. Subcontract or not decision hyphen profitability under different alternatives. Clear with this, guys, right? So with this, we have completely revised this entire chapter of applications of marginal costing. All these things, highlighted things, were already completed in our marginal costing chapter. So whatever I have ticked up here, this we did right now. And in fact, in these four areas also, we did one numerical problem with respect to your subcontract or not decision. So this area was also covered. Clear with this, guys? So literally, we have revised this entire concept, entire chapter as well. So now let's move on to the next one. So now let's start the revision of a new chapter, activity-based costing. Now the prerequisite for this chapter is overheads chapter. That is, you should have an idea about your overheads chapter. So it is better to watch your overheads chapter first before you enter into activity-based costing, because this chapter, activity-based costing, is nothing but an extension of overheads chapter. As simple as that, right? Now guys, one more thing. This chapter is a common chapter for CA intermediate costing as well as CMA intermediate paper 12 management accounting. The very same exact chapter is there for both CA and CMA inter in paper 12 management accounting. It is there. So this is also something I want to mention before we get started into this particular chapter. So on this note, let's get started. Now guys, what is the objective of this particular chapter, activity based costing? The objective of this chapter is to calculate the overhead cost per unit of the product. Sir, what sir? In overheads chapter only, we saw the objective of overheads chapter is to calculate the overhead cost per unit, right? But once again, we are going to compute the overhead cost per unit only under activity based costing. Yes. Why sir? Because there are some serious drawbacks in your traditional costing method, basically your overheads chapter. Now, first we will understand what those drawbacks are, and that is only being overcome under this chapter called activity based costing. So the drawbacks of your traditional costing method is being overcome using your activity based costing. If you understand this concept, right, this entire chapter is going to be super easy for you, as simple as that, right? We will also do one numerical problem and we'll close off. It's a very simple chapter provided you have a right application of mind. Clear with this, guys? Now, first, in overheads chapter, we saw that first we have multiple line items of indirect manufacturing cost, right? Let us say, for example, supervisor salary, your factory rent, repairs and maintenance, your depreciation on machinery, and all that. Now, first, what we do primary distribution, and we distribute this all these line items to all the departments of this particular factory. Example, P1, P2, P3, S1, S2. Correct? Then what we do? We redistribute back the service department overheads back to the production department. This is what we do. So we redistribute back the overheads incurred in the service department back to the production department. So at the end of secondary distribution, we only have P1, P2, P3 overheads, right? This is called as secondary distribution. And finally, from this, the third step is called as absorption. What we do is that using the concept of absorption, so we convert these bulk figures into overhead cost per unit of the products. The products could be, let us say, product A, product B, product C, product D, and so on. So using the concept of absorption, we calculate what? So we convert these bulk figures into overhead cost per unit of each and every product. This way, we achieve the objective of converting these bulk items into overhead cost per unit of each of the products, and we actually come up with the final objective. This helps us to achieve the overall objective of stock valuation and profit computation. This is what we used to do in our overheads chapter, correct? Right? Which we call it as a traditional costing system. Now, activity based costing system says the starting point, correct, line items of all your indirect manufacturing cost. The destination is to calculate your overhead cost per unit of each of the product, right? So the starting point and the ending point are same in ABC as well as in traditional costing method, but what is different is only the journey. Activity based costing says this journey is absolutely wrong, right? Now what we did in traditional costing system, now we apportioned all the line items of expenses to all the departments. Why? Because we took a stand that, look, I incur cost because I have departments, so distributed back to all the departments. From here, the service department were reapportioned back to the production departments, and from the production department we charge it to the product, right? Now ABC says this particular methodology unfollowed under the traditional system follows a serious limitation. What is it? Now, to understand this, let us go back and revisit one concept in overheads which we saw, which was called as your blanket overhead rate versus departmental rate system. We saw that, right? So I will quickly revisit that. From there, if you actually take it forward, that is when the activity based costing concept will be appreciated in a better manner. Now, we saw this in the concept of blanket rate versus departmental rate, right? Let me refresh your memory with respect to this particular example. Let us say a factory has two departments, P1 and P2. The overheads incurred in department P1 was 20,000, overheads in department P2 was 15,000. And let us say in department P1 the labor hours were 5,000 hours, and P2 department the labor hours were 3,000 hours, which means the absorption rate for department P1 is going to be 20,000 by 5,000, 4 rupees per hour, and the absorption rate for department P2 was 15,000 divided by 3,000, which is 5 rupees per hour, right? So suppose I am following a departmental rate, means what? Calculating the absorption rate department wise, right? In that case, how will I apportion or charge the overage to the product? Let us say I produce a product A. which spends 3 hours in department P1, 2 hours in department P2. What will I do? For each of the 3 hours, I will charge it with 4 rupees. For each of the 2 hours, I will charge it with 5 rupees. This way, I end up with an overhead of 22 rupees for product A. Product B, let us say, spends 2 hours in department P1 and 3 hours in department P2. Right, so now what do I do? For each of these 2 hours, I charge it at the rate of 4 rupees, and for these 3 hours, I will charge it at the rate of 5 rupees. So if I multiply that, finally I get an overhead cost of 23 rupees per unit. Right, now suppose if the company is following a blanket overhead rate system, which means single overhead rate for the entire factory, what will I do? Total overheads for the factory, which is 20 plus 15, 35,000, divided by total base quantity, 5,000 plus 3,000, 8,000 hours, which means a single rate is what I use. 35,000 divided by 8,000 hours, it comes out to rupees 4.375 per hour. Now, how will I charge the overage to the product? Simple. Product A spends how many hours in the factory as a whole? I'm not bothered about department-wise breakup. 3 plus 2, 5 hours it spends the factory. Each of the 5 hours, you give it a share of 4.375 rupees. Department product B, it spends how much? 2 plus 3, totally it spends 5 hours. I'm not bothered about where they spend the hours, right, into a single rate. So you arrive at the overhead per product. Clear with this, guys? Now, between the departmental rate and the blanket rate, which rate is better? We saw that departmental rate is absolutely a better method as compared to the blanket rate system. Why? There were a few advantages. One of the most important advantage is that, look, suppose let us say P1 department is a machining department, P2 department is an assembly department. Now, if I follow a department-wise overhead rate system, then I have the flexibility to choose the appropriate base quantity. For example, department P1 is a machining department. Then to absorb my P1 department's overhead, now it makes sense to use machine hours as the base quantity. Suppose department P2 is an assembly department. Here it makes sense to use your labor hours as the appropriate base quantity. Guys, correct? So I have the flexibility to choose the appropriate base quantity based on the factor that drives my cost. Guys, clear with this? This was one of the biggest advantages of your departmental rate. Whereas if I use a blanket rate, single rate for the entire factory, I necessarily have to use only one. I necessarily have to use only one base quantity. Now that need not be ideally the correct factor that drives my entire cost. Are you guys clear with this? So this was one of the reasons why we saw department-wise absorption rate is better than a single overhead rate for the entire factory. Guys, correct or not? Yes. Now let me take an example. Let us say departmental rate is correct. This is where ABC comes and says, even your departmental rate is not correct. Why? I will give you guys an example. With the help of this example, you will have a crystal clear clarity. Let us say department P1, one of the departments in the factory, is a machining department. Clear with this, guys? What does departmental rate, what does departmental method of absorption rate, what does it say? Simply it says, so take a respective department. For that department, whatever has to be the appropriate base quantity, use that as the base quantity to absorb your overheads. This is what your departmental rate says. Yes. Now, let us say P1 is a machining department. So we'll say the entire P1 department overheads should be absorbed taking the base quantity as machine hours. Right? This is what your departmental rate says. Yes. Now, I will give you guys an example. Let us say department P1, right? This is going to be your machining department, right? Let us say this department's overhead was rupees 1 lakh, right? Which means this is a machining department. Machines are available here, and this departmental overhead is going to be how much? 1 lakh rupees. Now, how, sir, 1 lakh you have incurred? I am giving you guys the breakup. Now, out of this 1 lakh, I'm talking, this is 1 lakh is what? Departmental overheads. I'm not even talking about the entire factory overheads. In this entire factory, there is one department called P1 department, which is a machining department. So here the overhead is how much? 1 lakh rupees for this department. Now, how have they incurred 1 lakh rupees, sir? I'm giving you guys the breakup. Now, out of this 1 lakh, right, 60,000 rupees pertains to machine running activity. How much? 60,000 rupees. Then there is another activity incurred inside this department called setup activity. Let us say 15,000 rupees is actually the cost incurred for your setup activity. Let us say I carry out another activity called inspection activity, right? For this inspection activity, in this department, I incur a cost of 25,000. So literally, this department overhead is how much? 1 lakh. The breakup for 1 lakh is 60,000 rupees machine running activity, 15,000 rupees setup activity, 25,000 rupees inspection activity. Clear with this, guys, right? If you add up, you get 1 lakh. Now, logically think, had you used a departmental rate, right, as we studied in overheads chapter, this entire 1 lakh, right, for this entire 1 lakh, we would have taken the base quantity as what? Your machine hours. But however, if you notice, now only this machine running activity, 60,000 rupees is driven. This cost is only driven by your machine hours, guys, correct? Sir, only for the purpose of machine running activity, machine hours can be taken as an appropriate base quantity. Why? Setup activity, 15,000 rupees you have incurred. Setup activity is actually incurred not for your machine time, not based on the machine hours, but setup activity is driven, or it is incurred based on the number of setups you have, or in other words, number of batches you have. Guys, what do you mean by setup activity? Before I start a particular batch, right, I need to set up my machine, and only then I can start my production. For example, let us say I'm starting this video, this session. Before I start up this session, I need to turn on the camera, I need to turn on my MacBook, I need to turn on the lights, another thing, right? Once this particular lecture gets over, I will turn it off. Now, the duration of the lecture is not relevant, right? Here, the number of times I open and close my laptop is when actually I have to once again redo the setup. Clear with this, guys? So here, this setup activity is not driven based on your machine hours. It is completely driven based on a separate base quantity, which is number of setups. Similarly, inspection activity cost is how much? 25,000. It is not driven by machine hours. This cost is actually incurred based on the number of inspections carried out. Are you guys clear with this? Or in other words, right, even your departmental rate is wrong. It said entire 1 lakh, they are assuming it is driven by machine hours, while only 60% of this entire departmental cost is actually driven based on your machine hours, which is your machine running activity, because there could also be certain other activities which are incurred because of certain other reasons, which could not be your what? Which could not be your machine hours. Are you guys clear with this? So literally what your activity based costing says is, first of all, I agree with your starting point, I agree with your destination, but this journey is where I do not agree with what it says. Look, you do not incur the cost because you have departments. Clear with this, guys? So basically, what activity based costing says is that, look, you incur cost because you have activities, or in other words, activity based costing clearly says, look, you have multiple activities. You have multiple activities in your factory. Now, because you have multiple activities, you start consuming resources, and because you start consuming resources, you actually incur the cost. Are you guys clear with this? Hence, what our activity based costing says is that, now, do not apportion your cost to all the departments by saying that, sir, I incur the cost because I have a machining department, because I have a production department, I have an assembly department. No. Zoom in further. It is not because of the department that you incur the cost. It is because of activities, right? Within every department, that is the reason why you incur the cost. Hence, the correct way of doing is, these line items of expenses should be apportioned to all the activities. First, list out what are all the multiple activities in your company, right? And try to allocate and arrive at the cost for every activity, and for every activity, from here, charge it to the products. Or in other words, here we use departments as the basis to actually transfer the costs to all the products, whereas activity based costing says, look, You don't incur all these line items of cost because you have a department. You incur these costs because you have activities, and activities, right, results in consumption of resources, and because you consume resources, you incur cost. Sir, what is it? Example, setup activity I have. Because I have setup activity, right, the resource consumption is the number of setups I have, right? Because I have this activity, there will be multiple number of setups, and since I have multiple number of setup, let us say I am hiring a guy and I am saying I will pay him 100 rupees to actually set up every time I start a session, right? He should come, fix the camera, I mean turn on the light, turn on the camera, connect, and give me all this iPad, MacBook, everything he should connect, and he should give it to me, right? He should turn on the mic and everything. Every time I start a session, I will actually hire this guy, and let us say I'm paying him 100 rupees. Now I actually do one setup. Now he is set up and he is gone. Now after one setup, whether I record 1 hour or I record for 10 hours in the day, it really doesn't matter, right? Here, this setup cost is not driven by the duration of the lecture. It is driven by the number of times I ask him to come and set up. Guys, clear with this? Or in other words, here the setup activity is an activity, right? The resource consumption is the number of setups, and because you have a resource consumption, it results in what? Incurrence of cost. So this is actually a game changer in the way in which cost gets looked at. Are you guys clear with this? So activity based costing was a game changer in the industry with respect to the perspective at which cost has been looked at. Literally in everyday real life scenarios also, you can actually use the concepts of activity based costing. Clear with this, guys? Now in this particular chapter, what we are going to do, we have multiple activities on the starting point and the ending point. We need to calculate the overhead cost. We should calculate the overhead cost per unit of A, B, C, D, or overhead cost per unit of the product. Now how are we going to do it? Basically, we have multiple line items of expenses on one side, and we have the products on the other side. Now what we do is we arrive at what is the cost incurred for respective activity, and from there, for every activity, we will find out what is the appropriate cost driver. So what do you mean by cost driver? The factor that drives my cost is called as a cost driver, or in other words, in overheads chapter we called it as base quantity. In this particular chapter we are going to call it as cost driver. Some terminology difference. For example, machine running activity. What is the cost driver? The factor that drives the machine running activity is what? Machine hours. Setup activity, the cost driver is number of setup, because the cost is driven by the number of times you set up. Inspection activity, number of inspections. Clear with this, guys? That is called as cost driver. So first we list out the activities. For every activity we arrive at the cost driver, then we calculate the absorption rate, right, per unit of cost driver. What it is and all, we will be doing it with the help of one numerical example. And typically in this particular chapter, the exam question, how it will come like is that they will give a data and they will ask you to compute, right, apportion the overheads, calculate the overhead cost per unit of a product using the traditional costing system, that is overheads chapter, and under ABC. Clear with this, guys? This is how they actually test this particular chapter, and this is what is all the chapter about. Clear with this, guys? So in our concept decoder, all these things I have clearly explained in a very neat manner, right? I have also given you guys the format that needs to be used for our numerical problem. All these things I have separately done, just so that it's easy for you to quickly revisit the day before your exam. What is what? Do not worry. Clearly, we will take up one numerical example, and with the help of this example, we will completely finish this particular question or this particular chapter. Clear with this, guys? Now, please take your question number 1 in your, the CA Inter concept, your CA Inter solved question bank. Please take question number 1. Now, look at this. The indirect expenses expended by a machine shop in a factory during a period amounted to rupees 1 lakh. The machine running time for the period is 10,000 rupees. What are they saying? In a machine shop, right, in a factory, the overall total overheads incurred is how much? 1 lakh. The machine running time, machine hours, is how much? 10,000. The details of the utilization of machine time are as under. I produce 2 products, A, B. Right? How many units? I produce 200 units of A, 100 units of B, and A, totally these 200 units of A consumed a total of 5,000 hours, and 100 units of B consumed a total of 5,000 hours, right? 5 plus 5, overall 10,000 hours was the total machine hours incurred in this factory. trace the overhead cost per unit to the two products using traditional overhead absorption costing system. We need to calculate the overhead cost per unit under the traditional absorption costing system, right? How do you do? Very simple. Calculate the blanket overhead rate. Sir, 1 lakh divided by 10,000 hours. So how much is it? 10 rupees per hour, and accordingly you apportion it to the two products. You will arrive at the overheads attributable to A, attributable to B, divided by the respective units. You will arrive at the overhead cost per unit of A and B. We will do it, don't worry. Next, the company collected more details relating to the activity performed by its machine shop to enable tracing the indirect costs by using activity-based costing system. Now, what have they given? Sir, this 1 lakh, sir, what is the breakup of this 1 lakh? Now, out of this 1 lakh, 60,000 rupees is pertaining to machine running activity. 15,000 rupees is pertaining to setup activity. 25,000 rupees is pertaining to inspection activity. Guys, literally, right now I gave you guys an example, no? This example, whatever I gave you was nothing but I picked the figures from this first question only. Are you clear with this? Right? Now, what they have said, the cost driver means what? The base quantity, the factor that drives the cost. Machine running activity is driven by machine hours. Setup activity is driven by setup time. Instead of number of setups, they are using setup time, right? And inspection activity is driven by inspection time, the number of hours for which the inspection activity was carried out. Clear with this, guys, right? They have given in the question. And the cost driver consumption is given here, right? Totally, sir. Product A consumed total of 5,000 machine hours, B consumed 5,000 machine hours. How about setup time? The product A consumed total of 3,000 setup hours, B consumed total of 2,000 setup hours. How about inspection time? A consumed total of 1,500 hours, B consumed total of 3,500 hours. Clear with this, guys? Now, trace the overhead cost per unit of the two products using activity-based costing system. So, literally, this is how your exam question comes like. So, you need to calculate the overhead cost per unit under the traditional costing system and once under your activity-based costing system. Now, under the traditional costing system, how will you do that? That is the first part of discussion. So, calculating the overhead cost per unit using the traditional costing system. Now, what do you do? Simple. Take the total overheads divided by your total hours, right? Machine hours. So, it's going to be 1 lakh divided by 10,000 hours. It's going to be 10 rupees per machine hour. So, now what do I do? Sir, product A consumed a total of 5,000 machine hours. B consumed a total of 5,000 machine hours. So what is going to be the total overheads that I'm going to apportion? So 5,000 into 10, which is going to be 50,000 rupees of overheads is attributable to A. 5,000 into 10, 50,000 is attributable to product B. Clear with this, guys? 5,000 into 10, 5,000 into 10. So 50,000 rupees of overheads to A, 15,000 rupees of overheads to B. Now, how many units of A and B have been produced? 200 units and 100 units respectively. So how much is the overhead cost per unit of A? Sir, 50,000 rupees, the total overheads pertaining to product A. How many units of product A have been produced? 200. So 50,000 divided by 200. The overhead cost per unit of A is going to be 250 rupees. Clear with this, guys? Right? So it's going to be, one second. So it's 50,000 divided by 200. Yes, it's going to be 250 rupees per unit. How about product B? So product B share of overheads is 50,000 rupees, right? And this is the cost pertaining to 100 units of product B. So divided by 100. So literally you remove two zeros, you get what? 500 rupees per unit. Clear with this, guys? So under the traditional costing system, what you have is that so 250 rupees is the overhead cost per unit of A and 500 rupees is the overhead cost per unit of B. Are you clear with this? As simple as that, guys. Beyond this, there's nothing there. Beyond this, this is all it takes. Clear with this, guys? The next one. Now let's go on to activity based costing system. Guys, use this format. This is a beautiful format and you can easily crack the sums with this format, right? So this is a format which I generally use for solving all the sums, right? This is the best format because it is a foolproof approach, meaning you cannot make mistakes easily. Now look at this. First, what you need to do? In activity based costing system, you have a two-step procedure. Step number 1, calculating your cost driver rate. This is similar to your absorption rate. And step number 2, apportionment of overheads, or in other words, charging of overheads to product. Basically, guys, your absorption, that is the third phase of your overhead accounting, has two-step procedure. Step number 1, calculating your absorption rate. Step number 2, charging of overheads to product. Similarly here, instead of absorption rate, we call it as cost driver rate. Clear with this, guys? And step number 2 is apportionment of overheads to the products. Now, first list out the activities. What are the activities? Machining, setup, and inspection. These are the 3 activities available: machining, setup, and inspection. Now, these are the 3 activities, right? Now, activity wise, how much is the cost? Now, sir, machine running activity cost overall is 60,000, setup activity 15,000, inspection activity 25,000. Clear with this, guys? So this is called as cost pool. Clear with this, guys? What is it called as? Cost pool. Cost pool is similar to there in your overheads chapter. These are all departments. That's how we call it. And we call this as departmental overheads. Here we list out the activities, and the costs pertaining to every activity is called as cost pool. Clear with this, guys? Next, you need to write down what is the cost driver name. Clear with this, guys? So what is the cost driver name needs to be written down. So what is the cost driver name here? Now, sir, machine activity is driven by machine hours. Setup activity is driven by setup time. Inspection activity is driven by inspection time. Clear with this, guys? Cost driver name needs to be written. Next, what is the cost driver quantity? This is similar to the base quantity. Sir, overall, this machine running activity is driven by machine hours, right? The 60,000 rupees is incurred for total of how many machine hours? Read the question. 5,000 of A plus 5,000 of B. Overall, sir, in this factory, I have how many machine hours? 10,000 machine hours. Clear with this, guys? So now you can just put it up here. So it's going to be 10,000 machine hours. Similarly, setup time, how much is it? 3,000 plus 2,000. Overall, sir, the cost is incurred for 5,000 setup hours. So you can just write down here 5,000 machine hours. Right? Sorry, setup hours. Then how about inspection? 1,500 plus 3,500. Overall, you get how much? 5,000 inspection hours. Clear with this, guys? It's going to be 5,000 inspection hours. Clear with this, guys? Yes. So now, what do you have here? What do you have here? Simple. So now the cost pool, the respective activity cost pool divided by the cost driver quantity, if you do, you will arrive at the cost driver rate. There we call this as absorption rate. Here we call it as cost driver rate. Now 60,000 rupees divided by 10,000 machine hours gives you how much? 6 rupees per machine hour. So literally, guys, 6 rupees per machine hour is the cost driver rate. Are you guys clear with this? Similarly, 15,000 divided by 5,000 hours gives you how much? So 3 rupees is the cost for every hour of setup, for every setup hour. Clear with this, guys? So 3 rupees per setup hour. Similarly, inspection, 25,000 divided by 5,000 inspection hours for every inspection hour, right? So for every hour spent for inspection, the cost is going to be 5 rupees. Clear with this, guys? So this way, literally we have found out the cost driver rates for the respective activities. Clear with this, guys? Now once you do that, now what do you need to do? Apportionment of overheads to the respective products. Yes. Now what is it going to be here? So what are the 2 products the company deals in? Product A and product B. So what you need to do? Particulars, product A, inside that 2 column, cost driver quantity amount, and product B under the 2 column, cost driver quantity and amount. So this is not P1, P2. Ideally speaking, this is product A, this is product B. Now product A, so what you need to do? You need to list out what are all the different activities. Machine activity, setup activity, inspection activity, right? Now product A, what is the cost driver quantity? So sir, product A, sir, it consumes 5,000 machine hours, 3,000 setup hours, and 1,500 inspection hours. Just write it down here. 5,000, 3,000, 1,500. Then how about product B? Sir, it consumes 5,000 machine hours, 2,000 setup hours, and 3,500 inspection hours. Just listed out here. 5,000, 2,000, and 3,500. Clear with this, guys? Right? So now what do you need to do? Sir, for every machine hour, I should charge the product with how much? 6 rupees. So 6 rupees into 5,000 is equal to, you get 30,000, right? And 5,000 is equal to 30,000. So for every machine hour, I should charge it with 6 rupees. Similarly, setup time, guys. setup activity. For every setup hour, I should charge the product with 3 rupees. So 3 into 3000 gives you 9000. 3 into 2000 gives you 6000 rupees. So out of this, overall 9000 rupees is the setup cost attributable to product A. 6000 rupees is setup cost attributable to product B. Clear with this, guys? So the total setup cost was 15. Out of this, I properly apportioned 9000 to A and 6000 to B based on the setup hours consumed by the respective product. This is a more fair and a rational way of apportioning your indirect cost, because you list out the activities. For every activity you find out the cost driver, right, and based on that cost driver you apportion it to the respective product. It is not a random base. You find out for every activity the factor that drives the cost, called as the cost driver, and you calculate the cost driver rate, using which you rationally and properly apportion it to the product. This is a more meaningful way of charging your indirect costs to your product. So this will result in a better and a fair costing. Are you guys clear with this? Similarly, your inspection. So for every inspection hour, I should charge the product with 5 rupees. So 5 into 1500, 7500. 5 into 3500, it's going to be how much? 17500. So literally we have calculated the activity wise share of costs for both the products. So now 30 plus 9 plus 7500 is 46500 rupees for A. 30 plus 6 plus 17500, 53,500 rupees is the cost of overheads attributable to product B. Clear with this, guys? So now what do you need to do? So this is the total cost of overheads for how many units of A? 200 units of A, which means how much the cost per unit? 46,500 by 200 gives you 232.50. Right? This is the overhead cost per unit of A. How about B? It is going to be 53,500 divided by 100 units. Similarly, just simply remove 2 zeros, get 535 rupees per unit. Clear with this, guys? Right? Now, if you look at it, had you used your traditional costing system, the overhead cost per unit of A was how much? 250. Whereas here it is how much? 232.5. It is ideally less. Clear with this, guys? Now based on this only, you value your stocks, because your stocks are valued generally at full manufacturing cost. Prime cost components are at actuals, right? On top of this, you had overhead cost per unit. Now if you use your traditional absorption costing system, it results in a wrong costing of product, whereas this 332.5 rupees is a more appropriate and a more accurate way of charging your overheads to the product. This will result in wrong costing if you follow your traditional costing methodology. This is what your activity based costing says. Clear with this, guys? So 232.5 for product B. Under the traditional system, it was how much? 500 rupees. Now it becomes 535. Ideally speaking, every unit of B should get 35 rupees more share of cost of overheads. Clear with this, guys? Had you followed your traditional costing system, you would have undervalued or undercosted your product B, and product A, you're giving a share of 250, while actually you should be giving only 232. You are over costing your product A. Are you guys clear with this? This will result in wrong costing of products, so wrong valuation of stocks, wrong fixation of selling price, because cost plus profit is equal to selling price. Literally, this entire company will get into a mess because of a wrong way of apportioning your indirect cost to the products. Are you guys clear with this? And this is what your overheads, this is what your activity based costing pinpoints and rectifies. Clear with this, guys? Basically, this chapter is nothing more than a refined version of your activity based, of your traditional costing system, right? So please go and update your library of adjustments. Write down question number 1. Please write down question number 1. Write down question number 1. Calculation of overhead cost per unit, under traditional costing system. If you want, you can use a short form TCS. This is just for our understanding. Traditional costing system, TCS, and activity based costing ABC under TCS and ABC. Clear with this, guys, right? That's about it, right? So overall in this chapter there's only this concept. Based on this, there are multiple variety of problems which we generally solve in our regular and exam oriented batch, but here for the marathon purpose I explained the concept and one representative sum we did here. And one more thing I want to tell you, the difference between your traditional costing system and your activity based costing system in the terminologies. So traditional costing system, activity based costing system, there we use departments to apportion your overhead cost. Here we use activities, right, to apportion your overhead cost. Number two, there we call it as departmental overheads. Here we call it as activity cost pool. Clear with this, guys? In the overheads chapter we use the word base quantity. Here we use the word cost driver quantity. In your traditional costing system, your overheads chapter, we use the word absorption rate. Here we use the word cost driver rate. That's all it is. That's all it is. So here this chapter says your cost is not incurred because you have departments. It is incurred because you have the activities, and activities, if you have activities, it results in consumption of resources, and consumption of resources results in incurrence of cost. Hence, just because you have a name board saying department 1, department 2, department 3, don't think because of the department the cost has been incurred. Zoom in and see inside the department there are multiple activities. It is because of these activities that the costs are incurred. List out the activity. For each activity, arrive at the cost pool, that is the cost associated with the divide for that activity. Find out what is the factor that drives the cost, called as cost driver. For each and every activity, calculate the cost driver quantity, divide the cost pool with the cost driver quantity, arrive at the cost driver rate, and using this cost driver rate, charge it to the product using the base quantity consumed. Correct? Or in other words, your cost driver quantity consumed. And with that, this will be a meaningful way of apportioning and charging your overheads to products. Clear with this, guys? And that is all this chapter says. It's fairly a small chapter, but there are multiple varieties of problem based on the concept which we have revised right now. Clear with this, guys? So with this, we have fully completed this particular chapter. Generally, this chapter gets tested almost every attempt, and this is definitely an important chapter. So on that note, so this particular chapter is over. So now let's move on to the next one.